Friends, good evening. Welcome to day 3 of your CA Final FR Marathon. Yes, total 5 days we are having. Out of that, 2 are completed, 3 more to go. Now, which topics we already completed? I'll just tick out the topics which are already completed. Introduction to Ind AS is done. Then, your Ind AS 1, presentation of financial statement, that is done. After that, we moved on to Ind AS 102, the share-based payment, that is done. And then we did your chapter number 12, business combination, chapter number 13, consolidated financial statement, and we also done schedule 3. So this much portion we have already completed. Now, sir, what is your today's target? Okay, indirectly, if you try to see, we have completed chapter number 12, chapter number 13, chapter number 1, and here in your chapter 3, unit 1, and in your chapter 7, unit 3, this much portion is completed. Now, today's target. We need to finish off chapter number 3, Ind AS on presentation. They will be finishing Ind AS 34, Ind AS 7. So Ind AS 34 and 7 will be done. Plus, we'll finish off chapter number 4, that is Ind AS 8, Ind AS 10, Ind AS 113. So chapter 3 will complete, chapter 4 will complete, and chapter number 6, not 5. Chapter number 6, in your chapter number 6, we have Ind AS related to your assets, Ind AS 2, Ind AS 16, Ind AS 23, Ind AS 36, Ind AS 38, Ind AS 40, Ind AS 105. 116 will not be done today. 116 will not be done today. So we are completing chapter number 3 today, chapter number 4 today, and chapter number 6, all standards except leases. Okay, any doubts? Anybody till now? Any doubts? Anybody till now? I told you the most important thing over here is discipline. Please make sure you're attending all the 5 sessions. It should not be like you're attending 1 or 2 and then you're not attending. That is not going to give you any benefits. So if you are attending revision session, make sure you're attending all of it. Plus, our revisions are kind of in-depth. We are covering all the theories as well as the important questions also. It's not just a superficial discussion. It's an in-depth thing. We are having total 25 hours here. Yeah, so 25 hours we are doing it. It's kind of a detailed revision over here. Thank you. Chalo, let's begin with Ind AS 34, chapter number 3, unit number 2. Chapter number 3, unit number 2, Ind AS 34. Okay, now Ind AS 34 is on interim financial reporting. So first of all, what do you mean? What do you mean by the word interim financial reporting? The interim financial reporting is basically a financial reporting which is for a period shorter than a full year. Okay, what's the interim period? What do you mean by the word interim period? It's a period shorter than a full financial year. It's a period shorter than a full financial year. An interim financial report. What is an interim financial report? It's a financial report which contains either a complete set of financial statement or a condensed set of financial statement. So for interim financials, we are allowed to give a condensed set which will have a selected notes. So complete set or a condensed set of financial statement, but for an interim period. What is the interim financial report? It's a financial report containing a complete set of financial statement or a condensed set of financial statement, but for which period? Interim period. It's not a full year, it's part. Fine. Now, listed entities are required to publish quarterly financial information in newspaper. Currently, the quarter got over and you see the quarterly results are coming out. The listed entities are required to publish quarterly financial information in newspaper. Does that quarterly financial information come under this interim financial report? Answer is no. No, because that quarterly financial information which is published, that is as per the SEBI norms. वो SEBI norms के हिसाब से. It is not a complete set of financial statement. It's not a condensed set of financial statement. The listed entities presenting quarterly unaudited but reviewed financial information, it's not covered under Ind AS 34, but for measurement purpose, for recognition measurement, they will be following Ind AS 34. Otherwise, Ind AS 34 doesn't apply to it. So Ind AS 34 not applicable to it. However, recognition measurement principle they'll be following, which are given under Ind AS 34. Next, content of your interim financial report. I told you they can have either a complete set or a condensed set. If you're going for a complete set of financial statement, it was already given under Ind AS 1. Okay, if they're going for a condensed set will have a minimum condensed balance sheet, condensed SOPL, condensed statement of changes in equity, condensed cash flow, selected notes. That's the only thing. And your interim financial report will focus on new activity, event, circumstances, and it will not try to duplicate the information which is already given. So it will try to focus on new things. Plus, any significant changes happened from the previous year end that are to be covered. It shall include explanation of event and transaction that are significant, explanation of events and transactions that are significant to understand the change in financial position and performance since the last annual reporting period. So from the last annual reporting period, now if anything significant has happened and which is basically affecting financial position or financial performance, balance sheet as well as P&L, uska details are also to be given. Now, following our list of transactions or event which will be basically disclosed if they are significant. Now, this list is same as the list which was given under Ind AS 1. If you remember under Ind AS 1, that given list, वो material items वहाँ पे था, उसके related, तो same list is basically given over here. Fine. Now, other disclosures, which are the disclosures which will be required under your interim financial reporting? So pay attention. So information shall normally be reported on year-to-date basis. Okay, now suppose the quarter ends in September. It's July, August, September. So quarter is 3 months. Year-to-date is April to September, 6 months. Fine. And following items are to be given in notes of interim financial statement mandatorily. Either you give it in notes of interim financial statement, or if they are there in any other statement which is presented with interim financial, uska reference de do. Suppose it is there in BOD report, or suppose it is there in management discussion analysis report, to give a reference of it. Okay. 1. They have followed the same accounting policies that they need to write. Explanatory comment about the seasonability or cyclability of the interim operation. Anything which is unusual. Okay. Any change in estimates which are there. New shares issued or debentures issued or redeemed kind of. The dividends paid. Some segment information. Any event which occurred after the interim period but before the financials are approved. So that, sir, that Ind AS 10 event after reporting date. Question. Whether event after reporting date also applies to interim financial reporting? Whether event after reporting date also applies to interim financial reporting? The quarter got over in June and the financials of that quarter are approved by, say for example, 20th July. So from June end to 20th July, if any significant thing happened, do I need to consider adjusting, non-adjusting? Answer is yes. Okay. Any change in composition of entity during the interim period, new subsidiary acquired or subsidiary sold off, any business combination kind of that. For financial instrument, the disclosure about the fair value as per Ind AS 113. Acha, if you become a investment entity or you cease to be investment entity, uske related disclosure, and some revenue related disclosures which are required. Okay, so these are mandatory disclosure. This was fine. Next point, this is important. Period for which the interim financial statements are prepared. Okay, so now suppose imagine you are preparing for Q2, July, August, September. You are preparing for Q2, July, August, September, balance sheet as at September end, 30th September. Acha, corresponding is not previous year September, corresponding is last year end. Acha, so we have September and corresponding will not be previous September, corresponding denge 31st March wala. So 30th September 24 and March 24 will be given. The balance sheet, current interim period, and a comparative as at end of immediate preceding financial year. It's not preceding the same 30th September last year. No. It is 31st March of last year. Okay, SOPL, current interim period. Same way comparative. I'll give. So Q2 this year, Q2 last year, plus year to date. Year to date also needs to be given. So April to September this year, April to September last year also. So current interim period and cumulative year to date with comparative. So Q2 plus April to September, that is year to date with both the comparative similar. Statement of changes in equity only year to date required current year to date required previous year. Cash flow also year to date required current year to date required previous year. Did you understand? April to September. And one more thing, if at all your business is cyclical, if your business is highly seasonal, cyclical, then you are required to give 12 months period ended on this date. Acha, 12 months period ended on this date. So our period is ending in September. To give 12 months ended on September, that is 1st October to 30th September. This year also 1st October to 30th September, previous year also. And that is required only for P&L and cash flow. That is required only for P&L and cash flow. So pay attention. Suppose you are having an interim period, it's basically quarterly, July, August, September. So balance sheet में September end, previous September end नहीं, previous it will be March end, important. अच्छा, P&L में July to September plus year to date, April to September, ये July to September, then year to date, April to September, ये April to September, and comparative same, July to September last year, April to September last year. If highly seasonal business is there, then 1st October to 30th September this year with the corresponding. Statement of changes in equity only year to date required. Year to date is April to September this year, April to September last year. Cash flow also only year to date, April to September this year, April to September last year. And highly seasonal business may you are required to give 12 months ended on 30th September current year, previous year. Achha, now suppose your interim period which you are presenting, it's not quarterly, half yearly. Achha. If financials are prepared half yearly only. Achha, if financials are prepared half yearly and half year is ending in September. Half year is ending in September, so we have to give for that half year. Year to date is also April to September only. Achha, so when it was quarterly, period was July, August, September, and year to date was April to September. But when you are preparing only half yearly, it's not quarterly, it's half yearly prepared. So it's April to September is the period and year to date is also April to September. Clear? Next. Okay. Now, for interim financial information, the materiality should be judged based on interim data. So don't try to judge the materiality based on annual figures. You try to judge the materiality based on interim period financial data. Okay. Now, accounting policies, you're required to follow the same policies what you had followed earlier. That is fine. This point is important. Measurement. The measurement for interim financial reporting should be on year-to-date basis. Measurement should be on which basis? Year-to-date basis. That way the measurement should happen. So don't try to measure the provision required in current quarter. ऐसा मत सोचो. So don't think about July, August, September. Think from April to September. So don't think from July, August, September angle. Think from April to September. Measurement is from year to date basis. We have a question on it. I'll come to it. Fine. And while recognizing the assets, liability, income, expenditure, we need to follow the principles of the relevant Ind AS. Like if you are basically recognizing a PPE, so you need to follow the principles of recognition given under Ind AS 16. Fine, that all is fine. Achha, revenues are cyclical. If revenues are cyclical, can I spread it? Answer is no. Book it in the period in which they occur. So when they occur, you can do that. Don't split it. Achha, cost incurred unevenly. If cost is incurred unevenly, some quarter more, some quarter less, keep it there only. Keep it there only. So don't try to apportion or equalize unless that apportioning or equalizing is allowed in your annual financials also. Okay, so for example, I paid maintenance for the whole year, which is January to December. Okay, so suppose January to December you paid maintenance. So now the thing is 3 months will come in this year, 9 months will come in next year. You can show it as prepaid expenses. So wahan pe that carry forward is allowed as prepaid expense in annual. So such things can also be apportioned over here in interim financials also. Achha, otherwise no. Achha, estimates, see generally your interim financial needs more of estimate. Reason, annual may what happens is you may take the help of actuary. I cannot take the help of actuary on quarterly basis. It will be very costly. So more estimates are used. Try to use the best estimates. It may sometimes not be possible for you to engage the experts for interim period. Okay. Now this question is given to you. There's a 2 lakh loss on disposal of business that happened in July. Keep it in July. Plus you paid some 60,000 property tax, which is for calendar year 16. You paid 60,000 property tax for the calendar year 16 from 1st January to 31st December 16, and we have a 6 months period ended in September. Okay, we have an interim period, 6 months ended in September, the April to September. Now, the tax which is paid is from January to December, so January, February, March. So outstanding of previous period is paid now. January, February, March, outstanding of previous period paid now. April to September related to this year paid now. October, November, December, it's shown as prepaid. October, November, December will be shown as prepaid. So 15,000 related to January to March, it's payment of outstanding. 30,000 related to April to September, that is for the current year, fine. And another 15, October, November, December, that will be reported as prepaid. Okay, question number 4, they are telling there's a bad debt coming during the quarter, keep it in that quarter. Sales promotion incurred, keep it in that quarter, can't apportion. Okay, there is some change in estimate happening, because of that some extra expense comes, keep it in that quarter. Extraordinary loss, keep it in that quarter. So check out, they wanted to apportion, not correct, not correct. यहाँ पे they want to keep it in same quarter, it's correct. The additional depreciation in the same quarter is correct. Extraordinary loss, they want to keep it in same quarter is correct. They want to keep it in same quarter is correct. Okay, question number 5. Question number 5. Okay, we are having over here quarter wise data given Q1, Q2, Q3, Q4. Now in see Q3 may we have the highest basically sales. Even though we have a sales highest in Q3, don't mean that the expense should also be split in that way. No. Now Q1 ka data is given. In your Q1 sales is 80 crores, salary is 60, advertisement, this is fine. Now Sincere Limited wants to defer 10 crore expenditure to third quarter. So we want to defer some 10 crore expenditure to third quarter. No, not allowed. Keep it in Q1 only. Is it clear? Okay, July 21 exam question. July 21 exam question, pay attention. There's a fixed production overhead. Fixed production overhead is 10,000 and normal production is 2,000. So can I say fixed production overhead are absorbed normally on the basis of the normal production or normal capacity. So it is 10,000 divided by 2,000, it comes at 5. It comes as 5. But if at all you're doing a lesser production, what will happen? If you're doing a lesser production, so there will be some unabsorbed thing coming up which will go in your P&L. But if you do more production, so imagine your production coming not 2,000, it coming more than 2,000, then actual fixed production overhead. So imagine your actual KM is 2,500. It's not 2,000, it's 2,500. So your fixed production overhead is 4 rupee only. So the fixed production overhead should be absorbed. Fixed production overhead, how do I absorb it? The total fixed production overhead divided by normal capacity or actual capacity, whichever is higher. In dono mein se whichever is higher. So normal 2,000, actual 2,500. So take 2,500. So 10,000 divided by 2,500. Achha, normal 2,000, actual 1,500. Then take 2,000. So fixed production overhead amount divided by normal capacity or actual capacity, whichever is higher, that way it is to be allocated. Fine. Now, there are no quarterly or seasonal variation. Normal expected production for each quarter is 500 metric ton and fixed production overhead for each quarter is 2,500. Achha, 10,000, 4 quarters, 2,500, 2,500, 2,500, 2,500. Actual productions are given. First quarter, second, third, fourth. Calculate the allocation of fixed production overhead. Now see, measurement should be done on year-to-date basis. We had seen that line, so pay attention. Fixed production overhead, how do we allocate? That's fixed production overhead divided by normal capacity or actual capacity, whichever is higher. So it is coming 5 per unit. It's 5 per unit. Actual is not given, ignore it. Now, first quarter we produced 400. So 400 into 5, this is absorbed. Oh, 400 into 5, absorbed is 2,000. Actual was 2,500. The extra 500 will go in P&L. The unabsorbed will go in P&L. Now, quarter 2 may don't do this way. Quarter 2 may don't do basically 2,500 is quarter 2 ka expense. Normal is 500. Actual is 600. Whichever is higher. Nahi. Measurement should be on year-to-date basis. So Q1 plus Q2 total fixed production overhead 5,000. 2,500, 2,500. divided by normal capacity is 1000, 500. Actual is 400 plus 600. Actual is 400 plus 600 is also 1000. The normal 1000, actual 1000, whichever is higher, I take 1000 only. So it comes 5 per unit. And now see, we already have 1000 units in Q1 plus Q2. So absorbed will be 1000 into 5, unabsorbed will be nil. But Q1 may we already had put 500 in P&L, which will get reversed. In 500 rupees, we had basically put it in Q1 as unabsorbed, which will get reversed. So now you come to Q3. Don't see that production overhead for Q3 is 2500 divided by normal capacity 2500, 500 units. Actual was also 500. No, don't do that way. Year to date basis. So year to date Q1, Q2, Q3, this is the total fixed production overhead divided by total normal production, actual production, whichever is higher. So it is coming 1500 only, whichever is higher is also 1500. So 5 rupee per unit is coming. 1500 into 5, absorbed is 7500, unabsorbed is actually nil. Now coming to the last quarter. In last quarter, Q1, Q2, Q3, Q4 all together, total production overhead, fixed production overhead is 10,000 divided by normal capacity 2000, actual 400, 600, 500, 400, actual is 1900. So 2000 or 1900, whichever is higher, becomes 2000. So 10,000 divided by 2000, it's 5 per unit. Okay, now 1900 into 5 is absorbed and extra 500 rupees. 100 into 5, that will remain unabsorbed. So this is how accounting will be happening. One which is absorbed will be going in your inventory, Q1 May, Q2, Q3, Q4. This way. Acha, 500 we had taken in Q1, it gets reversed as unabsorbed in Q2. And same way, yahan pe unabsorbed 500 comes in. I hope this is clear. Any doubts? Anybody with this question? Okay, next one, we have TDS on salary. Okay, so whenever I'm deducting TDS, should I consider the quarterly income of employee? No. It should be done considering the annual salary and not just the interim salary. So whatever salary is going to get throughout the year, uspe what tax will be applicable? The total tax, whatever is coming for the annual salary divided by 12, that way you need to take it. So it should be based on annual effective payroll tax, estimated average annual effective payroll tax, that's the word to be written. Achha, major maintenance coming up in any quarter, keep it in that quarter. Don't spread it unless it's allowed to be spread in your normal financials also. Year-end bonuses. Now normally we give bonus at year-end. Achha, if there's a legal or a constructive obligation, you have to pay that bonus and a reliable estimate can be made. Imagine every year 2% of net profit I give bonus. Every year since many years. So can I say it is past practice, it's a constructive obligation. So whatever you earned in this quarter also, uska 2% create a provision for bonus. So if there's a legal or a constructive obligation and a reliable estimate can be made, then you can book it in quarter also. Quarterly profit ka 2% make provision for bonus. ठीक है. Question number 7, RTP May 22, employer contribution to government sponsored insurance fund, which are assessed on annual basis. Q1, Q2 may larger amount payment are done, Q3 may minor payment are done. But see, it's assessed on annual basis, so you should also book it based on annual basis, that is equally. Or basically it is equal. It's not Q1, Q2 may more, keep it more, nahi, yahan pe nahi. So check out over here. It should be evenly booked in all quarter. Going to question 2, you intend to do a major repair in some quarter, keep it in that quarter. Third, you have a practice of declaring bonus 10% every year. Okay, so simple. Whatever is quarterly profit, uska bhi 10% make a provision for bonus. Okay, next is measuring interim income tax. This point important. Measuring interim income tax. How do I measure the interim income tax? It should be based on estimated average annual effective tax rate. It should be based on estimated average annual effective tax rate. So whatever is Q1's income into which tax rate to be taken? Not 30%. Aisa nahi. See, we have slabs many times. So do one thing. Estimate your annual income. You try to estimate the annual income. Based on that, what will be the tax coming? So suppose my annual income estimated suppose is 10 lakh. Now slab wise there. So what is the total tax coming now? Total tax divided by 10 lakh. So now what is that percentage coming? The estimated average annual effective tax rate will be calculated whenever there's a slab wise tax or there's some brought forward loss on which you don't have to pay tax. So that way you calculate the estimated average annual effective tax rate, and now quarterly income into that tax rate needs to be taken. Sometimes like suppose we have a normal income tax separately, capital gain tax separately. To do one thing, that estimated annual effective tax rate you calculate only for the normal income, and now in a quarter for normal income apply that rate, for capital gain apply the rate of capital gain. Okay. Now suppose your accounting year and your tax years are not same. So suppose accounting is done, suppose practically very rare, but suppose accounting is done Jan to December and tax may you're following April to March. Now last year tax rate was different, this year tax rate was different. So we are following in accounts Jan to December, the January, February, March, whatever was last year's tax rate that you take. April to December, whatever is this year's tax rate that you take. So apply the effective tax rate for each interim period to the pre-tax result for that period. For Q1, tax wise it was in last year, so apply that effective annual tax rate of last year. Q2, Q3, Q4, April to December. Tax wise they are in current year, apply the effective annual tax rate of current year. Okay? Okay, moving ahead, question number 9, check out. Now, you earn 1,50,000 pre-tax profit in first quarter, expecting to incur 150 loss in each of the 3 quarters. The first quarter mein 150 profit, second, third, fourth mein 50, 50, 50 loss. Okay, 150 profit and then 50, 50, 50 loss. Effectively will be nil. But question mein they've already given you annual effective tax rate. The annual average effective tax rate is given 30%. So don't calculate. We need to calculate only when there are slabs or when there is a brought forward loss. So don't calculate over here. So now it's already given to you. Q1 may 150 profit into 30%. That much provision for tax. Q2 may negative 50 into 30%. That much will reverse. Q3 may again negative 50 into 30%. This way you need to do it. Okay, question number 10. Iske andar we have a capital gain. Okay, so now check out over here. Annual income we are estimating 33, which will include a capital gain 8. Can I say normal 25? On your normal 25, there's a slab. First 5 lakh, 30%, then 40%. So I'm finding annual effective tax for normal income. The normal income 25, on that the tax is coming 950. The average annual effective tax rate is 38%. Okay, so now in your Q1, we have only the normal income to into 38%. In Q2, only normal income into 38%. In Q3, for normal income 38%, for capital gain 12%. Clear? Okay, question number 11. There's a brought forward loss 600 lakh. As there's a brought forward loss 600 lakh and we are going to earn 900, 900, 900, 900 each quarter. We are earning 3600 but we'll pay tax only on 3000. So 3000 pay we need to pay tax. 3000 pay we need to pay tax. So pay attention over here. Even though we are earning 3600, we are paying tax only on 3000. 3000 ka 40%, 1200 I'll pay. So on 3600 I'm paying 1200. Annual effective tax rate is coming 33.33%. First quarter whatever you earn into 33.33. Second quarter whatever you earn into 33.33. That way you need to do it. Okay, next question, question number 12. Next question, question number 12. Accounting year ends in December. Tax mein it is March wala thing. So now accounting year ends in December. So January to December. So January, February, March, tax wise it's fall in last year. Tax wise it falls in last year, and estimated effective tax rate last year ka 25, current year ka 30. So for Jan, Feb, March quarter apply 25. Then for April to December you apply 30%. Did you understood? That effective tax rate, annual average effective tax rate is to be found out only when there are slabs or there is a brought forward loss. Done. Okay. Now inventory we are required to have cost or NRV whichever is lower. So interim period end also. Interim period end also we need to measure at cost or NRV at that interim period. Fine. Foreign items. If I have a foreign currency, my debtors, creditors, I bring it to the closing rate. The closing rate at the end of the quarter will be considered for interim financial reporting. impairment. Fine, this is your Ind AS 34. Now moving to Ind AS 7. Any doubts? Ind AS 34? Any doubts? Ind AS 34? Thank you. Please pay proper attention. You have any doubts, stop me at the same time. Now going to Ind AS 7, which is on cash flow statement. Now we know that balance sheet, P&L are based on accrual concept. They do not basically show the cash position. Now what happens is, if I see a profit and then I go and buy a car, but car ke liye actual down payment required, I cannot take decisions based on that. So that's why cash flow is required. Now, so what's the difference between a cash flow statement and a cash and bank account? Cash flow statement is a summary statement. Cash and bank account is transaction wise. Cash flow statement is bifurcated in three parts: operating, investing, financing. Your normal cash and bank account is not such bifurcated. So cash flow statement is a statement which provides the detail about how the cash is generated by entity during a particular reporting period and how it is applied. Okay. Benefits are okay, not relevant. Now, under your cash flow statement, it shows how cash and cash equivalent. So we have what was the cash and cash equivalent at beginning of the year, then what is the cash, basically cash flow during the year, and then closing cash and cash equivalent. So we understand the definition of the word cash and the definition of the word cash equivalent. Okay, cash is nothing but cash on hand, demand deposit with bank. If I have a demand deposit with bank which we can get back whenever we want, that's demand deposit with bank. That's a part of cash. Cash equivalent, they are short-term highly liquid investment. Short-term highly liquid investment. Short-term is 3 months from the date of acquisition. You acquired, it will be disposed of within 3 months only, or it will be redeemed kind of within 3 months only. Short-term highly liquid investment that can be readily convertible into known amount of cash and which has an insignificant risk of change in value. Okay. Now moving ahead, whether bank overdraft and cash credit, they will be a part of cash and cash equivalent, or would they come under financing activity, borrowings? Okay, so pay attention. Cash credit is always negative. Bank OD is linked to your normal account, sometimes positive, sometimes negative. Cash credit always coming under financing. Bank overdraft. If bank overdraft is an integral part of your cash management program. If bank overdraft, which is linked to your current account, which are repayable on demand, they form an integral part of your cash management program, then in that case they will be included under cash and cash equivalent. But if they are not an integral part of your cash management program, then in that case they will come under financing activity. Fine. Question number 5, we are required to tell what will come under cash and cash equivalent. FD, nothing given. FDs are non-cancelable. They are non-cancelable. So I cannot demand whenever I want. Nothing given, assumed to be non-cancelable. And they are not basically your investments. They are not short-term, highly liquid investment. No. So FD with SBI for 3 years, not cash equivalent. FD with HDFC for 2 years, not cash equivalent. Okay, I bought a redeemable preference share, which are as such to be redeemed within 3 months only. I bought it, they will be redeemed within 3 months. It's a cash and cash equivalent. Cash balance, whatever you are having, it's cash equivalent. Cash, whether with you, other bank, wherever you are. Bank overdraft. Overdraft may, if it is a part of your cash management program, then it will be a cash and cash equivalent. Treasury bills, 90 days maturity. Treasury bills are kind of government bond. They are cash and cash equivalents. Now, your cash flow statement is bifurcated in 3 parts: cash flow from operating, cash flow from investing, cash flow from financing. What comes under operating? Operating activities are principal revenue producing activity, and anything which doesn't come in investing financing. Something which doesn't come in investing financing will be coming here. Acha, if nothing is given, your tax. If they just say that tax paid, so nothing given, tax paid is assumed to be related to your business, it comes under operating activity. But if they say capital gain tax paid, we sold a building, we sold a land, uspe capital gain tax paid, it will come under your investing activity. Nothing given, tax and uska refund both comes under operating. Okay. Now this point is good. You built a property to give it on rent. You construct a property to give it on rent, then construction of property will be operating, and rent received on it will also be operating. So here it's assumed your main business is renting. You're constructing property to be given on rent, so construction of that property operating, rental income will also be operating. Moving ahead, investing activity. Investing activity relate to acquisition, disposal of your long-term assets and investments, which are not covered under cash and cash equivalent. Something is under cash and cash equivalent, it doesn't come here. Remember short-term, highly liquid investment? They come under cash and cash equivalent, they will not come over here. Okay, the purchase, sale of fixed asset, purchase, sale of investments and income from investment. Income from investment will also be coming over here. Did you understood? Achha, if I give a loan to someone, for purpose of earning interest income, that also is coming here. Loans given and uske upar ka interest income. Loan taken nahi, loans given. Investment done, investment income, dividend received, rent received. Rent may be, if main business is renting, it will not come over here. Main business is not renting, then it will come over here. Fine. Now this point is important. Okay, when a contract is accounted for a hedge, I had some payments in foreign currency, I entered into a forward contract. And option, yeah, something is there. So how do I account for that hedge? Usme some payments are done. So that is accounted in the same way to the original contract or original item to which it relates. If at all the forward contract is done for purchase of goods, so can I say purchase of good comes in operating? So uske related this forward contract ka things, they also come in operating. But a forward contract was done for purchase of PPE. I imported a machine, uska payment tha. Acha, so if forward contract was done for purchase of a PPE, PPE comes in investing, any payment related to that forward contract will also come under your investing. So if a contract is entered, is accounted for a hedge, the cash flow from the contract are classified in the same manner as the cash flow of the position being hedged. If it relates to goods, it will come in operating. If it relates to PPE, the forward contract, then it comes in investing. If it relates to loan we had taken in foreign currency, uska hedge hai, then it will come in financing. Clear with this? Okay, financing activity cover what? They basically cover your cash flow due to change in size and composition of your equity and your borrowing. Means you issue new shares, you buy back the shares, you issue debentures, you redeem debentures, you take a loan, you repay the loan, plus on that loan debentures you pay interest. On equity shares, preference shares, you pay dividend. The interest dividend paid will also come here. The interest dividend received is investing, interest dividend paid is financing. Okay, moving ahead. Okay, check question number 8. Payment for purchase or construction of a building for the purpose of letting out. Building purchase for the purpose of letting out, operating. So construction wala operating, rental income also operating. It is always assumed your main business is renting then. Moving ahead, question number 10. Okay, you purchase a fixed asset in foreign currency. Now I have to pay in foreign currency. I entered into a forward contract and usme I paid some premium 5,000 rupee. How to account for this? Okay, so can I say that the forward contract was for the fixed asset ka payment? Okay, so then that forward contract will be accounted in the same manner as your PPE. So PPE comes under investing. This will also come under investing. Now, for operating activity, for your operating activity, there are two methods. How do I find out cash flow from operating activity? Direct method, indirect method. Now, under direct method, it's very simple. All cash inflows are added, outflows are deducted, non-cash items are ignored. And all cash inflows, outflows related to operating activity are considered. Inflows added, outflows deducted, non-cash items ignored. This is your direct method. Now, sir, which method we need to follow? You can follow as such any of it. So your Ind AS 7 doesn't tell you follow indirect. No, you can follow any of it, and they encourage you to go for direct method. They encourage, not mandatory. Depending on information given in question, will decide which method to use. Okay. Now, this question number 12. I'm taking all important questions. Operating activity using direct method, it is there. ठीक है. Sales, I don't want sales, I want collection from debtor. Then they're given cost of sales, I don't want cost of sales, I want payment to creditor. Acha, so first of all, pay attention over here. How do I get collection from debtor, payment to creditor? I need to prepare debtor creditor account. Now debtor creditor, if you check out, opening balances, closing balance is given, opening closing given, opening closing given, opening closing is given to you. Acha, sales you already have it, assume to be credit sales only. Acha, यहाँ पे you have a cost of sales, COGS है. From the COGS formula, opening stock, closing stock available, you can find purchases. COGS is there, opening stock, closing stock available, you can find purchase. Assume all purchases are credit purchase. So now you put it in creditor. So from debtors, you get collection from debtor, from creditors, you get payment to creditors. That both is there. Fine. Interest income does not come under operating. Interest income is your investing. Leave it. Fire insurance claim received, assumed to be related to goods. It will be coming in operating, but I'll show it separately as exceptional item. Depreciation, non-cash, ignore it. Admin selling comes in operating. But if you just check out, any expense payable is there, outstanding? No. So directly I can take it 1540. Interest expense comes under financing, leave it. Foreign exchange loss. Now question would have said the foreign exchange loss is nothing but increase in borrowing due to rate fluctuation. We brought it to a closing rate. It's a non-cash item, ignore it. And then we have a profit before tax, extraordinary item, tax. Now see, this is the tax debited to P&L. How much is tax paid? Prepare a provision for tax account. We have opening, we have closing, provision for tax, opening, closing. Tax debited to P&L, the entry will be P&L to provision for tax, and balancing in provision for tax is the tax paid. That tax paid will be taken. So collection from debtor account, payment to creditor from creditor's account. Admin expense, this is income tax paid based on that provision for tax account, and this fire insurance claim, I'm showing it separately, exceptional item. Moving ahead, indirect method. Okay, now pay attention. Under indirect method, we try to find out cash flow from operating activity with the help of profit. We've tried to find out cash flow from operating activity with the help of our profit. Now we know profit is not the operating cash flow because profit is based on accrual concept. There are other items, dividend income or interest income, interest paid, or other activity. They also come over there. So we know that the profit is not our operating cash flow. We need to adjust it. So we make adjustment for non-cash item relating to other activity which are there in P&L. So P&L mein there's a non-cash item, or in P&L there's item relating to other activity that you adjust. We're starting with profit, we'll start with PAT, profit after tax. And then we'll adjust it for non-cash item relating to other activity. Now we are getting cash flow from operating activity before working capital changes. Now we'll make the working capital changes. For working capital changes, there's an inverse relationship between current asset and cash. There's a direct relationship between current liability and cash. And now we are getting cash flow from operating activity before tax. We deduct the tax paid. Now we get cash flow from operating activity before exceptional item. We deduct exceptional item, and then we have a net cash flow from operating activity. Now see, normally I told you we'll start with profit after tax. But now what happens is when you are given the P&L figure in balance sheet, opening P&L, closing P&L, that's your profit carried to balance sheet after all appropriation. That's your profit carried to balance sheet after all appropriations. How do I find profit after tax? Add back all your appropriation. So you add back dividend, you add back transfer to reserve. The difference between the P&L figure given is profit carried to balance sheet. Add back the appropriation, you get profit after tax. Okay. Now profit after tax, whatever tax is debited in P&L will be added back. Actual tax paid will be deducted. Profit after tax, whatever tax is debited in P&L. So profit has gone down, operating cash flow उतना नहीं जाना चाहिए, paid वाला. So add back the provision for tax debited in P&L and deduct the actual tax paid. Okay, now direct method appears to be simple. Inflows added, outflows deducted, non-cash item ignored. But practically to follow direct method is very difficult. To find out collection from debtor, I need to go to each and every debtor account and find out how much cash came. So as such, it looks simple, but practically it is difficult. Acha, for direct method, we need cash sales, collection from debtor, cash purchase, payment to creditor, admin selling expense, etc. Okay, for indirect method, what do we need? We need profit. We need profit, we need details about non-cash item, we need details about item relating to other activity, we need details about working capital changes. That all is required under your indirect method. So depending on information given, we decide which method to use. Now under indirect method, bad debt, provision for bad debt, discount allowed, discount received. Now see, discount allowed, what is the entry? Discount allowed to debtor, and the discount allowed would have gone in P&L. The profit has gone down, operating cash flow should not go down, we add non-cash item, right? Discount allowed has gone in P&L, profit gone down, operating cash flow should not go down, it's a non-cash item we add. But bad debt, provision for bad debt, discount allowed, discount received, don't consider them as non-cash item. Don't adjust it in profit because their effect will automatically come under working capital changes. So when I'm taking increase, decrease in debtor, so because of bad debt, the debtor would have gone down, its effect automatically would come over there. Don't treat it as non-cash item separately. Okay. Now question number 21, we are required to solve by direct and indirect method both. Now see, here the data is given in such a way you are able to solve it as per both. You have a P&L, you have a balance sheet. Now I told you I don't need sales, I need collection from debtor. I'll prepare a debtor account. I don't need COGS, I need payment to creditor. So from COGS, we have opening closing inventory available, I'll find purchases. And from your creditors account, I'll find payment to creditors. Admin will come under operating, depreciation is non-cash, this is not coming, this is not coming. Direct method mein. And this is a tax debited to P&L, that is basically not required. For direct method, directly deduct the actual tax paid. For indirect method, I'm starting with PAT. For indirect method, if I'm starting with PAT, add back the tax debited to P&L, deduct the actual tax paid. Is it clear? Okay. Now, if you just check out the question over here, provision for tax is not there in question. If provision for tax is not there, we assume whatever provision is created, that is paid off. So, tax debited to P&L and tax paid, both are same. Tax debited to P&L and tax paid, both are same. Okay. So, from debtor, we got collection from debtor. From creditor, we got payment to creditor. Other things were fine over here. And indirect method, under indirect method, we started with PAT. Now add back the tax debited to P&L, deduct actual. Now both are 30-30, that's why ignored. Both are 30-30, that's why ignored. Non-cash items, items relating to other activity which are debited in P&L, you add back. The depreciation, non-cash item. Loss on sale of asset. Now see, sale of asset is investing. So whatever you received on sale of asset is already there in investing. Other activity should not be affected. But loss on sale of asset, debited to P&L, profit went down, operating cash flow should not go down. That's why I added. Interest paid is financing activity. So now we get cash flow from operating activity before working capital changes. These are all your working capital changes. Actual tax paid, sir, why you are not considered? So I have to add back the tax debited to P&L, wo 30 and then deduct 30. So either you add 30, deduct 30 or you ignore. Okay, this is for operating activity. You are having direct as well as indirect method. For investing financing, there are no such methods. For investing financing, there are no such method, but our investing financing activity will be sold, they will be solved in a manner like it's a direct method. So items relating to investing and financing activity, inflows are added, outflows are deducted, non-cash items will be ignored. Achha, so non-cash items which have gone in P&L, they are adjusted under indirect method. Non-cash items which have gone in P&L, they are adjusted under indirect method while finding operating activity. Non-cash items which have not gone in P&L, they will not come under indirect method also. Next. Reporting cash flow on net basis. Can I show my cash flow on net basis? One land sold, another land purchased. So one land sold for 3 crore, another land is purchased for 5 crore. So can I show net? No. You have to show both. So purchase of land separately, sale of land separately. It should be on gross basis, not net basis. So sir, when I can show on net basis? When I can show on net basis, exceptions are given. One, when the cash flow reflects the activities of customer. So imagine I have an account in Zerodha for doing purchase, sale of shares. I deposited money in Zerodha, I withdraw money from Zerodha. So wahan pe what happens is they are transactions of customer. So wahan pe they can show it net. Achha, cash receipt and payment for item for which turnover is quick, amounts are large, maturities are short. wherever you have a spare fund, you do a investment very short term के लिए in government securities or money market mutual fund. तो you did investment for 2 days, again you sold, again you did investment for 2-3 days, you sold. तो वहाँ पे you may do it on net basis. And this is basically for a financial institution. For a financial institution, they may show on net basis acceptance, repayment of deposit, placement of deposit, withdrawal of deposit, cash advances and loans made to customer, and repayment by customers. But this is only for financial. Okay, moving ahead. This point is important. Foreign currency cash flow important. Okay, I had a debtor in foreign currency, now I'm getting money. I had a debtor in foreign currency, now I'm getting money, I get $1 lakh. Then cash flow, how it will come? It will be coming at the rate prevalent on the date of transaction. So cash flow from foreign currency shall be recorded in entity's functional currency, applying the exchange rate on the date of cash flow. Applying the exchange rate on the date of cash flow. Now, unrealized gains and losses, you know, debtors, you bring it to closing rate. Creditors, you bring it to closing rate. Now, whenever I'm bringing something, debtors, creditors, foreign currency loan, I bring it to closing rate. So they are unrealized thing. So direct method mein as they're unrealized, ignore it. Direct method mein as they're unrealized, ignore it. Indirect method. Indirect method mein what do we do? Indirect method mein that unrealized thing, unrealized gains and losses, it has gone in P&L. It has gone in P&L, but it's a non-cash item. वो unrealized loss है या unrealized gain है. So it has gone in P&L, but it's a non-cash item. We are required to do adjustment. So unrealized loss debited to P&L, profit has gone down, operating cash flow should not go down, we'll add. But the direct method, unrealized gain loss, ignore it. Direct method में, indirect method में, they have gone in P&L, profit has gone up or down, operating cash flow should not go up and down, we need to adjust. But if it is related to debtor creditor, debtor you brought to closing rate, creditor you brought to closing rate, then uska unrealized gain loss automatically gets adjusted while doing working capital changes. So under indirect method, the exchange difference that arise basically in balance sheet for monetary item that form part of operating activity. Okay, monetary item that form part of operating activity, debtors, creditors, that will not require any adjustment. उसका कोई adjustment नहीं होगा because it will automatically get adjusted when we are doing increase decrease in debtors creditors. अच्छा, तो foreign currency loan we brought to closing rate, unrealized gain loss is there in P&L, we need to adjust. तो PAT में adjust करना पड़ेगा. But foreign currency debtor converted to closing rate, uska unrealized gain loss is there in P&L, don't make any adjustment in PAT, automatically it will get reflected in increase decrease in debtors creditors. Clear? Okay. Now, there is some cash and cash equivalent held in foreign currency. I have some cash and cash equivalent held in foreign currency. So, I have some $100 in my pocket. Now, dollar ka rate was 80, now it becomes 85. So, can I say that $100 was worth 8,000? Now that $100 is worth 8,500 rupee. So, we have a cash equivalent, cash and cash equivalent which is in foreign currency. So now sir उसमें क्या करेंगे? So that $100 was 8,000, now it became 8,500. So that 500 rupee gain, कहाँ पे आएगा? It will not come in operating, investing, financing. It will be coming in reconciliation. So cash and cash equivalent held in foreign currency, उसका related gain loss. Uska related gain loss will not come in operating, investing, financing. It will come in a reconciliation below. And pay attention. But while preparing your balance sheet P&L, 8,000 became 8,500. That 500 gain was taken in P&L. So actually, while preparing P&L, it's taken in P&L. The profit has gone up. Operating cash flow should not go up. So deduct from operating cash flow. Consider it in reconciliation table below. So see यहाँ पे deducted from your profit and considered in this reconciliation table below. यहाँ पे एक reconciliation table होगा, ये 4,500 आया, उसके साथ ये reconciliation, it becomes 4,600. Did you understood? हाँ, तो P&L में 8,000 became 8,500, $100 था ना, वो 500 profit has gone in P&L. but while preparing cash flow, that 500 will not come in operating. So it has gone in P&L, profit went up, operating cash flow should not go up, deduct. So it will come where? It will come in a reconciliation. So यहाँ पे ये 4500 आ गया and बाद में it is shown separately in reconciliation. Clear? Okay, question number 16 is similar. Check out over here. We have a deposit in a bank of USA. It was $1 lakh, now it became $1,02,000. The extra $2,000 is the interest income which we have received. Acha, that interest income $2,000 into closing rate, that has gone in P&L. And now that 45 became 50. So that $1 lakh was at 45, now it became 50. So that 1 lakh into 5, that 5 lakh has also gone in P&L. So in your P&L, so P&L was credited by rupees 1 lakh towards interest income. It was credited by 5 lakh rupee for exchange difference. 5 lakh rupee kiska tha? Exchange difference. Now what is happening? Exchange difference 5 lakh, and this is for cash and cash equivalent held in foreign currency. It will not come in operating activity. Now it has gone in P&L, profit went up, operating cash flow should not go up, deduct. So deduct 5 lakh from operating cash flow, add it in reconciliation table separately. So you deduct from net profit and add it in a reconciliation table at the end. And sir, interest income you will say that sir, interest income comes under investing. So that also you remove it from your operating activity. Profit mein hai, operating activity, it should not be there. Deduct and take it in investing activity. But pay attention, but if it is a interest income on cash equivalent, अच्छा, अगर आपका cash and cash equivalent पे interest income है, that will come in operating only. So here that interest income has gone in P&L. It is related to cash and cash equivalent. It should come in operating. तो P&L में है, profits have gone up, operating cash flow should go up, no adjustment. Interest income relating to items of cash and cash equivalent comes in operating activity. Did you understand? Okay, next you have interest and dividend. Interest paid, dividend paid is financing. Interest received, dividend received is investing for a normal enterprise. But for a finance company, interest paid is operating. Bank pays interest on the deposits taken. So interest paid is operating only. Then dividend paid is financing. Dividend paid is financing for everyone. Achha, interest received, dividend received. For bank, interest, dividend received will be operating. Interest received, they give loans. Dividend received, they make investments. Making investment is also routine for bank. So that's why for them it will be operating. Did you understand? Okay. Now just pay attention. See, for normal company here, interest paid, dividend paid is financing, interest received, dividend received is investing. Okay, we can't take it in operating. Operating में नहीं ले सकते. IAS 7 gives the option to either take it in operating or take it like this. तो वहाँ पे option है, we don't have that option. ठीक है. Now question number 17, a firm invests in 5-year bond, face value 10 lakh by paying rupees 5 lakh. Okay, so you paid 5 lakh and maturity pay you're going to get 10 lakh. The effective interest rate is coming out as 15%. Now effective interest rate say the income will be calculated. First it was 5 lakh, interest accrues 15%, we are not receiving. So now it becomes 575. Again interest accrues 15%, 86250, but we are not receiving. So interest accrues every year. It went in P&L. Interest accrues every year. It went in P&L. Profit has gone up. Operating cash flow should not go up. Deduct. If indirect method follow. Direct method है तो non-cash item ignore it. तो direct method में तो कुछ नहीं है ना. Cash flow में first year में 5 lakh outflow, 5th year में 10 lakh inflow. तो check out over here. Interest income will be over the period, but there is no cash flow associated. And on maturity we are getting 10 lakh, which will be investment activity. And on maturity when I'm getting 10 lakh, 5 lakh is towards principal, 5 lakh is towards interest. Both comes under investing, but bifurcated, but to be bifurcated. Taxes on income, nothing given. I told you it will come under your operating unless they specifically relate to investing or financing. Capital gain tax, investing. Tax on business profit, operating. Dividend distribution tax, now it's abolished. But if they say dividend distribution tax, it's on dividend which we are paying. Dividend paid financing, dividend distribution tax financing. Refund, nothing given operating. Okay, next. Okay, good concept. We did yesterday accounting for investment in associate and JV equity method. Under equity method, CFS mein, investment remains as investment, but we add our share of post-acquisition profits and losses we include, and opposite we take it in investment. Now see, our share of post-acquisition profit and losses we include in consolidated P&L, but we have not got cash. Cash nahi aaya, to cash flow mein how do I treat it? It's not received. Acha, so we have taken in P&L, profit went up, but we have not got cash. The operating cash flow should not go up, deduct. Did you understood? Then cash flow, only the amount received by way of dividend that will be coming. Okay, next, investment in subsidiary. You invested in subsidiary or change in ownership interest. Acha, change in ownership interest. We had, remember yesterday, change in proportion of NCI. Out of 70%, 10% sold. Earlier it was a subsidiary, now also it's a subsidiary. Acha, when you acquire a subsidiary, investing activity, outflow. When you sell a subsidiary, control gone. When you sell a subsidiary, control is gone. That is also investing. Acquisition of subsidiary, investing. Disposal of subsidiary, investing. As a change in proportion, out of 70%, 10% sold, that's not investing. That will come in financing. Okay, to check cash flow from obtaining or losing control is investing. But if at all, basically it's just from change in ownership interest, control is not gone, then it will come in financing. Acha, plus one more thing, whenever basically I'm acquiring a subsidiary, I paid money. But now in your CFS, nothing from CFS angle. In CFS, can I say assets and liabilities of subsidiary will come? Okay, so I paid 10 lakh rupee. Now uske assets and liabilities will come in my book, and one of the asset of subsidiary is cash 2 lakh. Okay, so now the thing is I paid 10, but uske assets liability coming, one of the item is cash 2 lakh. So net 10 gone, 2 comes, 8 lakh will be outflow under investing activity. Did you understood? 8 lakh will be the outflow under investing activity. The aggregate amount of cash paid or received will be reported net of cash and cash equivalent acquired, but this is only for CFS. Okay, now check this question. You acquired 70%. Oh, you acquired 70% acquisition of a subsidiary. It comes under investing activity. 15 lakh you paid cash. Shares given is basically a non-cash item. And on date of acquisition, they have a cash and cash equivalent 250. I'm paying 15. Unke assets liability come. One of their asset is 250 cash. So 15 minus 250, 1250 outflow under your investing. Achha, then you further acquire 10%. This is change in ownership interest. This will come in financing. Okay, next question, 20th. That's okay, not much relevant. Coming to 21st, very, very important. Coming to 21st question, very, very important. Okay. We have acquired a subsidiary during the year. And now the consolidated P&L is given. Consolidated NP is 5,000 and consolidated balance sheet is given, opening, closing. Fine. And we have acquired a subsidiary during the year. Okay. All the shares of B Limited were acquired for 74,000 cash. So when I say I would have paid 74 investing activity, but unke assets and liabilities would have came in. Achha, which are the assets and liabilities of subsidiary coming in? The fair value of assets and liabilities assumed they came is this. This all assets and liabilities came in. Usme there's a cash coming in 2,000. Okay, so I paid how much? 74. 2,000 comes back. Outflow under investing will be 72. So check out investing mein ye outflow ho gaya 72. Done. This is one. Now one more thing. Whenever you acquire a subsidiary, in that year, you need to take care while you are preparing cash flow. Check this note. So while preparing a consolidated cash flow for the year of acquisition, year where you acquire a subsidiary, we need basically the aggregate amount of cash received or paid net of cash and cash equivalent acquired will be coming in your investing activity plus we need to take care while we are considering increase decrease in assets and liability. Now pay attention. Under your working capital changes, think about this inventory. under your working capital changes, think about this inventory. Inventory 35 becoming 30. Inventory 35 becoming 30. So you will feel that, oh, inventory has gone down. Okay, inventory went down, cash goes up. Inverse relationship between current asset and cash. But no. Pay attention. Opening is 35, closing is 30, ठीक है? But closing is basically consolidated after that subsidiary was acquired. So don't do increase decrease like this. It was 35. It was 35 plus how much inventory came from S4? 35 tha plus 4 came. And for this all assets and liabilities, whatever I paid is already there in investing. For this all assets and liability, whatever I paid, net 72 is already there in investing. So 35 tha plus 4 came 39. 39 became 30. 39 became 30. So in the year of acquisition, you need to take care while we are seeing the increase decrease in assets and liability. So don't see 35 became 30. 35 tha plus 4 came from subsidiary. 39 has became 30. 9,000 is decrease in inventory. So check out your decrease in inventory 9,000. Decrease in inventory 9,000. Same way for all assets and liabilities, we need to take care. Did you understood this question? Did you understood this question? Question number 22, again an important one. Question 22, again an important one. Check out. Now, as such, it's a similar to last question, but there are few separate extra points also over here. A Limited spent 30 lakh on renovation of building and you charged off to P&L. Oh, it should have been capitalized. So we have taken in P&L, it should have been capitalized. तो क्या करेंगे? क्या करेंगे? We add it in P&L. P&L में से deduct किया था. It was shown as an expense. I remove the expense. Profit will go up. And PP में it will be added. Fine. So there is this. So check out the profit given is wrong. We need to rectify profit. Then with the rectified profit, prepare a cash flow. Okay. Same way over here. In your third point, I'll come back again to the second one. A Limited constructed a qualifying asset, incurred a construction cost 40 lakh. That has been charged to other expense. Oh, bhai, it's a qualifying asset. It should be, oh, construction cost you charge to other expense. Nahin, it should be capitalized. So that 40 rupee. And out of interest 110 charged to P&L, 10 lakh is interest which needs to be capitalized. Oh, so 40 ye capitalize karna hai, 10 interest to be capitalized. 40 ye, 10 interest. So can I say profit given is wrong? To rectify the profit. So check over here the rectified profit. 1840 was given. Add back what 30, then this 40, this 10, this is the correct profit. And now you can use this for cash flow purpose. Now going to second point. During the year you acquired a subsidiary. Oh, you acquired a subsidiary. You paid 300 lakh. Cash coming is 20. 300 I paid. Cash comes is 20. So can I say net 280 will be outflow under investing? And I need to take care whenever I'm doing increase decrease in assets and liability. Whenever I'm finding out increase decrease in assets and liability, I need to take care. Fine. Now the carrying amount of your PP opening this. Acha, addition including coming from S. Addition including coming from S. Now whatever comes from S, for that the payment is already there in investing, don't take it. Other than that, whatever basically I've acquired, that will come under investing. There's a revaluation done, it's a non-cash item, will not affect your cash flow. Okay, there's a disposal, there's a carrying amount of PPE sold. There's a carrying amount of PPE sold and profit on sale over here, it's coming. See, sale happened at 630 and carrying amount is 490. So 490 of PPE sold at 630, 630 will come under investing. And profit has gone in your P&L. Profit has gone in P&L. So P&L profit has gone up. Operating cash flow should not go up. वहाँ पे deduct करेंगे. Depreciation non-cash item added basically while finding operating cash flow. This is done. अच्छा, associate. Associate है. Share of profit coming from associate is 120 and a dividend we have got is 30. Share of profit has gone in P&L. Profit went up. Operating cash flow should not go up. I'll deduct. So this is to be deducted in operating activity. And I got 30 rupee. 30 rupee dividend received comes under investing. 30 rupee dividend received comes under investing. Now goodwill is impaired. Intangible assets are impaired. Impairment loss. Entry. Impairment loss debit. P&L में to goodwill. or impairment loss debit P&L में to basically intangible. So they are non-cash item, but it has gone to P&L, profit has gone down, operating cash flow should not go down, it will be added. We are required to calculate cash flow from operating activity. The profit on sale of PPE is deducted, depreciation added, non-cash items, impairment of goodwill, this all. And our share of profit, I told you, we have not received cash, for 120 deduct. We have received how much rupees? 30 rupee, that comes under investing activity. So this is again a good question. Non-cash item, non-cash items which have gone in P&L, they are adjusted while doing indirect method, while finding cash flow from operating activity. Under direct method, they are ignored. Plus non-cash item which have not gone in P&L, they will be ignored altogether. Next, component of cash and cash equivalent. Component of cash and cash equivalent. Now, can I say in your cash and cash equivalent, cash comes, demand deposit with bank comes, short-term highly liquid investment comes, and bank overdraft also comes if it's a part of cash management program. So bank overdraft also will be under cash equivalent for cash flow. For balance sheet, bank overdraft always comes under your liability. Balance sheet purpose liability, cash flow it comes under cash and cash equivalent. So we need to give a reconciliation. Cash and cash equivalent appearing here and cash and cash equivalent appearing in your balance sheet. Uska reconciliation needs to be given. Fine, this question is okay, not much important. This is your cash flow from operating activity. This is cash statement of cash flow. So we are done with Ind AS 34 and Ind AS 7. Moving ahead to chapter number 4, Ind AS 8. Okay, unit 1, 2, 3 chapter. We have Ind AS 8, Ind AS 10 as well as Ind AS 113, 3 standards. So let's finish these 3 standards. Now coming to Ind AS 8. Under your Ind AS 8 there are 3 things: accounting policy, change in accounting estimate, and prior period errors. Current year ka ya prior period ka, whatever. The accounting policy, accounting estimates, and third one is errors. 3 things are covered under this Ind AS 8. ठीक है. Now this standard is applied for selecting and applying the accounting policy. How to select the accounting policy? This standard gives you guidance. Okay, how to account for change in accounting policy, how to account for change in accounting estimate, and how to account for prior period errors. That all guidance is given over here. Acha, this standard tells about the guidance for this whole thing. Uske related tax impact are covered under Ind AS 12. Uske related tax impact are covered under Ind AS 12. Did you understand? Now, what do you mean by the word accounting policy? What do you mean by accounting policy? What you follow is your policy. Like suppose inventory can be valued either as per FIFO or weighted average. If we follow weighted average, that's our policy. Someone might be following FIFO. What you follow, that's your policy. The accounting policy has specific principles, bases, convention, rules, practices. There are specific principle, bases, convention, rules, practices applied by the entity in preparation, presentation of financial statement. What you follow is your accounting policy. Acha, cash flow from operating activity, either direct method or indirect method. What you follow is your accounting policy. Okay, now sir, how to select a accounting policy? How to select a accounting policy? If any Ind AS is telling you, follow the Ind AS. If any Ind AS already gives guidance, you need to follow it mandatory. Acha, can I follow a different policy than what is given under Ind AS? You may follow different policy if it is immaterial. I told you Ind AS applies only to material items. Fine. Acha, in absence of Ind AS, suppose if Ind AS is not there, management has to use judgment in developing and accounting policy. Developing and applying an accounting policy which is relevant as well as the reliable, that you need to take care if Ind AS is not there. And uske liye they are telling you take the guidance of this all thing in the order given. You take the guidance of this all thing in the order given. So for selecting accounting policy, first see Ind AS. Acha, iske related Ind AS is not there. The Ind AS with similar or related issue. The Ind AS dealing with similar or related issue you see. Acha, if that is not available, then you go to the conceptual framework. Conceptual framework are the bases on which the standards are built. The first, See the Ind AS. Ind AS वो नहीं है, direct नहीं है, related item का Ind AS. That is also not their conceptual framework. Then the pronouncement of IASB, pronouncement of other standard setting body, and lastly go to industry practices or accounting literature. So if basically Ind AS is not there, follow this way. Fine. Moving ahead. Change in accounting policy. The one meaning of accounting policy done. How to select a accounting policy done. Now change. Sir, can I change the accounting policy whenever I want? So they're telling you can change when it's required by Ind AS, or change will lead to provide more reliable and relevant information. The change will be providing a reliable and a more relevant information, then you can change it. Okay. Now following are not the change in accounting policy. What is not a change in accounting policy? Application of accounting policy for transaction, event or condition which are in substance different from the previous one. Okay, the previous code transaction there, but this time it's kind of in substance, it's a different transaction altogether. So point A talks about a similar transaction but different in substance. And point B talks about some new transaction coming up. New transaction coming up, uske liye we have a new policy. So that's not change in policy. Application of new policy for transactions that previously did not occur only. The first one talks about similar transaction but different in substance. Second one talks about the new transaction. These are not the change in accounting policy. Now just tell me one thing. Just tell me one thing. We are a hotel industry. Every time basically the building is basically operated by us only. This time also we constructed a new hotel, the building is there, but now the building is given to someone else for operating. So all earlier the buildings we were operating, this time building given to for operating to someone else. So can I say it's a similar transaction but different in substance? So earlier it was all accounted as per PP. This time the building I'm not going to manage. I gave it to someone else. I'll be getting a kind of fixed income. So वहाँ पे now it will become a kind of investment property. So यहाँ पे policy different are followed because that was PP. This is investment property. It's not a change in accounting policy. ठीक है. अच्छा, plus one more thing. Change in method of making estimate. अच्छा, the way you make an estimate. The change in method of making estimate is also known as change in accounting policy. I'm not telling change in estimate. Estimate change, it's a change of accounting estimate. Method of making estimate change, that's a change in accounting policy. Okay, question number 2, December 21 exam, this was there. You acquired a building for admin purpose, PP. Now you relocated to a new building. See, admin purpose was a PP. Now you relocated to new building. So can I say this building I don't need? So now I leased it off. So now it becomes an investment property. Earlier it was PP. Now it becomes investment property. So PP में cost or revaluation model both are allowed. Investment property only cost model allowed. So now I change the policy. Is it a change in accounting policy? No. It's not a change in accounting policy. It's application of policy for transaction and event that differ in substance from previous one. So earlier PP tha, policy was like that. Now it's an investment property. Policy is different now. So it's not a change in accounting policy. Okay, moving ahead. Question number 4. Change in functional currency. See, functional currency is the currency of the primary economic environment in which you operate. The primary economic environment in which you are operating, वो change हो गया, तो functional currency changed. Is it a change in policy? No, वहाँ पे कोई change in policy नहीं हुआ है. It's not regarded as a change in accounting policy. No, not. Okay, moving ahead. How do we account for change in accounting policy? Okay, accounting policy changed. How do I account? Retrospectively, I need to account. Okay. So if a change occurs due to first time adoption of Ind AS, first time you're adopting Ind AS, it changes occurring, wo Ind AS 101. But later on you're changing the accounting policy, it comes over here. So how do I account for it? Retrospective effect. Now, how do I give a retrospective effect? As if the new policy was followed from very beginning, since inception. As if the new policy was followed from very beginning, that is since inception. Now, effect relating to inception se leke, effect relating to inception se leke, period before preceding year. From inception to the period before preceding year, that is given in opening balance of previous year. Effect relating to previous year is given in previous year. Effect relating to current year till the date of change, that's given in current year. Acha, so whenever I'm changing, I need to give a retrospective effect. Retrospective effect is right from the beginning you're following this new policy. So from that beginning se leke period before previous year, that much effect you give it in opening balance of previous year. Effect relating to previous year, you give it in previous year, and effect relating to current year till the date of change, that should be given in current year figure. So current year figure, previous year figure, opening balance of previous year. So यहाँ पे 3 balance sheets will be required in your balance sheet. ठीक है. And this is we learned under Ind AS 1. Whenever you change your accounting policy retrospectively, or you retrospectively make a restatement of item or reclassify the item in financials, you need to give 3 balance sheets: current year beginning, previous year beginning, current year end, previous year end, and previous year beginning. So see, you need to adjust current year figure for effect relating to current year. You need to adjust previous year for the effect relating to previous year. You need to change the opening balance of previous year for the effect relating to period before previous year. Fine, this is okay. Now, question number 6. Question number 6. Check out. ABC Limited changed its method of depreciation and changed its method of inventory valuation. Prior FIFO tha, and now weighted average will be more appropriate. So you are changing from FIFO to weighted average, and because of change you are doing it in 18-19. So March 17 opening stock of last year opening stock goes up by 10. Last year closing stock goes up by 15. So if I see last year opening stock goes up by 10, closing stock goes up by 15. Current year closing stock 20 se. Acha, so current year mein opening stock will be this. Opening stock goes up by 15, closing stock goes up by 20. Now opening stock goes up, profit goes down. There's an inverse relationship between opening stock and profit. Closing stock goes up, profit goes up. So yahan pe net your profit is going up by 5. Here also your profit is going up by 5. Both the places your profit is going up. Profit going up, you reduce the cost of sales. Profit going up, कैसे करेंगे? Cost of sales reduce कर दो. Your cost of sales 164, cost of sales 173. Both of them में 5 going down. तो check out solution. ये 164 5 deducted, ये 173 5 deducted. Did you understand? Okay, moving ahead. Limitation on retrospective application. Now they are telling that you need to apply retrospectively as if the new policy is followed from very beginning, not previous year beginning, very beginning. Very beginning to the period before previous year, the effect is given. The effect is given at beginning of previous year. It doesn't mean we are changing from beginning of previous year. We need to apply it from beginning only. Acha, but sometimes some datas are not available. So that is called as limitation on retrospective application. Now, whenever the data is not available, what do? Then you try to apply it not retrospectively, then you try to apply it prospectively from the earliest date possible. So जब वो possible नहीं होगा, don't go for retrospective, do it prospectively from the date possible. Now, if 1 odd year data not available, or cumulative data not available, if 1 odd year data not available, apply in a manner that previous year figures can also be as per the new policy. But if cumulative data not available, you can apply it in a manner that previous year can be as per old policy. The previous year can be as per old policy. The 1 odd year data not available, that's period specific effect. Then you apply retrospectively in a manner that previous year can be given as per new policy. But a cumulative data not available, now what do? You go prospectively in a manner that okay, this year is for new policy, previous year old data will be fine. Check out, there will be a question coming regarding this. Acha, one more thing, whenever you're changing the policy, whenever you change a policy, you need to give disclosure in your notes to accounts. What disclosures are required? What disclosures are required? The nature of change, why, amount of adjustment coming in current year, previous year, amount of adjustment coming in period before previous year, that's opening balance of previous year. And if retrospective, it is not possible. retrospective was not possible, so did you apply it prospectively? Acha, previous year figures you kept it as per the old policy, that is to be described. ठीक है. Now if a new Ind AS is issued but not yet mandatory, acha, new Ind AS is issued, not yet mandatory, and you're not applying it, so you're required to disclose the fact. So new Ind AS issued, it's not yet mandatory, so I'm not applying it. So just disclose the fact and possible impact which it can have when you start applying. ठीक है. Question number 8, check out, this is Delta Limited changed the accounting policy of PP to apply a more fully component approach. You know, under PP we follow a component approach, a component having a different life, it's depreciated over its life. And we started now revaluation model, earlier was a cost model. But before 2002, cumulative effect, the data are not available properly. ठीक है, तो do one thing, start applying prospectively from 2002, previous year data, keep it as per old policy. The management determined it's not practicable to account basically retrospectively, so you decided to change it prospectively from start of 22, and management applied it in that way. Okay, these are the figures which are given. Prepare a note for it. See, whenever they're asking a note, we need to write down the nature of change, what, the reason, why, from which period you had, current year may impact, previous year may impact, period before previous year may impact, whatever it is, that all impact. And if you're not able to have a retrospective application, uske related thing also needs to be written. The policy has been followed prospectively from start of 2002 because it was not practicable to determine the effect from any earlier date, and the adoption of new policy has no effect on prior figure. The prior figures are as per the old policy only. And current year mein what effect came, that you are writing it out. I hope this is clear. This is your change in accounting policy. Now we go to change in accounting estimate. Many places in financial statement you need estimate, and due to new circumstances coming in, new information coming in, you becoming more experienced, you change your estimates. Revision of estimate, what to do, how to account, they are not accounted retrospectively. They are accounted prospectively, so they will come in the current period only. So last year we had made a provision for doubtful debt 100, now we feel it should be 120. The extra 20 book it in current year. ठीक है. अच्छा, change in method of making estimate. If you change the method of making estimate, that will be treated as change in accounting policy. अच्छा sir, if I switch over from WDV to SLM, written down value method, SLM method, see, whether I should go for SLM or WDV depends on how you are expecting benefit. If you are expecting even benefit, go for SLM. If you are expecting declining benefit, go for WDV. That was an estimate. Now if you change, that's change in estimate. It's not change in method of making estimate. So switching from WDV to SLM, that's just a change in estimate, not a change in accounting policy. ठीक है. Moving ahead, how do I account for change prospectively? It will basically have the current year effect, plus if I change something, imagine the useful life of fixed asset changed. Because of the useful life of fixed asset change, this year's depreciation will change, future ka depreciation can also change. ठीक है. Now question number 10. Acha, Nikita is telling, sir, exemptions given for first time adoption. First time adoption, I'll cover it whenever I do that Ind AS 101. Uske related exemption I'm not taking currently here. Okay, now question number 10. There is a motor which is sold with a standard warranty of 2 years, 31st March 2 May. Based on testing, you understood there are some problems, and provision for warranty you have done 1 lakh rupee for the motor which you sold during this year. For the motor which are sold during this year, you have done a provision 1 lakh. Achha, next year may a defect is discovered in motor. So now it will not be coming 1 lakh se zyada aayega. Fine. The defect resulted in amount of 2 lakh. ये जो 2 lakh rupees during the year FY23 on repair sold in last year. जो last year में बेचा उसके related का repair expense 2 lakh came. And we still expect 1,50,000 cost during 3-4 on meeting the warranty for basically the motor sold during 2-3. अच्छा, इस साल जो बेचा उसके related expense coming up in next year will be 150. अच्छा, now see, last year what we sold, provision was 1 lakh, actual came 2 lakh. Provision was 1, how much actual came? 2. So out of 2, 1 gets adjusted against provision, remaining 1 goes to P&L. So out of 2, 1 was adjusted against provision, 1 goes to P&L. Now this year end, next year may I know 150 will come up, so I need a provision 150. My provision is already used up, so now you create 150 provision. So out of 2 lakh which you really spent this year, 1 was adjusted against provision, 1 goes to P&L, plus I need extra provision 1.5, that also goes to P&L. Total 2.5 is going to P&L. Clear? Now errors. Okay, if there are errors, how do I do? Prior period errors are nothing but the omission or misstatement in entity's financial statement of one or more prior period arising from failure to use or misuse the information which was available or which could reasonably be expected to have been obtained and taken into account. If there is some error, what to do? And here the error also includes fraud. Here the error also includes what? Fraud. How do I treat these errors? You need to give a retrospective effect similar to change in accounting policy, retrospective. If error relates to current year's figures are changed. Error relates to previous year, the previous year column, that figures are changed. If error relates to period before previous year, the opening balance of previous year will get changed. Similar to your change in accounting policy, it will be accounted. I hope this is clear. Now coming to question number 11, A Limited has presented certain material liabilities as non-current. A Limited has presented certain material liabilities as what? Non-current up to 31st March 1 while preparing. Basically later they found out, oh no, it should not be non-current, it should be current. Achha, and this was impact since many years. So few things were shown as non-current, it should come under current. You reclassify the thing. Achha, does it affect previous year also? Yeah. Does it affect uske bhi pehle? Yes. So you need 3 balance sheets. Whether they need to prepare a 3rd balance sheet, answer will be yes, they should prepare 3 balance sheet. Achha, second, they committed an error in last year. If they committed an error in last year, the previous year figures will be rectified. Opening balance of previous year not changing, no need to have a 3rd balance sheet. So there's no effect on opening balance of previous year, no need to have a 3rd balance sheet. Okay. Now, there's an interim financial information. There's an interim financial information. There was some under provision. There was some under provision done. And from interim financial figures perspective, it's material. But annual perspective, it's immaterial. The management is telling from annual perspective, the figure is immaterial. Ignore it. No. For interim financial statement, I need to see the materiality based on that interim financial data only. So I need to consider based on interim financial data. So whether management ka view is acceptable, answer is no, not appropriate. Okay, question number 15, Cherry Limited. Question number 15, Cherry Limited. What happened? Check out. They incorrectly included in inventory rupees 6400 product which was sold off. Acha, product जो बेच दिया था, I took it in inventory. तो कहने से inventory was overvalued by 6500. अच्छा, तो 31st March 4 inventory was overvalued. तो 3-4 में the closing stock overvalued, closing stock goes down. तो 3-4 the closing stock goes down, 4-5 opening stock goes down. 3-4 closing stock goes down, 3-4 closing stock goes down, 3-4 profit goes down. 4-5 opening stock goes down, 4-5 का profit will go up. So 3-4 का profit will go down, 4-5 का profit will go up, and profit going up or down, adjustment will come in COGS. अच्छा, 3-4 profit going down, add it in COGS. तो check करो COGS, ये 53,500 है ना, add 6,500, ये हो गया 60. And next year your profit will go up, to decrease COGS by 6,500. And a closing stock of 4-5 is correctly valued, no other change comes up. Closing stock is correctly valued, no other change comes up. So this is the effect, and they've given a note. How did you rectify it? Uske related note is given. So there was the error is rectified. Uske karan this figures are affected. Okay, question number 16. Question 16. There's an investment property. Original cost is 1 lakh. Omitted to depreciate. we omitted to depreciate in the previous financial statement, and property was acquired in 2001. Now error is to be corrected in 2004. Oh, achha, this is 2004. So 4 ka depreciation, 3-4, I'll take it in this year. 2-3, 2-3, I'll take it in previous. 1-2, beginning of previous year. Achha, so if I try to understand 10,000, 10,000, 10,000, 10,000 related to current year, I'll take it in current year. 10,000 related to previous year, I'll take it in previous year. 10,000 related to period before previous year, I'll change the opening balance of previous year. So opening balance of previous year, uske andar ye 10,000 adjusted. So restated opening. Now, previous year ka 10,000 profit will go down, and current year also 10,000 profit will go down, and then we have a corrected closing current year. I hope this is clear. This is your Ind AS 8. Let's go to Ind AS 10. This is your Ind AS 8. Let's go to Ind AS 10. We'll try to finish Ind AS 10 and 113, then take a break. We'll finish Ind AS 10 and 113, then take a break. Are you enjoying? I'm telling you, we are covering all important questions as well. This is an in-depth revision, and if you like it, do share it with all your friends. Whether they have studied from me, not studied from me, this is really going to help them. 25 hours ka revision. This is not superficial, this is in-depth. Now, moving on to Ind AS 10, which is event after the reporting date. Now, what do you mean by the word event after the reporting date? Event after reporting date are those events. It may be favorable, unfavorable, but it has to be material. If it is immaterial, ignore it. But it can be favorable, unfavorable, which occur after the year end till the books are approved by approving authority. Till the books are approved by approving authority. In case of a company, the financial statements are approved by board of director. Shareholder adopts. The board of directors will be approving it. Okay. So if anything happened after year end till the books are approved, we classify them as event after the balance sheet date or event after reporting period, and they are subclassified in two parts: adjusting, non-adjusting. Adjusting events are those which provide existence of the condition which were prevalent at the balance sheet date. Okay, the adjusting events are those which provide evidence of the conditions which were prevalent on the reporting date. Non-adjusting are indicative of condition that arose after the reporting date. Okay. Now, tell me, who approves financial statement? I told you board of director. In your question number 3, they're telling 18th May, the management means the BOD. Management means BOD. BOD approved the financial statements. Then there's a supervisory board. To whom it is given, and then they approve it. And then shareholders actually don't approve, the shareholder adopt. So what is the date? What is the date for event after reporting date? It's year end ke baad. Till which date? Should I take till 18th May to 26th May, 15th July? Kab tak? It should be till BOD approves. Supervisory board is of no use. Normal BOD approves. Normal BOD, when did they approve? 18th May. So event after the reporting period will be 1st April 2 to 18th May 2002. Okay. Okay, the board of directors approved on June 15th, and management discovered a fraud. They reopened the books. They will approve it again. And now they approved on 30th June. Then event after balance sheet date will be from 1st April to 30th June. If they reopened it and they're again approving, so then I have to take that latest date which is there. Fine. Question number 6. ABC Limited prepared an interim financial report for the quarter. Okay, question. Whether this event after reporting date also applies to quarterly financials? Whether event after reporting date also applies to quarterly financial? Yeah, it applies. Remember, under your Ind AS 34, the principles of recognition of assets, liability, expense, income will be based on respective Ind AS. So this is also applicable. The Ind AS 10 will be applicable for interim financial reporting also. Now going to the word adjusting event. We know event after reporting date are of two types: adjusting, non-adjusting. Coming to first adjusting. Adjusting events are those which provide evidence as to the condition which were existed at the reporting date. Few examples. A litigation which was going on at year end, we have done some provision. And now the court ka result comes up after year end before books are approved, and we did a provision 10 lakh, actual payable became 12 or actual payable became 8, the condition where prevalent, it's adjusting. Okay. Now, debtor was doubtful, we already done a provision. Debtor was doubtful, we knew there are troubles, we have done a provision. And after year end, before books are approved, he became bankrupt and actual loss is coming different. Then it's adjusting. But debtor became insolvent due to earthquake. Debtor became insolvent due to earthquake or fire at a debtor's place in April. Acha. This is due to fire at a debtor's place in April. 31st March condition was not existent. That will be non-adjusting. Okay. Inventory sold off later on at NRV. Now see, when inventory is sold off later on at NRV, what is happening is, I generally presume the conditions were there. I generally presume the conditions were there on 31st March. And then it is sold at NRV later on. Cost to NRV, to NRV pe becha, lower rate pe becha. It's adjusting event. Okay, you purchased a PP, actual cost was not known, or the provisional cost is provided in your book. After year end, before books are approved, the actual cost comes up. So that's adjusting. Fraud discovered after year end, before books are approved. Now see, fraud was already there. It was already there. We came to know about it now. So it was already there, so it is adjusting event. Now, if it's an adjusting event, books are not yet approved, so we can make changes to the books. Books are not yet approved, we can make changes to the books. So financial statement of the current period are adjusted to reflect this. Now coming to non-adjusting. Non-adjusting event are those which are indicative of the condition that arose after the reporting date. They were not there, they arose after the reporting date. Example, okay. Decline in fair value of investment. The investments which you had, uska market value went down later on. Now see, if I knew the market value would have gone down, I would have sold off only. So I was not knowing that price will go down. So that is non-adjusting. Major disposal of asset. Now see, negotiation for sale of asset was going on. Deal finalized later. See, asset sold you can record only when it is really sold. Negotiation chal raha hai, I cannot record a sale on 31st March. Actually, it sold on 15th April, record on 15th April, non-adjusting. So I need to understand. Don't go by the word negotiation. So don't say that negotiation is non-adjusting. No, aisa nahi hai. You need to understand for what purpose it is. If negotiation is for purchase sale of asset, so till the time you actually purchase or sale, you can't record. It's a non-adjusting. But a negotiation is for retrospective wage revision. If negotiation is for retrospective wage revision, we have already done a provision and now the negotiation got finalized after year end before books are approved, that will be adjusting because it's a retrospective wage revision, services already were received, the situation was going on. To understand for what purpose it is. Major business combination happening after reporting period. Okay, change in foreign exchange rates after reporting period. So major litigation coming up for events which occurred after the reporting period. So some event which happened after year end before books are approved, uske related litigation. These are all non-adjusting. Now sir, what to do for non-adjusting event? Non-adjusting event, you don't adjust in financials now. But if material, you can disclose their effect in notes to accounts. Notes to accounts. Acha, so adjusting event, we adjust the figures in financials right now. Non-adjusting event, we don't basically adjust in financials. We'll disclose it in notes to accounts if material. Okay, check question over here. We have done a provision for bad debt. February, May. Debtor has suffered a loss due to earthquake. February, May. And we made a provision 50 lakh. April, May, he became insolvent. So see, we already knew his condition was bad. This is adjusting event. But if earthquake had happened after 31st March, then it will be non-adjusting. Okay, moving ahead. Question number 10. Moving ahead, question number 10. Okay, ABC is trading in laptop. 31st March, you have 50 laptops of 45,000 each cost. 15th April, advanced version came. Now see, laptop, mobile, the newer version keeps on regularly coming. तो 15th April the newer version came, old version के prices went down. These are all normal market fluctuation. These are all normal market fluctuation. These are considered as adjusting. So check out normal market fluctuation like introduction of new product will not be a new condition. It is ऐसा तो होता ही है. We knew, like we knew every time Apple launches new iPhone in the month of September. तो मुझे मालूम है वो होने वाला है. तो that is something which we are already aware of. It is an adjusting event. Going ahead. Question number 15. Question number 15. You are required to pay penalty for breach of performance of a contract. You believe the penalty is payable at a lower amount. So you went to an arbitrator. The financial statement for 2001-2 which were approved in July. The arbitrator in June awarded the case in your favor. Acha, so you already done a provision. But you felt the penalty should be at a lower amount. You went to arbitrator. Books are approved in July. In June, can I say before the books are approved? Arbitrator gave a award in your favor. So can I say now the provision which you made needs to be reduced? Situation was already there. It's an adjusting event. Plus, the provision earlier made was to be reduced. ये हुआ. Arbitrator also decided that the cost of the case, the cost which you incurred for the arbitration, that should be borne by other party. Acha, the one thing, the provision which was already done is to be reduced. Second, whatever cost I had incurred for this arbitration procedure, that I'll get a reimbursement from other party. So this question, there are two issues. Reduction in provision for penalty, already there in balance sheet, and second, recording a new asset, the reimbursement receivable for the cost of litigation. Now see, the reimbursement receivable, whether I'll receive or not receive, वो पता नहीं था. It was a contingent asset. So cost of litigation, whether I'll get or not, वो पता नहीं था. It was a contingent asset. As per Ind AS 37, contingent assets are not recognized. They are recognized only when they become virtually certain. So now, basically, in June, the judgment came. Now it's virtually certain. You record only in June. Provision already done. Situation was prevalent. Now in June, before books are approved, I understand lesser provision required. You can adjust it. So this will be adjusting. But ये जो second part है ना, recording reimbursement receivable, it was a contingent asset on 31st March. It should be recognized only when it's virtually certain. It became virtually certain. Which date? In June. Record it in June, not in March. Okay. So two things. As far as provision है, वो adjusting event होगा. As far as recovery of cost, it was a contingent asset. Don't record until it is virtually certain. Record it in June only. Next question, question number 16. You are entitled to duty drawback. You get some duty back, whichever you have paid, provided you have to make an application within 15 days of meeting the turnover limit. You made late application. As you made late application, whether you will receive or not receive, it's at the option of the officer. So you have basically filed after the stipulated time. तो आपको मिलेगा नहीं मिलेगा, you are not sure. It's a contingent asset for you. So 31st March, it's a contingent asset. You record only when it becomes virtually certain. Now it's approved by department on 28th of June. Record on 28th June, even though books were not approved. Even though books were not approved, I cannot make it 31st March because 31st March, whether I'll get and not get, it was not sure. It's a contingent asset. So यहाँ पे it will be non-adjusting. If application was filed within the stipulated time, so now I was sure I'm going to get back, approval came later, I can record on 31st March, it's adjusting event. But as you file late, whether you'll get or not get, you are not sure, it's a contingent asset on 31st March, it became sure only in June, record in June. Okay, now Girdhar Lal has question that, sir, on 31st March, if reimbursement expense was not recorded as contingent asset, should we record a contingent asset? Dear, first of all, contingent assets are not to be recorded. Contingent asset कभी record नहीं होते. तो earlier you spend, you had recorded as an expense. आपने spend किया था, आपने asset नहीं दिखाया. You did not show as an asset, you showed as an expense only. Now later the court is telling you will get a reimbursement from other party. तो expense reverse हो जाएगा and kind of you're getting money. तो that time you would not have recorded it. आपने उसको expense में ही डाला था. Now to book basically a asset, you book only when it's virtually certain, that is when that court ka order came in June. You cannot go back in March. Are you clear? Okay. This long-term loan arrangement, this is already covered under Ind AS 1. The same thing, I'm not doing it again. We will rectify the bridge after year end, before the books are approved wala. ठीक है. Going concern wala point was already discussed also under your Ind AS 1. I'm not doing it again, so leave these two things. Now come to question number 19. Acha, Moon Limited won an arbitration award. It was evident the company was likely to win. And directors have approved basically on this time, and 1 crore rupee. Management did not took it because it was considered favorable. Acha, now see, your event after balance sheet date are those event which should be material, and it can be both favorable as well as unfavorable. So management did not consider it because it is favorable. No, that is wrong. It will be a adjusting event. Acha, ye mobile wala, we just now did it. After the year is over, the new launch came and price is reduced. It's an adjusting event. NRV went down. You have to consider it in March only. Old debtor became insolvent. So already we knew his position was not good. It's an adjusting event. Achha, after year end we went for restructuring. It's a non-adjusting event. Okay, dividend. Now, dividend after the year gets over, the board of directors have a meeting, they approve financial, they recommend dividend. Then the shareholders will be having a meeting, they will be declaring a dividend. The liability for dividend should be booked only when it is declared. So can I book it on 31st March? No. If basically it's declared in June, it will be recognized in June only. So it is not an adjusting event. It will be recognized only when it is declared. Now, if it's a redeemable preference share, okay, if it's a redeemable preference share, can I say under Ind AS the redeemable preference shares are a liability? If it's a liability, uska expense, so dividend on it. So this year's dividend should come in this year only, even though declared, not declared, doesn't matter because it's an expense, it comes under finance cost. So dividend on redeemable preference share will be regarded as an expense. Current year expense should come in current year, whether dividend declared or not. Did you understood? Okay, next point is the last point of this standard. It is talking about distribution of non-cash asset to owner. We are distributing what? Non-cash asset to owner. Distribution of non-cash asset to owner. Achha, so to owners, to my shareholder, I'm giving some non-cash asset. Imagine this example I had given in class also. Arvind Limited has a subsidiary Arvind Fashion Limited. Arvind Limited has a subsidiary Arvind Fashion Limited. Now what happened is they went for some demerger kind of things. And now the shares of Arvind Fashion Limited, Arvind was having, rather than keeping it with themselves, they gave it to the shareholders of Arvind. Achha, so Arvind has given the shares of Arvind Fashion to its shareholder, means the shareholder of Arvind. मेरे shareholder को मैंने subsidiary के shares दे दिए. So the thing is, earlier it was shareholder to Arvind, Arvind to Arvind Fashion. It was kind of shareholder to Arvind Fashion. Now what happened? Now it is basically shareholder and they will have directly the shares of Arvind and they will have the shares of Arvind Fashion also. This way it is now there. Okay, I hope you understood it. So Arvind Limited gave the shares of Arvind Fashion to the shareholders of Arvind. So can I say it's a non-cash distribution, non-cash asset distributed to owners? Whenever it's a non-cash asset distributed to owner, you need to account it like the dividend which you are giving to them. Cash nahi de rahe ho, non-cash de rahe ho. So how do I account it over here? So one, you need to first of all whenever entity declares a declaration, whenever you're declaring it that I'll give you the shares, you need to record a liability for dividend payable. It's actually not dividend, but still accounting is done like the dividend to shareholders. So you basically record a liability and it's a dividend to retained earnings, not P&L, retained earnings debit to dividend payable or liability for distribution. Now liability for distribution will be remeasured every year as well as at the time of settlement. To measure the liability at fair value to be distributed. Day one it is fair value to be distributed. Then at each reporting date, settlement date, you again remeasure it. And then when you settle it, so difference between dividend payable recognized and the carrying amount of that asset. So now how I'm paying the dividend liability for distribution debit to bank nahi hai, to investment in equity shares of Arvind Fashion Limited, that goes away. Uska carrying amount goes away and difference comes in P&L. Okay, the checkout over here. Arvind is having shares of Arvind Fashion. Now that shares of Arvind Fashion, Arvind is giving to its shareholder. Now cost is 10 lakh, but uska fair value today is 15. So record a liability for distribution at 15. So retain earning to liability for distribution 15. Then it became 16. Then iska fair value became 1620. So 15 became 16. 16 became 1620. Okay, now in your book liability 1620, I'm giving the shares. The liability goes away 1620. Shares in my book is 10 lakh. Difference 620 goes in P&L. Any doubts? Anybody with Ind AS 10? Any doubts? Anybody with Ind AS 10? I'll do Ind AS 113, then we are taking break. I'll do Ind AS 113, then we are taking break. Pay attention, keep smiling. Sir, if I'm getting kind of bored or I'm not able to concentrate, what should I do? Shake yourself. Shake it. Fresh hona hai yaar. Keep on drinking water. Keep on replying. Keep on moving your body. These are all small things to keep yourself fresh. Now, chapter number 4, unit number 3 is Ind AS 113. Ind AS 113 is fair value measurement. Now see, many Ind AS tells you that, okay, this item should be measured at fair value. So now, which item to be measured at fair value, this standard doesn't say, but how to find out fair value, this standard is telling. So this standard does not tell us which item should be measured at fair value, or respective Ind AS will say. But if an item is measured at fair value is determined as per Ind AS 113. ठीक है? Now, so what is the definition of the word fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participant at a measurement date. Acha, so try to understand. It's a price that would be received to sell an asset. I'm selling asset, I'll be getting money. It's not an entry price, it's an exit price. It's not an entry price, it's an exit price. Okay, in an orderly transaction between market participant. Okay, so price is basically not over here entity specific, it's market specific. I may be hard pressed and I may be selling the asset at a lower value. But that is not to be seen. I have to see the price which will be there in an orderly transaction between market participant at a measurement date. It's a market based value rather than entity specific value. It's an exit price. Fine. Now, restriction relating to asset or liability you consider. Imagine you have a building or you have a plot of land. You have a plot of land which is nearer to airport. As it's nearer to airport, they are not allowing you to build a skyscraper. So you are allowed to have only 4-storied building. So that is a restriction of asset because it's nearer to airport. So restriction relating to asset or liability consider, but restriction relating to entity don't consider while determining fair value. Okay. Moving ahead. Now they say that in an orderly transaction. So for determination of fair value, we assume either the transaction takes place at a principal market or the transaction takes place at a most advantageous market. The fair value takes into account the transaction takes place either at a principal market where there is highest volume, usko principal market, or the most advantageous market. I can sell the shares in BSE also, I can sell the share in NSE also. In BSE, I am getting 5 paisa extra. The most advantageous will be BSE. ठीक है, तो प्रिंसिपल मार्केट में या तो मोस्ट एडवांस, इफ प्रिंसिपल मार्केट अवेलेबल assume the transaction is done at principal market. If principal market not available, then you assume the transaction is done at most advantageous market. ठीक है. Now how do I find the most advantageous? Where your net proceeds are highest. Net. What happens is, okay, I'm able to sell at this rate, but commission in that marketplace might be more. तो नेट प्रोसीड्स कहां पे ज्यादा आ रहा है, दैट्स द मोस्ट एडवांटेजेस. इफ प्रिंसिपल मार्केट अवेलेबल, फेयर वैल्यू इज बेस्ड ऑन प्रिंसिपल मार्केट नॉट अवेलेबल, देन ओनली बेस्ड ऑन मोस्ट एडवांटेजेस. मोस्ट एडवांटेजेस किसको बोलेंगे, वेर यू आर हैविंग द हाईएस्ट नेट प्रोसीड्स. ठीक है. Then I told you it is basically a market participant based. It's an orderly transaction between the market participant. Now who are that market participant? They are independent, not a related party. They should not be under any stress or force, and they were reasonable and sufficient information so that they're able to make a proper decision. Now, the price is not an entry price, the price is an exit price. Fine. Now, whenever you are determining the most advantageous market, I consider the net price. Net price is after the transaction cost as well as transport cost. So there are two words coming, transaction cost, transport cost. So for determining most advantageous market, we see the net proceeds, that is basic price minus transport cost minus transaction cost, everything. But while determining fair value, transaction costs are not considered. Transaction costs are the cost of transaction. Transaction costs are not considered, but transport costs are considered. Asset is big in size, transport will be more. Asset is small in size, transport will be less. So transport cost is considered in fair value. Transaction cost is not considered in fair value. But so while determining fair value, transport cost considered, transaction cost not considered. While determining the most advantageous market, everything considered. Net proceeds I have to see. तो वहां पे दोनों considered. ठीक है. We have a question over here. Asset can be sold in two active markets. Market A, market B. Achha, if market A is a principal market, then only go for A. Principal market available, fair value is based on that. Achha, so we'll get 26. Transaction cost ignore. Transport cost 2. So 26 minus 2, fair value is 24. Fair value is 24. Achha, if none of the market is principal market nahi hai, so then I need to find most advantageous. For finding most advantageous, see the net proceed. So 26 minus 3 minus 2, 21. 25 minus 1 minus 2, 23. अच्छा, तो यहाँ पे हो रहा है 21 net, यहाँ पे हो रहा है 23 net. So here basic price is less, but net is more. So B is your most advantageous market. B is your most advantageous market, and the fair value will be 25 minus 2. So fair value is 25 minus 2, 23. The fair value is 25 minus 2, 23. So for finding out basically the most advantageous market, we consider net proceed. But for determining the fair value, I'll be considering only the transport cost. Transaction cost is not considered. Next one, I have a fair value of a non-financial asset. PPE, investment property, intangibles. PPE, investment property, intangible. How do I determine the fair value of it? The fair value of it is based on, it should be based on what? The highest and best use. So if there is basically a plot of land where a mall can be constructed, तो उसका highest and best use is basically mall. So if you have constructed a mall, आपने mall construct किया, तो what revenues you are getting from that, based on that the fair value is determined. But if suppose you are using that land as parking lot, so are you doing highest and best use? No. So how much you will get by selling it to someone who will do a highest and best use? So either it is based on highest and best use if you are doing it, or if you're not doing it, how much you will get by selling it to someone who will be doing a highest and best use. And highest and best use is something which is physically possible, legally permissible, and financially feasible. Physically possible, legally permissible, and financially feasible. And highest and best use is determined from market participants' perspective, not from your perspective. ठीक है, the check over here, DS Limited as a vacant land, and basically lot of commercial complexes are coming up there. The highest and best use is basically commercial complex. Company is not interested in developing this and you have let out as parking. Are you doing highest and best use? You just given it as parking. Are you doing highest and best use? No. So here the fair value of that land will be the amount which you will get on selling to someone who will build a commercial complex. Who will build a commercial complex. Are you getting it? Okay, moving ahead. The fair value will be the price that will be received when sold to a market participant who is interested in developing a commercial complex. Acha, liability and equity. If that liability or equity is quoted, the quoted price, agar liability equity quoted hai, to quoted price you take it. ठीक है. If ours is not quoted, you try to find out the fair value based on identical or similar instruments which are quoted. Now sir, what is identical? Our debentures are 9% with 5-year term and AAA rating. There's another company 9%, 5-year term, AAA rating. So that is called identical. Ours जैसे वैसे ही someone else, but same thing, 9%, 5-year AAA rating. But if someone has 10%, 5-year AAA rating, these are not identical, these are similar. So try to basically find fair value of our debenture based on either the identical if available or the similar debentures. ठीक है. Acha, if that is also not available, then this standard says you try to use more of observable data, less of unobservable data. Observable data is something which is available to everyone. Inflation index, RBI ka rate, though that's observable data. Unobservable data is something which is available only to you. My future projected cash flows, तो वो आपका है, that's unobservable data. And standard says use more of observable, less of unobservable. तो use direct quoted price available नहीं है तो identical or similar उसके ले लो. That is also not available, then use observable data more, less of unobservable. ठीक है. Okay, moving ahead. Now, fair value at inception, initial recording. Now see, day one generally the transaction price is the fair value. So if I'm buying, what I'll pay the fair value generally. So generally initial recognition transaction price is the fair value. But sometimes if a transaction is between a related party, can I say transaction price may not be the fair value? So day one, if transaction price is not the fair value and Ind AS tells you, the respective Ind AS telling record at fair value. So I am recording asset or liability at fair value, but amount paid or received is not the fair value. How to account for the difference? If that respective Ind AS tells, you take it as per respective Ind AS. If nothing is given, this standard says the difference you take it in P&L. Now going to valuation technique. Okay, one is a market-based approach. I told you a similar, identical or similar available uske basis pe. So this is basically metrics pricing is normally used for debts. Okay, so I don't have my listed. So similar benchmark securities which are listed. They have a similar rate, similar term, similar rating. So unka kya rate chal raha hai? Take that. Second, based on market multiples. Okay, imagine I am unlisted. There's a listed company which is similar to me. They have a P ratio of 10. They have a price to earning ratio. The price is 10 times the earnings. EPS jitna hai usse 10 times. So same for me also, I can take it, but I am unlisted. So probably for me it may not be 10. For me it may be 9, kind of that you adjust. So this is basically market multiple or market approach. So under market approach, we take the base of similar entity which is listed. Okay, check question 3. ABC acquired 5% for 10 crore in 2001-2. Okay. And now we want to find the fair value of this 5%. There is a similar transaction. PQR acquired 20% for 60 crore. But it will be sometime, kabhi, I don't know when. So I cannot say 20% is 60 crore, so 5% is how much? Oh, 20% was 60 crore on some day. I want today's. So, but they used EV/EBITDA of 8. The EBITDA into 8 multiple. Currently, the EBITDA is 40. So can I say company ka valuation? Currently, company's valuation is 40 into 8, 320. अच्छा, I hold 5%. तो currently valuation is 40 into 8, 320. I hold 5%. So my valuation 16. My valuation is 16 crore. But they say that we need to consider 5% liquidity discount, 5% of non-controlling stake discount. We hold a very lesser stake. तो ये 5% आपको क्या करना है, डिस्काउंट लेना है. तो टोटल 5 plus 5 10%. 10% of 16, it is coming 1.6. So now valuation will be 14.4. Next, income approach, future earnings का present value. Future earnings का present value, that is income approach. Whatever I'm going to get in future, उसका present value, that is the value of entity. उसमें से debt deduct करो. That is basically the enterprise value. Whatever future I'll be getting, उसका present value, that's entire business. उसमें से you have to pay debt. Remaining is available for equity. Plus, if I have any surplus cash now, or if I have some surplus assets now, which were not considered here, so plus surplus cash, this is the equity का value divided by number of equity shares. ठीक है. Check question number 5. They are telling two approaches, market and income, both are there. You have to give equal weightage to both. अच्छा, तो valuation is for market approach is this, valuation is for income approach is this. I have to give equal weightage, so I'll totally divide it by 2. I'll totally divide. That's the enterprise value. उसमें से debt को deduct करो. Surplus cash I'm having added, surplus asset I'm having added, that becomes the total amount available for equity divided by number of equity shares. Okay, question number 6 is easy. आप करोगे तो problem नहीं आएगा. 6 fine. Okay, moving ahead, 7th one. 7th is a good one. RTP November 21 exam, 7th. Okay, 1st January 1, there is a decommissioning liability which is required. After 10 years, I have to do decommissioning. So I am finding a fair value of that decommissioning liability. Following inputs are given. These are the labor costs which will be incurred. These are the labor costs which will be incurred. This. Iska probabilities are given. So I'll take multiplied by probability, weighted. वो हो जाएगा. So this understand. Okay, plus overhead will be 80% of it. Overhead हो गया. And now see, you are not going to do it. Labor इतना लगेगा, overhead इतना लगेगा, but I'll hire someone to do it. He will charge profit. तो markup 20% is always on cost. That guy को 20% देना है. Okay, so if we just check out, the expected labor cost is coming 131, overhead is 80%, plus I have to give a markup 20% on both. So this is 283.5. This is 283.5. ठीक है. Plus a risk that actual cash flow might differ, so extra 5% premium also I am considering. So this was coming 283.5, plus karo 5%. Plus karo 5%. Fine. And now A Limited assumes a rate of inflation 4% over 10 years. Now see, ये जो अभी था ना data, this all is current thing, but I have to do that decommissioning after 10 years. So 10 years inflation add karo, 10 years inflation add karo. So here they've added inflation first and then added 5%. You add 5% first and then you add inflation, answer will be same. It doesn't matter whether we take effect of inflation first or effect of risk uncertainty first. तो आपका ये 283.5 है, उसमें 10 years inflation to be added, 1.04 into 1.04 into 1.04 into 1.04. I have to do it kind of 10 times. तो ये हो गया आपका effect of inflation, वो risk uncertainty. Now your total cash flow which you are expecting after 10 years. The total cash flow which you are expecting after 10 years is 440.63. This is what you are expecting. Discount करो इसको. Now sir, should I discount it by the same inflation factor, inflation का rate? नहीं. Discounting will not be at inflation rate. Now, check. Risk-free rate is 5%. Entity का credit risk is 3.5%. तो for entity 5 plus 3.5, so discounting will be done at 8.5%. Now check this note. Okay. Discounting will not be at inflation rate, but it will be at the cost of capital of the entity, which is risk-free plus the risk associated. So I know I have to spend 440.63 after 10 years, discount it at 8.5%. Today's value is 194.97. That's the fair value of liability. Next one is fair value hierarchy. We have three levels, level 1, level 2, level 3. Level 1, level 2, level 3. I'll directly go to a chart which explains this. Acha, if quoted price of identical is available, identical ka quoted price available hai? Yes, and I can use it without adjustment. Identical quoted price available, I can use it without adjustment. Is price to be adjusted? No, तो उसको बोलेंगे level 1. Identical का quoted price available, I can use without adjustment, it's level 1. But if price is to be adjusted, अगर price adjust करना है, then it will be level 2 or 3. अच्छा, तो adjust करना है. अच्छा, adjustment is based on, we have to use significant unobservable data. Unobservable data comes in level 3. So are there significant unobservable input? Yes, to level 3. No, to level 2. अच्छा, तो identical one का quoted price available without adjustment I can use is level 1. If I have to do adjustment, so now I have to see input used for adjustment. Unobservable data significant है, it's level 3. Observable data significant, it's level 2. ठीक है. अच्छा, identical का price not available. Identical का price not available only. ठीक है, तो now you see for doing valuation inputs which you are using. Significant inputs are unobservable, level 3. Observable, level 2. ठीक है. Now D holds equity shares of private company. You have a equity shares of private company. You use discounted cash flow method. So whatever cash flows will come up in future, uska present value is valuation. Now see, cash flows are internal. It's not known to public. Observable means available to everyone. So this is unobservable data. This is unobservable data. This will go in level 3. This will go in level 3. Achha, what will be your answer if price of similar company was available? Achha, similar company ka price available, usme I am doing it. Usme you are doing it, then it will be level 2. Achha, identical without adjustment was level 1. So here it falls under level 3, discounted cash flow. If price of similar was available, it will be level 2. Clear? Question number 9 is fine, and this are disclosure. This was your Ind AS 113. Any doubts? Anybody till now? Any doubts? Anybody? We did 5 standards. Ind AS 34, Ind AS 7, Ind AS 8, Ind AS 10, Ind AS 113. 5 standards we have done. Now we take a break of 15 minutes and then we will start again. So we are having a break 15 minutes. It is 7:18. We'll be back at 7:33. We'll be back at 7:33 p.m. Till then, enjoy your break. Okay, hi, welcome back. Day 3 of your marathon is going on. Today we completed 5 standards till now. Ind AS 34, Ind AS 7, Ind AS 8, 10, 113. Now going to your chapter number 6. All the Ind AS related to assets. All Ind AS related to assets. We are starting with Ind AS 2, which is on inventory. Keep your books open. Give me high five. Thank you. Okay, now just tell me, am I audible, visible properly? Just tell me, am I audible, visible properly? Okay, yep. Chalo, thank you. Moving ahead to Ind AS 2. Okay, Ind AS 2 is on inventories. It was going to give us accounting treatment for inventory and how do we measure the inventory? We know cost or NRV, whichever is lower, how to find out cost, how to find out NRV, all that things. Okay. Definition of the word inventory. Inventory are assets held for sale in ordinary course of business or in process of production for such sale or in form of material or supplies which will be consumed in the production process or for rendering services. So can I say they're nothing but kind of your raw materials, WIP, finished goods, all that things coming. Now machinery spare parts. Machinery spare parts which are of regular use, they come under inventory, but machinery spare parts which are of irregular use and have a longer life, they will be falling under your PPE. So whether machinery spare part comes over here, if they meet criteria of PPE, they will be under PPE in day 16 or else they'll be coming over here. Okay. Now question number 2, whether your inventory includes material, as per Ind AS 2, inventory includes material supplies awaiting use in production process, whether packing material, publicity material are a part of this. So whether packing material, publicity material. Now see, primary packing material. Suppose you are selling, say, dry fruits in a jar. You are selling dry fruits in a jar, so that jar, that's a primary packing. That's included. Secondary packing. For sending it to someone, you're using cartons. That's a secondary basically material. वो primary packing material are included. Secondary packing material are for transportation purpose, for the purpose of sale, they are not included. Publicity material, okay, publicity material is for marketing purpose, again they are not included in your inventory. Fine. Moving ahead, this standard applies to all your inventory except one, the financial instrument, biological asset related to agricultural activity and agriculture produce at the time of harvest. Agriculture produced at the time of harvest is accounted as per Ind AS 41. Later it will be accounted by Ind AS 2. So at the time of harvest, the mangoes plucked from mango tree, immediately they are valued as per Ind AS 41. Subsequently, Ind AS 2 will be applicable. Achha, then they are telling the measurement part. Recognition, presentation, all that will be applicable. The measurement part will not apply to the producer of agriculture or forest product to the extent they measure it directly at NRV in accordance with well-established practice in that industry. So in that industry, they directly value it directly at NRV. So producers के लिए, producer of livestock, उनके लिए it is not applicable. Commodity broker trader, they have the inventory just for few days. As such, I'm a broker also, I'm a trader also. I buy and I sell it immediately in 1 or 2 days. So I have an option directly to measure it at fair value, less cost to sell. Okay, this is okay. Now, we know basically your inventory is valued at cost or NRV, whichever is lower. What do you mean by the word NRV? Coming up later. Now, so measurement is lower of cost or NRV. Coming to first of all the word cost. Cost includes your cost of purchase, cost of conversion, other cost incurred in bringing the inventory to present location and condition. Okay, the cost of purchase, cost of conversion, other cost incurred in bringing inventory to present location and condition. Cost of purchase will include the purchase price, non-refundable taxes. If there are taxes, I'm getting a credit, GST paid, it's basically I'm getting a credit, it's not included in cost of inventory, it will be GST receivable. So credit not available, added to cost. Any other expenditure directly attributable to acquisition. Achha, trade discounts, rebates, duty drawback are deducted. Trade discounts, duty drawback, rebate are deducted. Only trade discount, not cash discount. ठीक है. So check over here. Cost of conversion next. Now, so we understood cost of purchase. Now cost of conversion. Cost of conversion is you got raw material, you are now converting it into finished goods. So cost of conversion consists of cost directly related to unit, direct labor, direct expenses, and systematic allocation of fixed and variable production overhead. Systematic allocation of fixed and variable production overhead. Variable production overhead are allocated based on actual capacity. Fixed production overhead are normally allocated based on normal capacity. But if actual production is more, then fixed production overhead will be based on actual capacity. Acha, so variable production overhead always based on actual capacity. Fixed production overhead, how do we have it? Fixed production overhead divided by normal capacity or actual capacity, whichever is higher. Normal capacity or actual capacity, whichever is higher. This is the way we'll be doing it. So normally it's normal production, but if actual production is higher, then I'll use actual. ठीक है. Moving ahead, question number 7, May 19 exam, it was there. The normal capacity is 10 lakh units, fixed production overhead is 30 lakhs. So can I say fixed production overhead per unit based on normal capacity is 3? Now determine if actual production 750. So see 30 lakh divided by fixed production overhead 30 lakh divided by normal capacity 10 lakh, actual 750, whichever is higher. So then it will be 30 lakh divided by 10 lakh. But if actual is 15 lakh, if actual is 15, the 30 lakh divided by not 10 lakh, then it will be 30 lakh divided by 15 lakh. So first wale case mein it's 30 lakh divided by 10 lakh, rupees 3. Second wale case mein it's 30 lakh divided by 15 lakh, it's 2 per unit. Okay, next one, November 20 exam question. Pay attention. A company normally produces 1 lakh unit each year. Current year mein they have produced only 50,000. Acha, the normal is 1 lakh, actual is 50. I have to take whichever is higher. ठीक है. Variable manufacturing overhead is 100 per unit. Fixed production overhead is 1 crore. Fixed production overhead is 1 crore. 1 crore divided by 1 lakh I'll take. 1 crore divided by 1 lakh I'll take. It's 100 per unit that will be there. ठीक है. Now, selling expenses are not considered. Selling expenses are not considered while finding the cost of inventory. तो हो गया, it's simple. Okay, question number 9. Okay, question number 9. The full capacity is 10,000 labor hours. Unit नहीं दिया है, hours दिया है. Normal is 7500. Actual is 6500. Normal 7500, actual 6500. So fixed production overhead will be based on normal capacity 7500, actual 6500, whichever is higher divided by 7500. And fixed production overhead is 1500. So 1500 divided by not 65, it will be 75. It's 0.2 per hour. It's 0.2 per hour. Variable is basically 2600. 2600 divided by actual 6500. It's always based on actual. 2600 divided by 6500. It's 0.4 per hour. The fixed production overhead 0.2 per hour. Variable production overhead 0.4 per hour. ठीक है. Now, how many units you produced this year? Achha, I am producing 6500. I'm producing 6500. This is given to us. Now, opening inventory was 2500. Produced is 6500. Opening 25, produced 65. How many sold? Sold is 6700. Opening plus production minus sale. This is closing. So closing I have is 2300. Closing 2300 units. Hours nahi hai. Units. Now just try to understand. Actual unit produced 6500. Actual hours are also 6500. So in current year, actual labor hour 6500. Unit produced is also 6500. So can I say 1 unit requires 1 hour? 1 unit requires 1 hour. Okay, now inventory is 2300 units. It will require 2300 hour. How do I value it? The 2300 fixed production overhead is 0.2, variable is 0.4 into 0.6 kar do. 0.2 plus 0.4 is 0.6. So closing stock will be your inventory was 2500 plus 6500 minus 6700 is 2300. 2300 into 0.6 1380. ठीक है, तो basically what is your closing inventory? The closing inventory will come as total 2300 unit, and 1 unit needs 1 hour only. 1 unit needs 1 hour only, and the cost is 0.2 fixed, 0.4 is variable. Acha, if 1 unit needed 2 hours, so 0.2 and 0.6 is per hour. If 1 unit needed 2 hours, तो into 2 करना पड़ेगा. So over here it will come as 1380. 1380. Did you understand? Okay, moving ahead, what are not included in your cost of inventory? What is not included in your cost of inventory? The one, abnormal wastages are not included. Second, the storage cost, unless storage is a part of procedure to manufacture inventory. Agar storage is part of procedure to manufacture inventory included, but once inventory is ready, then we store it, that's not covered in cost of inventory. Admin overhead not included, selling and distribution not included, interest and finance cost not included unless it's a qualifying asset. Unless it's a qualifying asset. Okay? This all are not included in cost of inventory, so they will go directly to P&L. Now, coming to question number 10, trade discount deducted from cost of inventory, handling cost added to inventory. Salaries of account department, no, ignore. Sales commission is selling expense, ignore. After sales warranty is again selling expense, ignore. Import duty will be considered if credit not available. Cost of purchase include, freight include if it's an inward. Outward freight is marketing expense, not to be done. Insurance of purchase include, brokerage commission paid for indenting agent, clearing forwarding agent, that is to be included. Fine. Question number 11. Question number 11. There's a normal wastage 5%. See, abnormal wastage not to be included. Cost of normal loss is to be borne by other good units. So now total 5000 metric ton input cost is 1000 rupee. 5000 metric ton into 1000. Your total cost was 50 lakhs. 5000 into 1000, 50 lakh. So assume 50 lakh is not for 5000. 5% is normal loss. Assume 50 lakh is for 4750 unit, divided by 4750 unit, 5000 minus 5%. So per unit the cost is coming 1052. Per unit the cost is coming 1052. Now see, actual wastage is 300. So inventory is 4700. So 4700 into 1052 is coming under your inventory, and that 50 rupee abnormal into 1052, that will go in P&L. Clear? Question number 12. Okay, Girdhar Lal has a question, sir. Raw material storage cost, that is included in your cost of inventory if basically after purchasing raw material you have to store it for some time before using. Agar store karna zaruri hai before using, then it's included. If store karna was not necessary but you unnecessarily buy in bulk, then it is not included in cost of inventory. Okay, now 1st January 1, you got an order of 7000 custom made corporate gifts. Okay, raw material 5,50,000, 50,000 refundable taxes don't include, so 550 minus 50. Okay, purchase price was funded by a loan. Okay, 555 उसमें fund raise, loan raising fee 5000, loan raising fee will be accounted as per 109. ठीक है ना, आपने loan लिया, loan का interest will be capitalized only if it's a qualifying asset. Okay, design का cost added to cost of inventory. Team develop a technique and did some further modification. Testing phase, this is also included in cost of inventory. This is also included. Okay, February mein additional cost incurred. These are also included in your cost of inventory. Depreciation on plant used to manufacture, that is also included. Now they are ready for sale on 1st of March. No abnormal, what is the cost? So refundable taxes nahi lena, loan raising fee nahi lena, baki everything was just to be added, and it's assumed it's not a qualifying asset, so interest is not covered. Okay, next one is joint product by product. Imagine we incur a cost and now 2 products are coming out. we incur a cost and two products are coming out. So the thing is, whenever you're manufacturing butter ke saath buttermilk also comes. So that's joint product. So whatever cost you've incurred is to be split between the joint product on a rational and consistent basis. On a rational, consistent basis. See the wordings. Try to remember such wordings. So it is to be split between the joint product on a rational and consistent basis. How? How it is to be split? So one, you divide it in the ratio of what? Sales value at split off point, not the quantity, not the rate per unit. Sales value, quantity into rate. So sales value at split off point or sales value at completion of production. Achha sir, what about byproduct? So the thing is, if at all, when you are producing a byproduct is coming, so NRV of byproduct will be deducted from the total cost and the remaining cost will be distributed between the joint products. The NRV of byproduct are measured at NRV and it will be deducted from the cost of main product. Net cost is distributed amongst the main product. Okay, moving ahead. Question number 15. December 21 exam. Now check, we have, there's byproduct BP coming, two main product MP1, MP2 and plus some scrap. Okay, the byproduct BP, MP1, MP2, two main product and some scrap. Your total cost incurred is 355. Total cost incurred is 355. And now, total cost incurred 355. I'll deduct the NRV of byproduct first. So byproduct aapka hai total 2000 unit coming up and it can be sold at 20 rupee. But to sell at 20 rupee, I have to incur a separate processing charge 8000, packing charge 2000 and so I can sell at basically 20 rupee. So it's 2000 into 20, but usko karne ke liye I have to incur 8000 as separate processing charge and 2000 as packing cost. Profit 5 bhul jao. So I have to what is NRV? Estimated selling price. Estimated selling price 2020 minus estimated cost to complete the product. What is the estimated cost to complete the product? 8000 and 2000. So NRV of byproduct is 30. So out of 355, 30 remove it. Out of 355, 30 gone. Acha, 5000 you're getting from scrap, that also you remove it. 5000 you're getting from scrap, that also you remove it. ठीक है, तो net cost is 320 coming. 320 you divide between MP1, MP2. Sir, which value? Sales value at split off point. How do I find sales value? The output into rate. So whatever is coming, output into rate. 5000 into 60, 3 lakh. 4000 to 50, 2 lakh. 3 lakh, 2 lakh. So 3:2 mein it will be allocated. Ye 3:2 mein it is allocated. And then you find out per unit ka price into number of units lying in stock as your inventory. Next one, agriculture produce harvested. At the time you harvest, it's immediately valued as per Ind AS 41. Later on, basically Ind AS 2 will come. How do I measure the cost? Okay, cost ko measure karne ke liye cost formulas. Okay, if it's not ordinarily interchangeable, inventories which are not ordinarily interchangeable, all inventories are kind of different, you have to use specific identification method. So find out cost of each of the inventory separately if it's not interchangeable. But if it is interchangeable, then either you use FIFO or you use weighted average. Both of them are allowed. It's up to you which one you want to use it. Whichever you're using, it's basically your policy. Acha, inventory with different nature or use. A different cost formula can be used. Okay, so inventory, two types of inventory I have. Dono ka nature or use is different. I can have one as per FIFO, other as per basically your weighted average. Answer is yes. Okay, the checkout, inventory with different nature or use, you may use a different cost formula. A different location nahi. Location different nature or use should be there. Acha, standard cost method, retail method may be used for convenience if the result approximates the cost. Acha, so standard cost method wherein the inventory is valued directly at standard cost and the standards has to be revised periodically. Retail method is basically whatever is selling price, usme aapka gross margin nikal do. The selling price mein se remove your GP margin, the cost comes. So this method can be used for convenience if the result approximates your cost. And different nature or use, different cost formula may be justified. This is there. Okay, moving ahead. Question number 19. Question number 19. Okay, one of the company's product line is beauty products. They sell hundreds of different brands. Oh, we are selling different 100 brands. So, sabka cost nikalna might be very difficult. But the thing they are telling is over here, we have a gross margin 65% on each line. So, simple. You may use retail method, MRP minus 65%, you get the cost. So, that is how you can do it. Achha, you are selling handbags, you manufacture it on your own, you are doing it since last 50 years. So, आपका cost you will be kind of knowing. तो यहाँ पे you may go for standard cost method. ठीक है, first वाले में that is retail method, second वाले में you may go for standard cost method. Okay, NRV. What do you mean by the word NRV? NRV is nothing but your estimated selling price, less estimated cost to complete the product, less estimated cost necessary to make the sale. Estimated cost to complete will be only for WIP. And just remember one thing, NRV is different from fair value. Fair value is market participant based, NRV is entity specific. Fair value is market participant based, NRV is entity specific. ठीक है. Estimate of NRV are based on the most reliable evidences available when you are making the estimate. And if there are some normal market fluctuation, which are happening after year end, new product coming in, prices have gone down, it will be considered as an adjusting event. We did a question related to that under Ind AS 10. Fine, moving ahead. Okay, in this question, the inventory is at cost. Inventory is at cost 284,700. Inventory is at cost. Now there are 400 coats. Cost is 80 rupee. Normally sold at 150, but there's a defect. There's a defect, so they were all sold at 50%. So iska NRV, can I say 400 into 75 हो जाएगा? 30 and उसमें भी 5% I have to pay selling expense. So 28,500. Now cost was 32,000. NRV is 28,500. Cost is 32, NRV is 28,500. It should be at NRV, but we included it at cost. इसमें 32 included है. इसमें 32 है. It should be 28,500. तो 28,500 and 32 का difference 3500 I have to remove. यहाँ से 3500 remove it. ठीक है. Next वाले में 800 skirts of cost 20 each, 16,000. अच्छा, they were defective, so I have to do some working, kind of treat it as WIP. Okay, and they were sold at 28, तो 800 into 28, but उसमें 5 rupee expense लगा, तो 800 into 23 कर दो, 18,400, and there is there is also some expense called 800, तो 17,600 NRV. NRV 17,600, cost is 16, keep it at cost. तो first वाले में it was at cost, I have to bring it to NRV, 3500 to be removed. Second वाले में it is basically at cost, it should be at cost. So just 3500 to be removed, this is the answer. Okay, next question over here. Check out, we had certain inventory, cost was 10 million, expected selling price was 12 million, but due to market fluctuation adjusting event, now the price became 8 and 0.5 is for selling, so net 7.5. Okay, 10 cost, 7.5, 2.5 is a loss to be recorded. 2.5 is a loss to be recorded. Cost or NRV, whichever is lower. It's cost or NRV. It's not carrying amount or NRV, it's cost or NRV. Now, inventory unsold, market has become better. Market has become better and now NRV is 10.5. Okay, cost is still 10. So now 10 or 10.5, whichever is lower, bring it at 10. तो आपने जो 7.5 किया था, make it 10. The earlier 2.5 which you had written down will get reversed. Next point is NRV of raw material. Now see, raw material are not for sale. So raw material ke price is going down, as such we are not worried. Raw material ke price have gone down, we are not worried. How do I find NRV of raw material? See, if the finished goods in which raw material is used, if the finished goods in which the raw material is used is to be sold at or above cost, if finished goods is to be sold at or above cost, we are not going to have loss. So NRV of raw material is its cost only. The NRV of raw material will be at least equal to its cost. The raw material will be valued at cost. So as its NRV is assumed to be more than cost. But if finished goods in which raw material is to be used is sold at cost, below cost, तो finished goods in which raw material is to be used is sold below cost, तो कहने से loss होने वाला है. So now the NRV of raw material is its replacement price. NRV of raw material will be the replacement price. So it will be valued at cost or NRV, whichever is lower. NRV will be the replacement price. The finished goods are to be sold at or above cost. NRV of raw material is assumed to be above cost. NRV uska above cost hai, they will always be valued at cost. But if finished goods are to be sold at loss, the NRV of raw material will be the replacement price. Value them at cost or replacement price, whichever is lower. Fine, moving ahead. How do I compare cost and NRV? The comparison of cost and NRV is to be done on item by item basis. Like year 2000, 1900. So 1900. Year 5000, 5100, 5000. Item by item basis it is to be done, not on aggregate basis. Reversal of write down, you have written down inventory, value had gone down. If at all later on the value increases, you have to reverse the write down. Reversal will go in your PN. Okay. And recognition as an expense, whatever inventory is sold off, that will be recognized as an expense, and whatever inventory you bring it to NRV, that much also will be recognized as an expense, and if anything is reversed, that will be reversed from your expense. So what goes in expense? Amount of inventory sold, any write down, reduced by any reversal of write down. Reduced by any reversal of write down. Okay, question number 26. We have fabricated means prepared. So we have manufactured a special equipment as per customer's design. As per customer's design it is made. And now customer told us to withhold the delivery. Oh, customer told us that, sir, I am having financial difficulty, stop the delivery. Now, WIP made 85 lakh, finished goods made 55 lakh. These are goods not yet delivered. And already delivered, uska pending amount debtor is 65. Winding up petition is filed. So what did we do? We did a provision for this all things. Okay, now first of all, so WIP and finished goods, they are to be valued as per Ind AS 2. Now they are to be valued at cost or NRV, whichever is lower. The cost is this. Cost is this, NRV. If they are specially made for customer and uska NRV 0 hai, it can't be used anywhere else, then you are required to have expense of this much. But if at all you are able to get something, whatever you will be able to get something, the cost is this, NRV you find out, whichever is lower you value that way. And now, debtor you can make a provision, it's fine, absolutely. So assuming, see here, in absence of NRV, assuming cost is lower, you value inventory at 140. Alternatively, you may assume NRV is nil. You may assume NRV is nil, you show inventory 0 and full 140, you book it as loss only. And then debtors, yes, you have to create a provision. Then this is your Ind AS 2, moving ahead, Ind AS 16. This was Ind AS 2, moving ahead, Ind AS 16. Any doubts? Ind AS 2? Keep smiling, have lots of water and keep on replying. Thank you. Okay, moving on to Ind AS 16, which is on PPE. Ind AS 16, which is on PPE. Okay, first of all, this standard applies to all your PPE other than PPE classified as held for sale. Non-current asset, held for sale, it's covered under Ind AS 105. Achha, biological assets are not covered, but if it's a bearer plant covered under this standard. Bearer plant is covered under this standard. Now, what do you mean by the word PPE? PPE are tangible item. For intangible, we have Ind AS 38. So they are tangible item held for use in production or for supply of goods or services or for rental to others or for admin purpose, but and are expected to be used for more than one period. They are not held for sale in ordinary course. If they are held for sale in ordinary course, it becomes inventory. Okay. Now, someone asked me, sir, rental. If I have a property for rental, won't it come under investment property? Achha, land or building which is held for earning rental, investment property. Machine held for rental. Machine you give it on rent. The machine held for giving on rent comes under PP. So investment property includes only land or building. Okay. Bearer plant, the definition, biological asset is nothing but a living animal or plant. Bearer plant is what? a plant which will be there used for production of agriculture produce, which will give you fruit for more than 1 year, and we are not going to sell the plant itself. Plant is not for sale. The fruits will pluck and fruits is going to be sold. So mango tree, chiku tree, coconut tree, they are bearer plant. Investment property, it's basically a property held for earning rental. Property will be only land or building. Now, so if basically someone fulfills definition of PPE, does it mean that we show them as PPE? No. Just fulfilling definition will not work. To recognize or show them as a PPE, the recognition criteria also needs to be fulfilled. What are the recognition criteria? It's probable that future economic benefit will flow to the enterprise and the cost can be measured reliably. It's probable that future economic benefit will flow to enterprise and the cost can be measured reliably. Now, when to apply this recognition criteria? Whenever the costs are incurred, initially or subsequently, whenever they are incurred. Fine. What do we do for the day-to-day servicing cost? I bought an Activa, it's capitalized PP. Later on, I give it for basically servicing every 3 months or every 6 months. That is just to maintain the economic benefit. It will go in your P&L. Okay, replacement of part. Replacement of part. Part replaced, it is added to the carrying amount of PPE if recognition criteria met and the carrying amount of old PPE needs to be removed. Regular major inspection, it's treated as a replacement of part only. It will be capitalized. It will be capitalized. Acha, now question comes, sir, at what value do we record? ठीक है, तो when do we record? When recognition criteria are met. Now coming to what value do we record? We record initially at cost. Initially your PP is measured at cost. Subsequently you have a cost or revaluation model both. But initially it's at cost. Now how do I find out the cost of PP? The cost of PP includes the purchase price, non-refundable taxes. Credit available, it's not included. Credit not available, then included. Any cost attributable to bringing the asset to the location and condition necessary for capable of operating it in a manner as intended by management. See the wordings. Any cost directly attributable to bringing the asset to location and condition which is necessary for it to operate in a manner as intended by management. Okay? Plus, this is important. Initial cost of dismantling. Whenever I install a machine, after the useful life, I have to dismantle it. The initial cost of dismantling, whatever is going to come up, uska present value needs to be included. But if the dismantling cost or basically some other cost is related to production, like I have to do a site restoration, Now site gets basically damaged due to production. वो produce करेंगे तब site will get damaged. Then that site cleaning cost is due to that production. It will go in cost of inventory. So see, initial estimate of dismantling, removing or restoration at its present value include the obligation for which entity incurs other than to produce inventory. So imagine that site is getting damaged due to production. If site getting damaged due to installation of machine install kiya, site got damaged and now I have to repair it. I have to do it. So then that is covered under Ind AS 16. But installation pe site damage nahi hua. Now produce karte time site will get damaged. Then that will be getting covered under Ind AS 2 inventory mein. ठीक है. Plus, so this is cost में. The examples of directly attributable cost. So they have written a directly attributable cost. They have to be included. What are directly attributable costs? The employee cost related to construction, acquisition of PP, cost of site preparation, handling, installation, professional fee, cost of testing also. Testing cost is also included, and while doing testing, some product comes. Test करते करते भी product आया, उसको बेचा. So whatever amount is generated from sale of that product coming in testing phase, that gets deducted from the cost. Acha sir, cost of testing 100 rupee and product coming, I sold it at 120. So sir, extra 20. So full 120 deducted from PP only. The extra 20 which you got, that also deduct from PP only. It will not go to P&L. Earlier it was going in P&L. Clear? This is amendment over here. Okay, following are not included in your cost of PP. What is not included in your cost of PP? The inauguration cost, the advertisement cost, promotional activity which you do, staff training which you give, staff may go away. So uska future economic benefit is not there. The staff training, any general overheads, they are all not included in the cost of PPE. Now, self-constructed asset. Self-constructed asset, internal profit should not be there. Any abnormal cost is there, that should not be included. That goes directly in P&L. And now, if it's a self-generated, you capitalize interest. If there is a borrowing cost, you capitalize. If it's a qualifying asset. Qualifying asset is an asset which takes substantial period of time to get itself ready for use or for sale. And generally that substantial period is a period of 12 months. Okay. Now pay attention to this question, RTP November 22. Now you will have to incur 20,000 cost for restoration of site where a PP is located. Where a PP is located, आपको 20,000 site restoration comes. This item was used for manufacturing and the requirement of restoration came not due to fitting machine. Requirement of restoration was due to manufacturing. अच्छा, machine fit किया, damage हुआ, उसके कारण restoration covered here. But machine fit से it's not getting damaged, due to production it is getting damaged, that will get covered under Ind AS 2. So don't take the present value of 20,000 in PPE, no. So this is basically over here, based on above, it should be added to the cost of inventory. Okay, question number 3, list price of machine 80 lakh, import duty add karo, assuming credit not available, delivery add it, installation add it, pre-production testing add it. Maintenance you don't add. आपने purchase किया next 5 years के लिए, you taken a annual maintenance contract, that is not to be done. Trade discounts you deduct, settlement discount you ignore. Trade discount you deduct, settlement discount you ignore. Okay, question number 4. Purchase price of land is 30 lakh, stamp duty 2 lakh added, architect fee added, site preparation added. Material added, direct labor added, general overheads not to be taken. अच्छा, material में 1 lakh was spoiled, wasted, further 150 was faulty, तो 1 lakh and 150 removed from material. And उसके कारण work was stopped and 22,000 labor also is also related to that, that also removed from labor. Building got completed on 1st January, brought to use in April. Brought to use April में doesn't matter, you can capitalize interest only till January if it's a qualifying asset. So 1st April 2000, 1st January 1, 9 months. Okay, loan was 40 lakh, it meets the definition of qualifying asset, capitalize interest for 9 months. Clear che? Moving ahead, question number 6, I'm taking only the important ones. Okay, RTP May 22 question. January 1 you purchase equipment 6 lakh. उसमें refundable taxes remove it. There was a loan taken 6 lakh 5. In addition, loan raising fee ignore it. Loan raising fee ignore it. अच्छा, January 1 you incurred 20,000 for transportation, 1 lakh for installation, add it. Dismantling का present value 1 lakh, add it. Then for modification you spend this all, add it. Staff को training देना था, no, not to be included. Staff training cost not to be included. Then testing phase में whatever it is, add it. Equipment got ready on 1st March. When did you started? 1st January. 1st January, 1st March, 2 months only. 2 months only. So better is don't assume it's a qualifying asset. So interest not to be capitalized. So borrowing cost, assumed it is not a qualifying asset. Achha, there was one more point. Because of low initial orders, there's an operating loss 23,000 during March. Once it's ready, you started using, orders are less, machine is less used, there's a losses. Initial operating losses are not added to PPE, that will go in PL. Okay, payment deferred beyond normal credit terms. If the payment is deferred beyond normal credit terms, then in that case, the asset will be recognized at cash price equivalent. It's the cash price equivalent. For example, we are paying installment of 33333 over a period of 2 years. One today, one after 1 year, one after 2nd year. To find out the present value, cash price equivalent. So 3333, 1 today. So uska present value 1. 1 after 1 year, 1 after 2nd year. So 95 lakh. So you don't record PPE at 1 crore, you record PPE at 95 lakh. Okay, out of 95 lakh, day 1 I paid 33333. Now balance is 6166,667. Now interest accrued, I paid something closing, again interest accrued, I paid something, closing. So PPE is recognized not at 1 crore, it's at cash price equivalent. Okay. Incidental operation. Now, while my building is getting constructed for own use, it's not for rental, building for rental, investment property. So while my building is getting constructed, what did I do? I used that plot as, basically gave it on rental as parking plot. तो उसको मैंने रेंट पे दे दिया पार्किंग प्लॉट की तरह. That's basically incidental operation. Incidental operation, the revenue related expenses go in P&L. They go in P&L. Okay, when should I stop capitalizing? When should you stop capitalizing? Asset is capable of operating in a manner as intended by management, even though it's not yet brought to use. Whether brought to use or not doesn't matter. It's capable of operating in a manner as intended by management. ठीक है? So that day I should stop. It should cease when the asset is in a location condition necessary for it to be capable of operating in a manner as intended by management. Fine. Now comes exchange of asset. Okay, I get one PPE by exchanging another asset. So exchange of asset. So machine acquired, car given. Machine acquired and I gave a car. So machine acquired, machine coming in, how do I value it? How do I value it? So they are telling it will be measured at the fair value of asset given up unless the fair value of asset given up cannot be clearly determined. So PP acquired in exchange for another asset is measured at fair value. Acha, fair value kiska? So just see, I don't know fair value of your asset. Whatever I gave you, I'll be knowing fair value of my thing. So machine acquired, I gave my car. So car ka kitna fair value, I'll know it. So it will be at the fair value of asset given up, unless the fair value of asset received is more clearly evident. So PPE coming in upon exchange, recognize it at the fair value of asset given up, unless the fair value of asset coming is more clearly evident. Acha, you recorded fair value, but there's an exception to it. Achha, if the fair values can't be determined, imagine fair value determined in your, or a transaction lacks commercial substance. If exchange lacks commercial substance or fair value cannot be determined, then in that case it will be recognized at the book value of asset given up. If transaction lacks commercial substance or the fair value of both asset given up coming in, fair value can't be determined, then the asset coming you record it at book value of asset given up. तो asset जो गया उस same book value से you record the asset coming. ठीक है. Now check question number 9. And now when do I say it has a commercial substance or it lacks commercial substance? The transaction has a commercial substance when the configuration of cash flow, the risk, timing, amount of cash flow, the configuration of cash flow from the asset which is received significantly differs from the asset which I am exchanging. तो मशीन से जो कैश फ्लो आएगा एंड कार से जो कैश फ्लो था उसमें बहुत डिफरेंस है. और द एंटिटी स्पेसिफिक वैल्यू इज प्रेजेंट वैल्यू ऑफ व्हाटएवर बेनिफिट्स आई एम गोइंग टू गेट. द एंटिटी स्पेसिफिक वैल्यू इट्स अ पोस्ट टैक्स बेनिफिट व्हाटएवर आई एम गोइंग टू गेट फ्रॉम यूज ऑफ एन एसेट एंड इट्स डिस्पोजल is significantly different compared to the fair value exchange. So entity specific value of the asset coming is significantly different from the fair value of asset exchanged. ठीक है. तो if any of this kind of thing is there, transaction has commercial substance. But I exchange my i20 car with your Maruti Swift car. यार उससे कैश फ्लोज में कोई फर्क नहीं पड़ेगा, तो वहां पे ट्रांजैक्शन लैक्स कमर्शियल सब्सटेंस. तो i20 car given, Maruti car coming, transaction lacks commercial substance. So i20 car given, Maruti car coming will be recognized at book value of asset given up. If it lacks commercial substance, वो book value पे ही आ जाएगा. If it has a commercial substance, then the asset coming is recognized at fair value of asset given up. Are you clear? Are you clear? These two questions are fine. Okay, next one is measurement after recognition. Day one we recorded at cost. Now what do I do subsequently? Okay, subsequently you have two options. One is a cost model or a revaluation model. But you need to apply, if you're going for cost model, the entire class को same thing. Class means all machines cost model. All your land, you have revaluation model. Chalega. It's not all PP, entire class of that PP. Furniture, so all furniture should be under same way. That way it is to be there. So examples of separate class is given under your cost model. Under your cost model, it's basically cost less accumulated depreciation, less accumulated impairment. Under your revaluation model, you would have revalued. So fair value on the date of revaluation. Revalue किया, उसके बाद का subsequent accumulated depreciation, subsequent accumulated impairment loss, that comes the carrying amount. Achha, whenever you're revaluing, the entire class of PP to which it belongs is to be revalued. Okay, do I need to do revaluation every year? Answer is no. Revaluation should be made with sufficient regularity that the value in books and uska fair value doesn't differ much. तो if at all वहाँ पे बहुत volatile है, you do it annually. Volatile नहीं है, you may do it once in 3 years, 5 years kind of. Okay. Moving ahead, accounting treatment of revaluation. Okay, how do I have a accounting treatment of revaluation? If you do upward revaluation, first time upward revaluation goes in OCI. Downward revaluation goes in P&L. Acha, subsequent. Acha, first time was upward. First time upward, again upward goes in OCI. But now downward. Now downward, to the extent balance is there in OCI, debit OCI, extra downward will go in P&L. Achha, subsequent is downward. Subsequent, when first time was downward, first time downward tha. Now again downward, again P&L. But now upward, so to the extent it was taken in P&L, credit P&L, extra you credit OCI. OCI में याद है revaluation surplus ऐसा लिखते थे. Okay. Next, presentation of revaluation. This is important. How do I present the revaluation? There are two techniques. Gross, accumulated. Both are adjusted accordingly. Imagine there's upward revaluation. So gross block as well as accumulated depreciation, both are proportionately increased. So gross block, accumulated, both are proportionally increased. That's one option. Second option is you remove the accumulated depreciation fully. Second option mein, what do? You remove the accumulated depreciation fully. So accumulated depreciation gone. Machine will be at net value. अब उसको revalue करो. So now accumulated is completely gone. So first वाले में cost as well as accumulated both are increased. Second वाले में accumulated is gone. Now only cost will be there. That is the second model and you revalue it. Revaluation gain will go in your OCI. ठीक है. Now once the asset is disposed of, so revaluation gains have gone in OCI. Revaluation surplus means accumulated over there. Now once that asset is disposed of from OCI, it will be transferred to retained earning because it's item not reclassified to P&L. Achha, one more thing, this standard says you may see once you revalue a PPE, can I say depreciation will be on revalued amount? The amount equal to the additional depreciation. You may transfer it from revaluation surplus to retained earning. Depreciation goes in P&L. So now it's revalued, depreciation will be on more amount, that will go in P&L only, but amount equal to additional depreciation, you may transfer from revaluation surplus to the retained earning. It's not mandatory, it's merit. Okay. Moving ahead, question number 14. Now check out over here. Gross block 200, accumulated depreciation 80, net is 120. Now you revalue to 150. Okay, so can I say 120 becomes 150? The same way, gross, accumulated, both you increase proportionately. So 120 becoming 150, the 200 should become 120 becomes 150, the 200 should become how much? Same way, 120 becomes 150, the 80 should become how much? That way you do it. So gross block 200 becomes 250, 80 becomes 100. So 200 becomes 250 and accumulated depreciation becomes 100. So 250 minus 100, it became 150. This is technique 1. Achha, technique 2, remove accumulated depreciation fully. Achha, the accumulated depreciation 80 goes away. Now asset will become 120. Asset becomes 120. You revalue it, make it 150. So now we have 30 rupee upward revaluation, which will go in OCI. Now cost 150, accumulated nil. Now cost 150, accumulated nil. तो सेकंड मेथड में it will be cost 150, accumulated nil. तो gross carrying amount restated 150, accumulated will be 0. Now depreciation. How do I give depreciation on your PPE? Component approach to be used. If any component of PPE has a life which is shorter than the PPE, if any component of a PPE has a life shorter than PPE, that component should be depreciated over that life. And all remaining is general. So component wise it is to be done. Land and building you bifurcate because land has unlimited life, not to be depreciated. Building has a limited life, it is to be depreciated. तो उसको अलग करना है. Question number 16 was a good one. Pay attention. Okay, in your question number 16, MS Limited has a machine costing 1 crore with no breakdown. आपने component अलग नहीं किए थे, तो you depreciated everything together. Useful life 10 years. So can I say 1 crore I depreciated over 10 years, no component. At the end of 6th, so 6 years में I would have given a depreciation 60 lakh. Carrying amount currently is 40 lakh. Carrying amount is 40 lakh. ठीक है? Now, you need a replacement of turbine. So actually, turbine ka life was 6 years, but you did not follow component approach. Now you are having a new turbine. The cost of new turbine you add it. Cost of new turbine you added, and previously you were depreciating turbine for 10 years, and now 6 years के बाद replace कर रहे हो, तो carrying amount of old turbine you need to remove. The cost of new turbine is 45 lakh. Discount rate is 5%. So now, what was the old turbine included in this? I don't know. What is the old turbine included in this? I don't know. So do one thing. Based on new turbine's rate, find out the old turbine. New turbine today is 45 lakh. So 6 years before, the old turbine would have been how much? So based on new turbine's cost today, discount rate 5%, the old turbine on day 1 was 3357. And we depreciated in 10 years because componentization was not done. So उसमें 6 years gone. So उसमें depreciation we gave for 6 years, 6 by 10. So this is the carrying amount of old turbine. The new turbine 45 lakh you add, and old turbine ka carrying amount you remove. Now balance, this is the value, and this is to be depreciated over remaining 4 years. The only point was new turbine will be added to machine, but अब जो old turbine है उसका some carrying amount is there that you remove it. It was basically spread over 10 years. उसमें 6 ही गए थे ना, तो there is some, we were depreciating in 10, तो उसमें some value was still lying that needs to be removed, and old turbine का cost is found out based on the value of new turbine today and the discount rate given. Clear? Question number 17, you bought some land, legal cost 1 million, add it, leveling, add it, material, add it, employment cost of worker, add it, 2 lakh per month depending on how many months the work has gone. Overhead directly related, add it, ongoing overhead allocated, no. Income from temporary use, it's an incidental operation, goes in P&L. Cost of relocating employee, no. Opening ceremony, no. Factory got completed in November. Achha, when did we start? 1st May. 1st May, 30th November it got completed. May, June, July, August, September, October, November. 7 months. 7 months. It got completed. Depreciation starts from December. Achha, useful life is 40 years. However, roof needs a replacement after 20 years. So when I say roof is to be depreciated over 20 years, and roof is 30% of building. Achha, now whatever your total value comes, ये जो आपका total value आ रहा है ना, उसमें land was 10,000, keep it separate. Land was 10,000, keep it separate. Remaining building में roof 30%, 70% other building. तो पहले तो land अलग कर दो, land is non-depreciable. Okay, roof 30% in building, remainder 30% roof depreciated over 20 years, this is depreciated over 40 years, and this year में it's only for 4 months. तो ये 20 years, ये 40 years, but this year में it's only for 4 months. Clear? Okay, next, depreciation normally goes to your P&L, that is fine. What is a depreciable amount? You don't have to depreciate the entire cost. Depreciable amount is cost minus the residual value. And depreciation period is basically the basically your useful life. The depreciable amount is to be allocated on a systematic basis over the useful life. Okay, now going to important question. Commencement of depreciation. When should I start depreciation? When the asset is available for use, means capable of operating in a manner as intended by management. Capable of operating in a manner as intended by management. When should I stop depreciating? When should I stop depreciating? कब stop करेंगे? तो one, when asset is sold off, derecognized. आपने जब derecognized, or asset is classified as held for sale. Whenever you classified as held for sale, now onwards it's valued as per 105. Depreciation is stopped once it's classified as held for sale. Okay, moving ahead. Depreciation method. The method should reflect the pattern in which the economic benefit are expected to be consumed by enterprise. The method should reflect the pattern in which the economic benefits are expected to be consumed by enterprise. You may use any method, SLM, WDB, unit R method, कोई भी use करो. It should reflect the pattern in which benefit is going to come. If benefit is going to come equally, go for SLM. Benefit is going to come in declining mode, go for WDB. It should reflect the pattern. वो ध्यान रखना है. Depreciation based on percentage of revenue, not appropriate. Percentage of revenue is not appropriate. Okay, you have a machine, output is consistent year to year. So can I say output consistent year to year? SLM में जाओ. Maintenance cost will increase and every 5 years के बाद new machines will come. That all will affect the useful life. वो useful life को affect करेगा. Maintenance, how many time के बाद technological obsolescence will come. वो useful life affect. But benefit is expected, even go for SLM. Okay, method of depreciation, whichever you selected, you have to review it annually. And if at all you feel the expected pattern in which benefit is coming is changing, though initially we thought benefit will be equal, now we feel benefit will be declining, to switch over from SLM to WDV, it will be regarded as change in accounting estimate. It will have a prospective effect. Next, question number 25. This was basically asked in November 19 exam. You are setting up a refinery outside the city limit. Refinery outside the city limit. So from city to your factory, you are constructing a road. Now others can also use the road. The question arises, the cost of the road, can I capitalize? So you are building a factory here. Factory mein road nahi hoga, there will be problems. So you are constructing a road from city to the factory also. So whether I should capitalize it or not. Ind AS 16 doesn't tell you what constitutes an item of PP. They don't tell you. Now railway siding, roads, bridges are required to facilitate the construction of refinery and uske operations may be later on. Expenditure, they are going to give you economic benefit. Project as a whole, आपको economic benefit मिलेगा due to that road. Even though you cannot restrict others, others को restrict नहीं कर सकते, but still, and it is basically, so this expenditure is directly attributable to bringing the asset, refinery, to location and condition which is necessary for capable of operating it in a manner as intended by management. So how management wants to operate that refinery, उसके लिए road चाहिएगा. ठीक है. So individually, okay, I can say this expenditure, but it will be a part of overall project, included in the cost of refinery only. Included in the cost of refinery only. Now how do I depreciate? So if uska road ka useful life is different, depreciate over its life. Otherwise, it is to be depreciated over the life of overall refinery only. Okay, next one, question number 26. Next is question 26. Okay, they have 3 property. All are purchased on 1st April 16. Now, factory, this is property. This is 1, 2 and 3. This is factory, this factory, let out building. Let out building will be investment property. अच्छा, यहाँ पे for factory, you follow cost model, revaluation. No. Both factories you have to have a same. Either both के लिए cost or both के लिए revaluation. Now, management presents all 3 property as PPE. No, third one is investment property. Management does not depreciate telling the fair values are higher. No, even though the fair values are higher, depreciation is required. We are not concerned with the fair value. If the residual value is more than carrying amount, if residual value is more than carrying amount, then depreciation will not be required. Fair value is of no use here. ठीक है? And evaluate the accounting policy. Is it correct or not? Answer is no. तो क्लासिफिकेशन में गलती है, सेकंड वैल्यूएशन में, फर्स्ट एंड सेकंड बोथ हैज टू बी एज पर either cost model or revaluation model, it cannot be different. Property 3, cost model, investment property, only cost model permitted. Then treatment of depreciation is also not wrong, rectified presentation is given to you, fine. Okay, this question 27 is simple, not difficult, I'm moving ahead. Only thing over here, due to revaluation, the depreciations are changing. And last में when you are selling it off, यहाँ पे amount equal, अच्छा, this is okay, this is basically the next one, चलेगा, leave it. Now, impairment, we have a separate standard, Ind AS 36, we'll come to it later on. Now coming over here, compensation for third parties for PPE. Okay, but PPE destroyed by fire, insurance company is going to give you some claim. PPE destroyed by fire, insurance company going to give you claim. That insurance claim receivable, book it as a separate asset. Insurance claim receivable, book it as a separate asset when it becomes receivable. Approve ho tab. When it becomes receivable, that is when it is approved. Did you understand? Okay, now Girdarlal has a question, sir, can we deduct temporary income from investment of loan proceed? Dear, investment of loan proceed, money coming in, wo deduct ho gaya from that interest only, and the remaining interest is capitalized. Did you understood? So imagine I had taken a loan for construction of a building, till the building got constructed, in between the loan money was temporarily invested. So now what happened is the temporary investment income, whatever it came out of your total interest, that you deduct, remaining interest you capitalize. Okay, compensation from third party you record only when they become receivable. Check this question. Your machine got damaged in fire on 31st January. Your claim is approved on 31st March. So book a loss on 31st January. Loss kab book karoge? 31st January. But the compensation, insurance claim receivable, book it on 31st March. So January में bank debit, P&L debit to PP. And March में insurance claim receivable to P&L. Now, derecognition, when should a PPE be removed from your books? One, when you dispose it off, and second, when no future economic benefits will be there. Now, whenever you dispose it off, whatever is profit loss coming on disposal, profit loss on disposal always goes in P&L. Even though it was a revalued amount, profit loss on disposal goes in P&L. Acha, once the profit loss has gone in P&L, PPE gone, तो related revaluation surplus, अब उसका कोई revaluation surplus पड़ा है, that you transfer it directly to retained earnings. Okay, next point, the last point of this standard is changes in existing decommissioning or restoration liability. Changes in existing decommissioning or restoration liability. Okay, now pay attention. See, we know that on day one, the estimated cost of restoration was booked as a liability in your book. So whatever estimated cost of restoration will come up at the end, uska present value was included as liability in your book. Now it is possible later on that may change. How to account for the change in existing decommissioning or restoration liability? Achha, liability may go up, liability may go down. Achha, asset might be carried at cost or asset might be at per revaluation model. Achha, imagine asset is at cost. Liability going up is a loss added to the cost of asset. Liability going down is a profit deducted from the cost of asset. If liability goes up, added to PP, liability goes down, deducted from PP. And now, subsequently, the depreciation will also change. Did you understand? This is if asset is carried as per cost model. Achha, if asset is carried as per revaluation model, liability going up is a loss, treat it as revaluation decrease. Liability going down is a profit, treat it as revaluation increase. If liability goes up, it's a loss, treat it as downward revaluation. Liability going down, it's a profit, treat it as upward revaluation if the PP was as per revaluation model. Okay, the check question over here. PP is 100 million. There's a restoration to be done at the end of 5th year. Estimated was 5 million and discount rate 8%. So We are estimating 5 million at the end of 10th year. Uska present value would be included in PPE. So in PPE, we have included the present value 2.32. So can I say now PPE is 102.32? PPE is 102.32. Okay. Determine the carrying amount of PPE decommissioning liability every year when there is no change. कोई change नहीं है. ठीक है, तो PPE 102.32 depreciate over 10 years SLM. ये हो गया. This is simple. अच्छा, decommissioning liability was 2.32. Interest accrues. Now it's this. Again interest accrues. Now it's this. So within 10 years it will become 5 million and then 5 million will be paid. This is when there is no change. अच्छा, now second question. At the end of 4th year, अब change आया. You expect that estimated outflow at the end of useful life will not be 5 million, it will be 8 million. Achha, so now I feel at the end of 10th year, it will not be 5 million, it will be 8 million. Okay, now you started booking based on 5 million, present value was included. कब आपको change आया? After 4 years. अच्छा, तो my decommissioning liability was 2.32. Interest accrued, it's this, again interest accrued, again 4th year end, now the liability is 3.15 in book. Now the liability is 3.15. Now tell me, should it be 8? No, 8 not today. 8 not today, at the end. 8 कब आएगा? Today in books is 3.15. Today in books it is 3.15. 8 will be at the end of useful life. End of useful life is 10 years. This is currently 4th year end. So can I say after 6 more years? I have to pay 8 rupee after 6 more years. I have to pay 8 rupee after 6 more years. So uska present value. So 8 is to be paid after 6 more years. Uska present value 5.04. The liability in your books today should be 5.04. It is 3.15. So liability should be 5.04. It is 3.15. The difference 1.89. Liability going up. Liability going up. It's a loss added to the cost of asset. The entry will become PPE debit to provision for decommissioning. 1.89. So it was 3.15, add 1.89, now it becomes 5.04. Now 5.04, interest accrues on 5.04 and now after 6 years it will become 8. Clear che? So now onwards, the PPE also got changed, 1.89 added over here and this was 3.15, usme 1.89 added and accordingly the tables are changed. Okay, next question number 30. Okay, entity as a nuclear power plant related decommissioning liability. You started on 1st April, useful life is 40 years. Initial cost was 1,20,000, which included a decommissioning cost of 10,000. Already present value was included. What is 10,000? 7,400, which is to be payable after 40 years. 7,400 जो आपको पे करना after 40 years उसका present value. ठीक है. Now ये 1st April 1 था, 31st March 11 after 10 years. After 10 years, the net present value of decommissioning liabilities decreased by 8. अच्छा, तो liability was 10,000. Every year interest accrues. 10 years तक interest accrued on that. 10 years तक interest accrued on that. So into 1.05, 1.05, 1.05, 10 years tak. So now liability in books is 16,300. Now liability in books is 16,300. It's reduced by 8,000. Directly given. Liability going down. Deducted from cost of asset. So liability debit, PPE credit. So liability debit, PPE credit. Okay, now PPE, it was started with 120, 10 years ka depreciation, 90 ho gaya. Now PPE mein 8,000 gone. So now 82 is to be depreciated over remaining 30 years. Depreciation changes. Depreciation changes. And from 16,300, 8,000 liability goes down. Now liability becomes 8,300. Now the interest will accrue 8,300 ka 5%. 8,300 ka 5%, 415. Third question is fine. It is basically on revaluation that you can do on your own. This is your PPE. This is your PPE. Moving on to the next one, intangible asset. This is PPE. Moving to the next one, intangible asset. Now under intangible asset, majority things will be similar to PPE. Only thing our definition etc. different, but accounting. वो initially at cost, subsequently at cost or revaluation model, many things will be kind of similar. Okay, so let's begin. First of all, what do you mean by the word intangible asset? Come directly to definition. What do you mean by the word intangible asset? It's an identifiable non-monetary asset without physical substance. Identifiable non-monetary asset without physical substance. Now, when do I say it's identifiable? The intangible asset is identifiable if it meets either of the following criteria. Either it arises out of a legal right or a contractual right, or it is separable, capable of being sold, exchanged, rented on its own or together with the related asset or liability. So, identifiable non-monetary, the value to be received is not fixed, without physical substance. तो identifiable कब बोलेंगे? Either it is separable or it arises from contractual or legal right. Any criteria fulfilled, we say it's identifiable. Non-monetary is amount to be received or paid is not fixed. How much I'll get on selling it, I don't know. Now, to be an asset, asset के लिए can I say asset is a resource controlled by an enterprise? वो हमारा control होना चाहिए. Now, control is basically a power to obtain future economic benefit, restricting others to use it, and generally that power, I can only have this design, others cannot have it, patent. So, wo generally is from a legal right. However, having a legal right is not necessary condition for control. ठीक है. Now, tell me one thing. If I give training to staff, I'll get future में more economic benefit, staff will work well, but would I be able to control them? No, they may leave. तो वहाँ पे you don't have a control over them. Then in that case, you can't record it as an asset. The staff training cannot be recorded as an asset. ठीक है. Customer relationship. I have a customer relationship. I can influence the decision. I'll be getting future economic benefit. That can be recognized as an asset. Satisfied customer. वो intangible asset है. ठीक है. Now check this question. You have recruited a player. As per the contract, player is prohibited from playing for any other entity for 5 years. The player has to pay for you only. He cannot play for anybody else for 5 years. The price which you have paid is derived from the skill and fame of the player. You will use the player in matches. So whatever money you have paid for the player, can you capitalize as an intangible? Answer is yes. See, here the player cannot leave you for 5 years. So here whatever money you paid for securing that rights of the player, that can be capitalized. So answer is yes. Recognize the cost incurred to obtain the rights of the player. An asset is something which gives you future economic benefit. Future economic benefit can be by way of a revenue, cost saving or some other benefit also. Third, without physical substance, so cannot be seen, cannot be touched. Sometimes suppose a software comes in a CD, but CD ka cost is negligible. So ignore it. Achha, laptop comes with a pre-installed software. So if case you are able to bifurcate tangible, intangible, bifurcate, or else substantial portion kiska hai, take it that way. Take it that way. Now, when do I record an intangible asset? Same as Ind AS 16, when it's probable the future economic benefit will arise and the cost can be measured reliably. When to basically measure the cost? Initially, subsequently, kabhi bhi tab you need to check this recognition criteria. Acha, this standard clearly says what happens? Most subsequent expenditure related to intangible are to maintain the economic benefit, so they will go in P&L. They've clearly said subsequent expense on brand, masthead, publishing title, customer list, etc. are always recognized in P&L. So यहाँ पे generally subsequent expenditure on intangible will not be there. वो होता है to maintain the thing, that why it goes in P&L. Fine. Measurement initially at cost. How to have the cost similar as your Ind AS 16. I'm not going into that. Okay, come to question 7. You acquired a software 10 lakh. Amount payable 6 lakh immediately, 4 lakh after 1 year. 4 lakh after 1 year, take it at its present value. Purchase tax include if it's not credit not available. Entry tax recoverable hai, don't include. Legal fees include, consultancy include, done. Okay, now acquisition is part of business combination. If a intangible asset comes under business combination, it will be recognized at its acquisition date fair value, provided it's an identifiable intangible asset. It will be recognized at its acquisition date fair value, and it doesn't matter whether the other party had recorded it in their books or not. उनकी book में था नहीं था, it doesn't matter. ठीक है, तो check over here. These questions are based on business combination already done. So you paid 50 lakh for 100% in Sun India Limited. Unke net assets are 30 lakh. In addition, they had a right. Trademark valued at 180. Sole distribution right. Usme se the cash flows will come 150 for next 6 years. ठीक है, तो trademark can also be recorded. Sole distribution right, they are also both identifiable. Both is to be recorded. So I paid 50 lakh. What I am getting? 30 lakh के normal net asset, trademark worth 180, and ये जो sold distribution right 150 6 years तक I'll get उसका present value. So these are the net asset coming. Difference is goodwill. They're identifiable. That's why they're recorded separately from goodwill. Next, if a government grant we are getting, it will be deducted from the asset. That will be covered under Ind AS 20. Exchange of asset, intangible asset acquired, other asset given. Intangible asset acquired, other asset given. How do we measure it? Same as Ind AS 16. I'm not doing it. Same as Ind AS 16. I'm not doing it. Okay, moving ahead. Internally generated goodwill. They're telling internally generated goodwill will not be recognized because we don't know how much we have spent for it. So that is not to be recognized. Now, internally generated other intangibles. It's not goodwill, other intangible, internally generated. They say there are two phases, research and development. Research phase, the cost goes directly to your P&L. Development phase, the cost can be capitalized subject to how many conditions? 6 conditions. So research always goes in P&L because research say future economic benefits are not probable. So recognition criteria not met. Achha, development phase, once the technical feasibility is there. Once technical feasibility is there, we call it as a development phase. Development phase, it can be capitalized subject to 6 conditions. Which are the 6 conditions? Technical feasibility is there. Intention to complete is there. Ability to use or sell after the completion, that is there. It will generate future economic benefit. Availability of technical, financial, other resources are there, and you can measure the cost reliably, what you have spent for it. Then and only then you can capitalize it. Now, pay attention. If you're not able to bifurcate research and development, treat fully as research. Now, research phase cannot be capitalized, but in-process research comes under business combination. So, business combination mein in-process research is coming, then that can be capitalized. Reason? You acquired that in-process research, so it's identifiable. Number 2. It will give you economic benefit. How? How it will give you economic benefit? In process research, you have done some research, you have spent 500 crores. Now I get your research, so I understand I don't have to spend that 500 crores now this way. In process research coming under business combination will be recorded at its acquisition date fair value. The in process research coming under business combination, recorded acquisition date fair value. Then you continue research, that will go in P&L. Then you start development, that can be capitalized subject to 6 conditions. Okay, so check out in process research coming under business combination can be recognized as an asset at its acquisition date fair value. It will give future economic benefit by way of cost saving. We don't have to spend the same amount again. Okay, question 11, if you just check out, यहाँ पे they have written after establishing technical feasibility. So after establishing technical feasibility, that is a development phase that can be capitalized. So this two testing also, yes, can be capitalized. Other things will not be capitalized. Okay, question number 12, good one. Question number 12, good one. In process research comes under business combination. Okay, the PC is 50 lakh. And net assets tangible are 45. In process research comes, I can capitalize it, I can record in my book. So 45 tangible plus 10, 55. 45 tangible plus 10, 55. You paid 55 is capital reserve. ठीक है. Now 10 you have capitalized. Further you spend 5 lakh on research, not capitalized. Further 2 lakh to establish technical feasibility, not capitalized. And then 7 lakh after technical feasibility, a development that can be capitalized. So first you capitalize 10, then this 2. Further you do research, वो capitalized नहीं होगा. In process research can be capitalized. ठीक है. Question number 13. Okay. 1st April to 31st December was research phase, goes in P&L. This development phase 900 is capitalized. Recoverable amount is 1000, no impairment. Recoverable is 1000, no impairment. Now further development you have done 900 plus 6000. The total now 6900. Total now 6900. ठीक है. Total now is 6900. And 6900 हो गया. Now it's ready for use. You start depreciating or amortizing from 1403. So 1403 में you started amortizing. March 3, this is the value. Recoverable amount given is 5000. The 750 will be the impairment loss that time. Okay, understandable. Question 14 is a good one, many times asked. Question 14 is good one, again related to business combination kind of. Pay attention, lots of water keeps you fresh. Every 15-20 minutes a sip of water, and if you're getting bored, not able to concentrate, shake yourself. Chalo. Okay, now coming under question number 14, you acquired 100% shares of ABR. PC is 35. PC is 35. Net assets are 15, but it doesn't include following. Net asset 15, it doesn't include following. अच्छा, there's a patent owned by ABR, remaining life 8 year. Consultant estimates उसका fair value is 10 crore. So we need to include. We need to include. Okay, see, successful drug है वो. So we need to include acquisition date, fair value. The 10 you add it in net asset. अच्छा, clinical outcomes are awaited. If they are successful, then it will be 15. See, today clinical outcomes are not yet there. तो उसको भूल जाओ. So today you take it at 10. Next. They have developed and patented a new drug which is already approved. Cost is 12 and now uska market value is 20. Include it at acquisition date, fair value 20. To add 20 in net asset. Third, they received some favorable inspection from government department. Government gave you one license free में. अच्छा, government giving you a license free में, entry will be license debit. License debit to deferred government grant at the fair value. The fair value is basically 10. So basically entry is what? Entry क्या हुई इसकी? License debit. Add it in net asset, and deferred government grant will be a liability. It will go to income over a period of 5 years. So in liability also 10. So add 10 in asset, add 10 in add 10 in liability. Net asset the impact will be 0. So net asset was 15 plus 10, 25, 25 plus 20. 25 plus 20, 45. 45 we paid how much? 45 की जगह we paid how much? 35. 10 rupee will be your capital reserve, gain on bargain purchase. Okay, recognition of expense similar to your PPE. Moving ahead, this is advertisement, fine. Measurement after recognition. After recognition, either you have a cost model or a revaluation model, same as Ind AS 16. Moving ahead. How do I treat revaluation? Same as Ind AS 16. Presentation of revaluation, same as Ind AS 16. I told you, majority content यहाँ पे is kind of repeated. So that all I'm leaving. Now coming to the useful life. Now coming to the useful life. Okay, useful life of a intangible can be either finite or infinite. या तो finite life है और infinite. Okay, if it has a finite life, I need to amortize it over the useful life. If it has an infinite, it is not to be amortized. So intangible with a finite useful life amortized, intangible with indefinite useful life is not amortized but is tested for impairment. उसको impairment के लिए test करना है. अच्छा, when I am deciding the life, whether it's finite or indefinite, okay, so imagine there's an intangible patent you got for 10 years and you can renew it. After 10 years you can renew it, and renewal is at very minor cost. If renewal is without significant cost, you can consider the renewal period also in useful life. Okay, so check out. The useful life shall include the renewal period if it is basically without significant cost. But if cost of renewal is significant, then don't include it. If cost of renewal is significant, then don't include it. Okay. Intangible with a finite life, the depreciable amount is to be allocated over its useful life on a systematic basis. Okay. Residual value, nothing given, we assume it's 0. For intangible, the residual value is assumed to be 0 unless there is a commitment by the third party or there's an active market. There's an active market for the intangible asset from where we are able to get the residual amount. So unless there's a commitment or there's an active market. ठीक है, active market है, वहाँ पे उसका value is available and that active market is probable to remain till the end of useful life. Fine. The residual value, you need to review it once in every year, and if there's a change in residual value, you account it as change in accounting estimate. Same way the useful life also needs to be. उसका जो useful life है उसको भी आपको review करना है every year. Change in useful life is basically a change in accounting estimate. When to start amortizing, just leave amortizing, it's all same as Ind AS 16. Moving ahead. Now check. Your broadcasting license for 10 years, which is renewable every 10 years. It's at a little cost. It's at a little cost. And there has been, you already renewed twice. You already renewed twice and it can generate cash flow indefinitely. If it can generate cash flow indefinitely, I'll keep on renewing also. So it has an indefinite life. यहाँ पे indefinite life. And next one, the authority decided now they will no longer renew. Okay, now they have decided they are no longer going to renew and now it will expire in 3 years only. Okay, now they are no longer going to renew it. Now uska useful life is 3 years only. So now it is becoming finite, it is 3 years only, but before that, unlimited life tha, now finite ho gaya. Pehle, future mein unlimited revenues were going to come. Now only next 3 years it's going to come. So first test it for impairment also. So immediately test it for impairment and now it will be amortized over remaining 3 years. Fine. Method of amortization same as Ind AS 16. Moving ahead. Okay, this question is fine, not difficult. Indefinite life is fine. Impairment is already done. Okay, coming to question number 25. Coming to question number 25. Okay, you purchased a patent on 1st April 1 for how much rupees? 3 lakh. The legal life is 15 years. But according to you, legal life 15 years, but you will be able to use only for 5 years, amortize over 5 years. SLM method is used. Acha, 1st April 2, management is uncertain whether I'll be getting benefit or not, and now they feel you will get only 150. So out of 3 lakh, the 3 lakh was depreciated over how many years? 5 years. 60,000. So 240 remained. 240 remained, but now management feels the market value uska recoverable is only 150. So you test it for impairment, you would have booked the impairment loss of 90,000. 240 say you are making it as 150. ठीक है. You are making it as 150. And now you decide to amortize over 2 years. Okay, so now 150 you are amortizing over 2 years, 75, 75. So out of 150, 75 gone, now 75 remains. Again, you have perfected the process now. So one more year gone and now you have perfected the process and now you feel the asset is worth 3. Now you feel the asset is worth what? 3 lakh. Okay, so now what happened? Asset is worth 3 lakh. So 75,000, I'm making it as 3 lakh. And now these are not treated basically over here as impairment. These are actually treated as revaluation. If it was treated as impairment, the reversal. If it was treated as impairment, the reversal can be up to the maximum amount which was earlier booked. So यहाँ पे they have treated it as revaluation, upward, downward revaluation. They have treated it. So check out up and down in value of patent. They have treated it as revaluation, upward, downward. Sir, can I treat it as impairment? You can treat it as impairment. Solve it accordingly. Answer will come different. It is not wrong. Are you clear? If you treat as revaluation, answer will come different, but it is not wrong. Okay, question number 26. Question number 26. One of the senior engineers at XYZ has been working on process, and now they are telling the senior engineer believes there will be a cost reduction, there will be a benefit coming, and now cost of rupees 18 lakh incurred during the year till 31st March 6. Okay, during the year till 31st March 6. And see, the approvals were obtained in June. Approvals were obtained in June. So actually, you can start capitalizing from June. The technical feasibility came from June. June onwards, you can capitalize. Okay, for the whole year, I spent 18 lakhs. Acha. But I can capitalize only for 10 months. So 2 months ka 360 I can't capitalize. So I have basically incurred for the whole year 18 lakh. I can capitalize only 10 months. 2 months ka 360 I can't capitalize. I have to remove from here. Then there was an offer of 780 received to buy, but we rejected it, and we feel there will be a benefit of 12 lakh in perpetuity. The director of research Neha is doubting. She is telling competitors will come, and she is telling the present value of future cost saving will be only 960. Acha, so now pay attention. Out of 18 lakh, 360 so anyways we are taking in P&L. Now 1440 remains. 1440 mein she is telling 1440 mein she is telling that we'll be getting a benefit only of 960. So impairment loss is to be booked. To check out, management is capitalized full 18. We need to bring the intangible to 960. उसमें जो पहला 360 था, जो पहला basically था, that was wrongly capitalized, that we remove it, and impairment loss we remove it. So now asset is brought to 540. Asset is brought to basically your 960. 960. Acha, 18 lakh into 2 by 12 was 3 lakh. It was 3 lakh. So 3 lakh was wrongly capitalized. First 2 months were removed. 15 ho gaya. 15 I have to bring it to 960. 540 is impairment loss. Retirement disposal same as Ind AS 16. Disclosures are fine. This is done. Home assignment aa gaya. This is your Ind AS 38. Any doubts? Anybody with Ind AS 38? Any doubts? Anybody with Ind AS 38? Sir, break. Taking. We are taking a break. So now we are taking a break of 15 minutes. We'll meet back after 15 minutes. We'll meet back after 15 minutes. Currently it's 9:06. We'll be back at 9:22. 9:22 to 10:30 will be the class. We'll be back at 9:22, and 9:22 to 10:30 we'll try to finish up 2 or 3 standards more. We'll try to finish up 2 or 3 standards. Enjoy your break. See you after the break. Okay, hi friends, welcome back. Let's move ahead. We're starting now with Ind AS 40, that is on investment property. We're starting now with Ind AS 40 on investment property. The previous session, basically we completed Ind AS 2, Ind AS 16, Ind AS 38. And now we are going to Ind AS 40, investment property. Give me high five. Chalo, last 1.5 hour. Chalo, fast. Investment property, we know it's nothing but your land or building which is there, which is given on rent. That we call it as investment property. The investment property is a property which is held for earning rental or for capital appreciation or for both, rather than use in production of goods or supply of services or for sale in ordinary course. So it's not for use in production, not for sale in ordinary course. Acha, owner occupied is nothing but PP. When you have a building which you occupy for yourself, for your work purpose, that's called as kind of a PPE. Now, investment property is basically held to earn rental or for capital appreciation or both. And Ind AS 40 applies to investment property, Ind AS 16 applies to owner occupied property. They've given some examples of investment property: land held for long-term capital appreciation, land held with undetermined use. Undetermined use is there. So then in that case, we assume it's for capital appreciation. Building owned by entity, leased out under operating lease. Building owned by entity, leased out under operating lease. See, if at all it is leased under finance lease, the building only goes out from your balance sheet. Then it is not there only. Okay. Building that is vacant, it is to be leased out under operating lease. Building is constructed for the purpose of use as investment property. So these are all examples of investment property. Following are not investment property. Which are not investment property? Which is for sale in ordinary course, or which is for use, own use, owner occupied, or if it is given under finance lease, in this case the property itself goes out from your books. Achha, now if property is held for more than one purpose, partly use, partly giving on rent, what do I do? So if at all they parts, ground floor basically for own use, first floor is basically for rental, if they can be sold separately or given on finance lease separately, then in that case you account it separately. Ground floor accounted as PPE, first floor accounted as investment property. But if at all they could not be sold separately, then in that case what do I do? If they cannot be sold separately, then what do? I account it as investment property fully if the own use portion is insignificant. You account it fully as investment property if own use portion is insignificant. But sir, what if own use portion is also significant? Then you have to bifurcate. You have to bifurcate investment property and PP. Fine, moving ahead. Ancillary services. Okay, sometimes with the building we provide maintenance services, we give security, kind of that. So ancillary services are given. If ancillary services are kind of significant, then we call it as owner occupied property, not an investment property. So if ancillary services are insignificant, so it's investment property. But if they are significant, if it's a significant one, then in that case we call it as owner occupied property. It's a business wherein we are providing that services, kind of that. Property leased to group member. Achha, whenever I'm giving a property to group member, what happens is, okay, so imagine parent has a property which is given on rent to subsidiary. So parent SFS, it is investment property. Parent's SFS, it is investment property. Now, for group as a whole, the subsidiary is using in business. If subsidiary is using that property in business, for group as a whole, it will be a PPE. So it is possible parent records as investment property in SFS, but for CFS purpose, it will be coming as your PPE. Okay, question over here, whether it meets the definition of investment property, which Ind AS is applicable. It's similar to the examples done earlier, it's fine. Now, recognition, similar to your Ind AS 16, future economic benefit should flow to enterprise, cost should be measured reliably, subsequent cost is similar, I'm not moving ahead. Recognition initially is at cost. How to find out cost? Similar to Ind AS 16. Now, check over here. We are constructing 6 identical houses. Purchase cost added, non-refundable taxes added, legal cost added. Advertisement to bring tenant, no. Opening ceremony, no. Maintenance, no. So this amount is basically capitalized for how many? 6 identical houses. One of the 6 house is for office accommodation of few staff, 5 are rented. So whatever your total cost comes into 1/6. 1/6 is for own use of staff, that will come under PPE. 5/6 will come under your investment property. 5/6 is investment property, owner occupied will be 1/6. Fine. Deferred payment is similar. Exchange wala is similar to Ind AS 16, so that also we move ahead. Now measurement after recognition. Okay, day 1 it was measured at cost. Subsequently, under your Ind AS 16, Ind AS 38, we had a cost model as well as revaluation model, but for investment property only cost model is allowed. Revaluation model is not allowed for investment property. But one thing you remember, the fair value of investment property is to be disclosed in notes. So we are not having fair value in balance sheet, it's just for disclosure purpose the fair valuation will be required. TK. Transfers. Okay, this is good point. Now what happened is, imagine there was a property which was basically held for earning rental, it was investment property, now we want to use it. So can I say from investment property it becomes PPE? Achha, there was a property which was for own use, now we want to give it on rent, from PPE it becomes investment property. So this is called transfers. Transfers are made at carrying amount. Transfers are made at carrying amount, and you transfer to or from investment property only when there's actual change in use. Just a intention is not thing, actual change in use is to be there. And now whenever you transfer from investment property to PPE, or PPE to investment property, or investment property to inventory, or inventory to investment property, all transfers are done at carrying amount only. Fine. Question number 10, important. Check out. You have a land whose future use is undetermined. Okay, how this should be classified in book? If future use undetermined, it will come as investment property. Okay, now you started constructing office for own use. Achha, if you started constructing office for own use, construction going on, now it will be classified as CWIP, capital work in progress. Achha, will there be any change in carrying amount from change in use? No. So initially it was investment property, now it becomes PPE, उसके अंदर वो CWIP, उसमें carrying amount doesn't change. Achha, whether the change in classification is a change in accounting policy? No. Earlier it was investment property, now it is PPE. Accounting policy will differ, it's not a change in accounting policy. And would your answer be different if management, there was an intention to commence construction? If there was just an intention to commence construction, actual construction not started, to continue as investment property. Clear? Okay, over here we have an investment property carried in balance sheet at 15 lakh. Management estimates the recoverable amount is 10 lakh. Remaining life is how many years? 20 years. So this is a simple question. Fine. Usme kuch nahi hai. Leave it. There's nothing over there. 15th one is a good one. 15th one is a good one. 1st April 1, you purchase a large property consisting of land, 2 crore rupees, and you began leasing it. Okay, land purchase for lease, it's investment property. Annual rentals, you're getting 20 lakh, it will go in your P&L. Now, 31st March 2005, fair value 260, but your investment property carried at cost model only. In your books, it is still 2 crore. Books, it is still 2 crore. Now, Y Limited vacated the property on 30th September. So, can I say half year they were there? So, half year rental income will be coming. Now, 30th September. Okay, just a minute. Okay, on 30th September, you immediately began to convert into 10 flats. So, can I say now you are starting to construct a flat? Uska fair value today is this. Doesn't matter. In your books, the carrying amount is 2 crore. From investment property, it becomes inventory at 2 crore. So, 2 crore inventory hai. You spend 60 lakh added to inventory. Inventory become 260. Inventory became 260. The project is incomplete and further 40 lakh will be required to complete, after which each flat can be sold at 50 lakh. Acha, so now inventory ka cost is 260. Now let's find NRV. 10 flat, they can be sold at 50 lakh. So 5 crore. But our further cost to be spent is 40 lakh. So 4 crore 60 lakh is NRV. Cost is 260, NRV 460, value it at cost, 260 will be the answer. Whichever is lower, 260. Then disclosures are fine. So this is basically your, okay, baki chalega. So this is your investment property. Okay, now I'll do one thing. I'll skip this Ind AS 23. I'm skipping Ind AS 23. I'll come to it later. Come to Ind AS 36, impairment. Let me do 36 and 105. Then I'll go to Ind AS 23. Okay, coming to Ind AS 36, which is impairment of an asset. Now, when do I say the asset is impaired? When do I say the asset is impaired? When the carrying amount exceeds the recoverable amount. If the carrying amount exceeds the recoverable amount, then we say the asset is impaired. What is the recoverable amount? Higher of value in use and fair value less cost to sell. The recoverable amount is higher of value in use and fair value less cost to sell. Clear? Okay. Now, sir, do we need to test the assets for impairment every year? No, you have to look for indication every year. You have to look for indication every year. If indication exists, you have to find the recoverable amount. Do I need to find recoverable amount every year? No. Look for indication. Indications are there. Then you basically find out the recoverable amount. But for the following item, you need to find out the recoverable amount every year mandatorily. So irrespective of indication, you are required to test the following for impairment annually. Intangible with indefinite life. They are not amortized. They have to be tested for impairment. Intangible not yet available for use, development phase. And goodwill acquired under business combination. So these three things you have to test for impairment mandatorily. Wahan pe you find out recoverable amount mandatorily, whether indication is there or not. Fine. Now indicators of impairment is just a theory, not much relevant. Now, due to COVID, there are significant order cancellations coming up and that all thing is there. Do we need to carry out an impairment test? Answer is yes, it's an indication. Okay. Now, how do I find out basically recoverable amount? It's higher of value in use and fair value less cost to sell. So, they have given, what do you mean by the word fair value less cost to sell? Fair value, we already did it under Ind AS 113. Exit price tha. Okay. Now, value in use. Value in use is nothing but the present value of all the future cash flows that will be coming. It is present value of all the future cash flows that will be coming from an asset. That's nothing but your value in use. Now, how do I find out basically value in use? You have to estimate the future cash inflows and outflows. And then you have to use the appropriate discount rate to find out the present value. These are important points. So estimate of future cash flow will include the cash flow from continuing use. I'll use that asset, whatever cash flows I'll be getting. Okay, outflows which are necessary to generate those inflows. So regular servicing cost, etc. that will be taken in outflow. Okay, plus at the end of useful life, what I'll be getting, that also you include. So what I'll be getting by use, what I'll be getting at the end, termination pay. Acha, following should not be included. What should not be included? Future cash outflow or cost saving arising due to some future restructuring. Future ka outflow or related cost saving arising due to what? The restructuring. That is not to be taken. Plus, any improvement or enhancing, like suppose it's a petrol car, I say I'll be converting into CNG and that's why petrol benefit will happen. So till the time you convert into CNG, that you don't consider. The future cash inflows and outflows will be based on current situation. Future improvements, developments will be ignored. Okay. The cash flow should be before interest and the cash flow should be pre-tax. The cash flows has to be pre-tax. Fine. Now, foreign currency ke cash flows. If at all the cash flows will be coming in foreign currency, so do I also try to predict? The rate, exchange rate which will be going on first year end, second year end, third year end, fourth year? No. So do one thing. Whatever cash flows in foreign currency are there, find out the present value of cash flow. Find out the present value of cash flow in foreign currency only. Find out the present value of cash flow in foreign currency, multiply by the spot rate going on. So we don't try to estimate the rate. Acha, one more thing, the discount rate to be used is basically one which is appropriate for that currency. Okay, check this question over here. This cash flows are coming. I'll find the present value in foreign currency only. Use the discount rate relevant for that currency. Ye US wala 10%. So whatever present value comes in foreign currency, multiply it with your spot rate, which is 45. तो जो भी आया उसको multiply कर लो 45 के साथ. Did you understand? Okay, moving ahead. The UK entity has a property located in US and the cost is 1.8 million. Exchange rate was £1 is equal to $1.6. अच्छा, ये dollar है, right? £1 is equal to $1.6. I need to convert into pound. So 1.8 divided by 1.6. 1.8 divided by 1.6. Is it coming 1125? Okay, 1.125 million. It was 1.125 million. Now, upon impairment, it's a recoverable amount is 1.62. Recoverable amount is 1.62. So cost is 1.125. Now this is 1.62 and 1.8 ho gaya rate. So 1.62 divided by 1.8, it's coming 0.9. So ye 112500 pound. This is coming 0.9. It's 9. This, the impairment loss is coming 2,25,000 pound or 0.225 million. It's 2,25,000 pound or 0.225 million. हो गया. So cost, then you found out basically recoverable amount, you compared it, that's basically your impairment loss coming up. ठीक है, तो cost was in foreign currency converted to local currency. Recoverable amount was in foreign currency converted to local currency, then you compared cost or recoverable amount, whichever is lower. Now also they want the bifurcation. Analyze the total impairment loss on account due to change in value and due to exchange component. Imagine value had not changed. Value was still 1.8 million. Earlier it was 1.8 divided by 1.6 rate tha. 1.8 million divided by 1.6, so it was 1.125. And suppose rate is still same. Value is 1.8 only, but now it divided by 1.8, so it becomes 1 million. So just because of exchange rate difference, the value 1.8 million is 1.8 million only. Because of exchange rate 1.125 becoming 1 million, so 0.125. 0.125 is due to the exchange rate, remaining is due to the change in value. Clear? Now discount rate which I want to use, which discount rate is to be used? Okay, so first of all we understood the cash flows were pre-tax. Cash flows were pre-tax. So discount rate should also be pre-tax, which is basically reflecting the current market assessment of what? The time value of money and risk specific to the asset. We are finding out impairment loss related to that asset. The risk specific to that asset, that is to be considered. So pre-tax rate that reflects the current market assessment of the time value of money and the risk specific to asset. Achha, if this rate is not available, then you can use entity's weighted average cost of capital, incremental borrowing rate or other market borrowing rate that can be taken. Okay, this question over here, we are manufacturing, a machine was purchased at 5 lakh. Okay, vendor financing arrangement, the rate was 10%. Now machine will be used for what? For manufacturing steering wheels. So we need to find out future inflows, uska present value. So March 3, you sold 10,000 steering wheels at 190 per wheel. March 3 mein. During the recent financial budget, you are expecting to sell each steering wheel at 200 rupee. You are expecting to sell each steering wheel at 200 rupee in 3-4. And then the price will rise every year 3%. ठीक है? Price will rise every year 3%. But next year I'll sell at 200, then 200 plus 3% plus 3% plus 3% every year. You expect to sell 10,000 steering wheel next year and then every year 5% increase. So next year 10,000 I'll sell plus 5%, 5%, 5%, 5%, it will increase. Cost of steering wheel is 160. Costs are expected to rise 1% in 2004-5. So 3-4 May it will be 160, then plus 1%. Thereafter plus 2% every year. Regular maintenance will come in 2005-6, so वहाँ पे deduct करेंगे in 5-6. You expect to invest in new technology, ignore it. Uske karan savings will happen, that you ignore it. And current estimate of disposal proceeds, at the end when you dispose, you'll be getting 80,000. You take it in the last year. तो ये cash flows आपको मिल जाएंगे. This many steering wheels at this rate, your cost was this. So this is basically the benefit to you. वो you will get the future cash inflows, उसका present value you can do it. ठीक है? Now present value, how to do it? Should I use this 10%? No. Should I use this 10%? No. So they have given the pre-tax discount rate 8%, which reflects the market assessment of time value of money and risk associated with that asset. So this you need to take. I think this is clear. Okay, now recognizing and measuring the impairment loss. Impairment loss will be immediately recognized in your P&L. If the asset was carried at a revalued amount, the impairment loss will be treated as downward revaluation. And because of impairment loss you booked, asset ka value goes down. So now onwards automatically the depreciation will change. Fine. Question number 8 is as such. Find out impairment loss, current year's depreciation. So carrying amount is this, the recoverable amount is this. The difference is basically your impairment loss. We already have a revaluation reserve ka balance 14. It's treated as downward revaluation. 14 adjusted against revaluation reserve, balance 1.3 goes in P&L. Balance 1.3 will be going in P&L. Achha, revised value of asset is now 12 lakh, which is to be depreciated over remaining 3 years. The annual depreciation now will be 4 lakhs. Fine. Achha, in your question number 9, there's one line which is important. I'll just take that line. Okay. KAPC has followed a policy of writing down the revaluation surplus by transferring amount equal to additional depreciation from revaluation surplus to retained earning. Remember, amount equal to additional depreciation can be transferred from revaluation surplus to your retained earning. So they have done that. If they don't give it, means it is not transferred. Agar nahi diya hota, I assume revaluation surplus is whatever it was. But यहाँ पे revaluation surplus में से something has been transferred to retained earning, amount equal to additional depreciation. Now, whenever that impairment loss comes, so whatever is balance available in revaluation surplus, that much I can use and extra will go in your P&L. Okay, so revaluation surplus mein it's not 2.1, 1.05 has gone additional depreciation wala. Now only 1.05 remains. And there's an impairment loss 2.6, so 1.05 adjusted and remaining 1.41 goes in P&L. Fine. Okay, this is question number 10. Tax impact of basically impairment loss. Impairment loss is not to be allowed under income tax. The income tax mein abhi allow nahi hoga. Whenever it's actually sold, it will be allowed. So today what happened? Because of impairment loss, the asset went down in books. The books mein asset has gone down. Tax made is to be allowed in future. DTA needs to be created on it. Okay, next is impairment loss for a CGU. Now, sometimes what happens is the individual asset is not able to generate cash flow on its own. If individual asset is not able to generate cash flow on its own, we are not able to find value in use of that individual asset. So we basically do a impairment testing of a CGU, cash generating unit. It's a smallest group. It's the smallest identifiable group of assets which are capable of generating cash flow on its own. So the thing is, machine cannot generate revenue on its own. So machine plus the factory land together, they are basically used. So this is basically how CGU wala portion works. Okay. Now, if you see question number 12 over here, plant 1 produces a component that is assembled in plant 2 and 3, and then they are sold. Now, utilization level of plant 2 and 3 depend on allocation of sales between 2. There's no active market for plant 1 product. Plant 1 product, there's no active market. So I cannot test plant 1 separately for impairment. So can I say testing will be done? Plant 1 has to be clubbed with plant 2 and 3. Achha, plant 2 and 3 they've given it's how much value will be there depends on allocation of sales between both. So indirectly I can understand plant 1, 2, 3 will be kind of all dependent. Yahan pe CGU will be plant 1, 2, 3 together. ठीक है? अच्छा, यहाँ पे raw material used for plant Y is bought from plant X. X product are sold to Y. Transfer pricing is at some certain rate given. transfer pricing it at certain rate, but whenever we are finding value in use, you need to consider the price which can be there in open market. Don't consider the internal pricing. Fine. And they are telling if X could sell the product it sells to Y in active market, X could sell. So then in that case, X will be a separate CGU, X can generate cash flow on its own. But अगर उसका कोई separate market नहीं है, then in that case, it will not be separate CGU, X and Y will be tested for impairment together. Fine, moving ahead. Now, just check this line. Just check this line. Sometimes what happens is, I am testing machine for impairment. I have how to find the recoverable amount? Higher of value in use and fair value less cost to sell. Okay, for fair value less cost to sell, the buyer ka rate, someone is ready to purchase, I'm trying to see that. Now buyer says I'll take machine with the related decommissioning liability. So can I say the recoverable amount is asset together with his decommissioning liability? So if recoverable amount is that way, then in that case the carrying amount also should be that way. Machine with the related decommissioning liability. So if recoverable amount is after considering the liability which is related to it, the carrying amount should also be based on that way. So check over here, this question. There's a mine which is there, uska carrying amount, the carrying amount of provision for restoration is 500. Carrying amount of provision for restoration is 500. Now what they are telling, you have to test the mine for impairment. Various offers you have received 800. 800 is basically asset will also go, the liability provision for restoration will also go. So can I say it's net of that liability? Okay. Value in use 1200 excluding liability. No. So liability is 500. So can I say basically your value in use will become 1200 minus 500, 700. Okay, the recoverable amount is higher of value in use 700 and fair value less cost to sell is 800. So I'll be taking whichever is basically higher, so 800. Carrying amount 1000 given, but that is only related to the main thing. Uska liability also needs to be considered. So 1000 minus 500, carrying amount 500, recoverable amount is 800. There is no impairment. Next one, allocation of goodwill to CGU. Now see, goodwill. I cannot sell goodwill alone. The goodwill is not capable of generating cash flow on its own. That's why goodwill has to be allocated to other cash generating units and then tested for impairment. Okay, then now two things. One, goodwill can be allocated. To individual CGUs, and second is goodwill cannot be allocated to individual CGUs on a rational basis. Okay. So check out over here. If goodwill can be allocated to individual CGU, if I can allocate goodwill to individual CGU, तो all that individual CGUs को मैंने goodwill allocate किया, now they will be tested for impairment annually. If goodwill cannot be allocated to individual CGU, the individual CGUs will be tested for impairment only when there is indication. See, याद है goodwill arising on business combination, if that is allocated, वो impairment mandatory हो जाता है. So if goodwill can be allocated to individual CGUs, तो CGU A, B, C, उन सब में I have allocated goodwill. तो CGU A, B, C all will be tested for impairment annually as well as when there is an indication. But if goodwill cannot be allocated to ABC, so now ABC will be tested for impairment only when there is an indication, and the group CGU will include A, B, C and goodwill. That will be tested for impairment annually. And now wherever goodwill has been allocated and now there's an impairment loss coming, that impairment loss will be first towards goodwill, then to other asset in the CGU based on their carrying amount. Clear? Okay, the checkout over here, we are having basically goodwill 200, other assets are 900, total 1100, and recoverable amount is now only 600. Carrying amount 1100, recoverable amount is only 600. So how much out of 1100 recoverable is 600, 500 is impairment loss. First 200 towards goodwill, 300 towards others. So goodwill mein 200, 300 others. Fine. Now goodwill when there is a NCI. Okay, goodwill when there is NCI. You remember NCI can be either at proportionate net asset, that's basically a partial goodwill method, and or NCI can be as per the fair value. If NCI is at fair value, it's a full goodwill method. Goodwill relates to them also. Acha, now pay attention. Now pay attention. If NCI is at fair value, can I say it's a full goodwill method? Impairment loss, whatever comes up in attributable to NCI will be deducted from NCI, attributable to group will be deducted from the group share. So if goodwill ka impairment comes, I put it, automatically it's shared between both. It was a full goodwill method. Goodwill was related to both of them. Both of them. But if it was NCI was at proportionate net asset. Achha, if NCI is at proportionate net asset, what happens? If NCI is at proportionate net asset, the goodwill was only related to our share. Achha, so we hold 80%, goodwill was only related to our share. ठीक है. So goodwill attributable to NCI was not recorded in books. ठीक है. But when I'm finding the recoverable amount is for the business as a whole, including goodwill of entire business, including goodwill of NCI also. So recoverable amount is basically the recoverable amount of the CGU is also for the goodwill attributable to NCI. So now in your carrying amount, NCI related goodwill was not recorded, but in the recoverable amount, the NCI related goodwill include ho gaya because recoverable amount is for the entire business including NCI share. Unka bhi goodwill sab aa gaya. So now you need a grossing up of goodwill. I'm not explaining the concept, I'm just revising here. So you need gross up. Grossing up of goodwill is required only when it's a partial goodwill method. If it's a full goodwill method, grossing up of goodwill will not be coming up. Okay, check question number 16. In your question number 16, it's a full goodwill method, no grossing up required, a normal question. Okay, now going to question 17, it's a partial goodwill method. In 17, 80% you are owning 2100 pay, you bought it, fair value of identifiable net asset was 1500, and now the goodwill was found out. Goodwill came 900 rupees. Goodwill came 900. Goodwill is to be allocated to those CGUs which are getting benefits. Those CGUs which are getting benefits. CGU of parent are expected to get benefit, and the goodwill of 500 related to those synergy has been allocated to other CGUs. Acha, so 400 rupee ka goodwill allocated to other CGUs, and the subsidiary is also one CGU, they are also expected to get benefit. Out of 900, 500 is related to others, 400 relates to that subsidiary. So there's a CGU called subsidiary. Subsidiary is a CGU, and there's a goodwill allocated. There's a goodwill allocated to CGU subsidiary is 400. There's a goodwill allocated to CGU subsidiaries, how much rupees? 400. Now pay attention. Now pay attention. Net asset of subsidiary excluding goodwill is 1350. If I just go over here, identifiable net asset 1350, goodwill allocated to that subsidiary is 400. 500 was allocated to other CGUs. So this is basically your carrying amount. But now the thing is, yahan pe this goodwill, they have written over here clearly, NCI is at proportionate net asset. NCI is at proportionate net asset. Now recoverable amount 1000. Recoverable amount 1000 includes NCI share of goodwill also, but carrying amount mein nahi hai. So gross it up. Gross it up. This 80% is 400. So another 20% will be how much? 100 rupees. So now gross up ho gaya. Grossing up mandatory when it's a partial goodwill method. So goodwill 500. This is this 1850. Total 1000. So 1000 ka loss, 500 for goodwill, 350 here. Sorry, 850 ka loss, 500 for goodwill, 350 here. Allocation done like this. But when we are accounting, the thing is goodwill related to NCI was not recorded, so their share of impairment loss also will not be recorded. So यहाँ पे 500 was after grossing up, वो grossing up was notional. And यहाँ पे 500 goodwill impairment comes up. See, 100 was not recorded in books, so 100 impairment also you don't record over here. So check out over here. Impairment loss, goodwill mein 400 gone. This is 350. Net 1000 will now remain. Again I'm telling you the line. goodwill related to NCI was not recorded in books. So impairment loss in goodwill related to them will also not be recognized in book. But I will do it. पहले calculation के लिए gross up करेंगे, total इतना, now goodwill impairment 500. Now goodwill related to NCI was not recorded, 20%. The same way इसका 20%. And impairment loss in goodwill also should not be recorded related to NCI. Okay, now someone says, sir, if I don't do grossing up, my still answer will remain same. It will come same in this question, not in next question. It will come same in this question, not in next question. Now, NCI is at proportionate net asset, partial goodwill method, grossing up will be required. Now, pay attention. 2700 is other asset, goodwill 800 is given, that's only your share. Gross up karoge, it becomes 1000. So, 3700. Recoverable is only 2000, 1700 loss, 1000 goodwill gone, 700 this gone. That's 1000 goodwill gone. But now pay attention, 200 goodwill. 200 goodwill related to NCI was not recorded. So same way when I am doing an impairment loss write-off, that much should not be recorded. So I will be recording over here 800. 800 tha, 800 chala gaya. Here it will be 700, that is done. So now again you will say, sir, whether you do gross up or not, answer is coming same, not in the next one. Check over here. If suppose recoverable amount is 2800, the loss is how much? 900. Loss is how much? 900. Now after grossing, goodwill was 1000. So goodwill mein se 900 gone. Goodwill mein se 900 gone. Now NCI share was 20%. Acha, goodwill mein wo 20% the. So 20% of that goodwill was not recorded. 20% of impairment loss related to goodwill also don't record. 20% of goodwill not recorded. 20% of impairment loss related to goodwill. So iska 20% is 180. 180 don't record. 720 you record. 20% goodwill was not recorded. 20% of impairment loss related to goodwill also you don't record. Did you understood this? Did you understood this? Next one, allocation of corporate asset. See, corporate asset are nothing but like R&D department. Now, they don't generate cash flow on their own. R&D department, admin, headquarter, they are not generating cash flow on their own. So, they are again to be tested with the CGUs for the purpose of doing impairment testing. Now, if again two options, either they can be allocated to individual CGU or they cannot be allocated to individual CGU. So, they can be allocated to individual CGU. If they can be allocated to individual CGU, then that individual CGU will be tested for impairment with that corporate asset. But if they cannot be allocated, the individual CGUs will be tested for impairment on their own. And group CGU will be there, which is individual plus the corporate asset. That way it will be tested for impairment. Only thing over here, so यहाँ पे similar to goodwill है. They're similar to goodwill, but only thing is under goodwill, if there's an impairment loss, loss is first borne by goodwill, then by other assets in CGU. Here it will not be like that. If corporate asset is allocated and loss come, the loss will be borne by other assets and the corporate assets proportionately, not first towards corporate asset. Okay. Now moving ahead to question number 20. Achha, question 20 mein they are telling there's a machine which has suffered some damage. Fair value less cost of disposal is less than the carrying amount. Fair value less cost of disposal is less than carrying amount. And now value in use I need to see. Now it's bit damaged. If it's bit damaged, I can understand value in use will also come lower. So there's some impairment required. Now if budget or forecast reflects no commitment to replace the machine, you need to calculate the value in use also. Individually it doesn't generate cash flow, so you have to test it for impairment with a CGU. But if budget and forecast reflect a commitment to replace, usko replace hi karne wale. So then value in use is of no use over here. Directly you can consider recoverable amount as fair value less cost to sell. Directly you can consider it as fair value less cost to sell because management intend to sell it. Value in use is of no importance. Okay, question 21 is a good one. Question 21 is good one. There are two corporate assets. One can be allocated, other cannot be allocated. One can be allocated, to usko allocate karenge, then we'll do the impairment testing. So now how to allocate? They are telling on a reasonable basis. What ICI has done, it's not the carrying amount. They did carrying amount into the useful life. They've done carrying amount of CGU into the useful life. That proportion में they've allocated the one which can be allocated. So CGU X can be allocated. So this was the carrying amount of ABC. CGU X has been allocated based on which value? Carrying amount into the useful life. तो ये allocate हो गया. This allocation done. And now this total comes. Now we are testing this for impairment. This is now compared with recoverable. This is basically the loss coming. Now this loss will be borne by that corporate asset and other asset in the CGU proportionately. Proportionately will be based on carrying amount. Loss is always borne based on carrying amount. Allocation of corporate asset may not be on carrying amount. ठीक है. So this is the loss which is borne. Now after step number 1, after allocating corporate asset X, step 1, this were the values now left. This were the values now left, A, B, C, X, and now group में I am adding Y. तो can I say overall हो गया ये group A, B, C, X and Y. And now thus Y was not able to be allocated. So now I test group CGU for impairment. So group CGU का carrying amount is this, recoverable 3200. So impairment loss in group CGU is nil. If there was an impairment loss in group CGU also, it will be borne by A, B, C, X, Y in this ratio. 500 is to 699 is to 1091 is to 582. That ratio mein it will be borne. 22 is similar to 21, so it's fine. Now reversal of impairment. Now going to reversal of impairment. Now reversal of impairment is allowed, but other than goodwill. Goodwill का impairment, whatever you recorded, that cannot be reversed. वो भूल जाओ. Reversal of impairment otherwise allowed, but there has to be an increase in service potential. The service potential has increased just because of passage of time. If recoverable amount increase, that you don't consider. For example, this were the future cash flows, present value was coming this. Now 1 year gone. 1 year is gone. So now higher cash flows were later. Present value was coming less. Now 1 year gone. Now higher cash flows are nearer. So present value is now coming more. Cash flows have not changed, but the present value comes more. So यहाँ पे service potential is not increased. I cannot do reversal of impairment. Reversal of impairment is allowed only when there is a increase in service potential of an asset. ठीक है. Moving ahead. Okay, now reversal of impairment loss of an individual asset. Whenever I'm doing a reversal of impairment loss, तो कितना reverse कर सकता हूँ? How much basically the reversal can be recognized? The revised carrying amount. Pay attention, this line very important. Revised carrying amount after reversal shall be. Revised carrying amount after reversal shall be equal to either the recoverable amount or carrying amount had there been no impairment loss earlier. इसमें से whichever is lower. Okay, so today recoverable amount is this, but had there been no impairment loss earlier, the carrying amount would have been this. I have to take whichever is lower. So after the reversal, the revised carrying amount shall be either the recoverable amount or the carrying amount had there been no impairment loss recorded earlier. उसमें से whichever is lower. Clear? Okay, check out question number 25. July 21 exam. Okay, asset purchase for 100 lakh. Useful life is how many years? 4 years. ठीक है, तो 100 lakh का था, 4 years. First year में 25 depreciation gone, 75 carrying amount. Recoverable is 60, 15 impairment loss. And now 60 will be written off over remaining 3 years. So next year 20 depreciation, 40 value, recoverable also 40. So next year no impairment. No impairment. Now 40 again 20 depreciation. So now 20 is the value and now the recoverable amount is 28. Oh, 20 हो गया 28. So earlier I had written an impairment loss in year 1. Now I can reverse it. Okay. So after reversal, the revised carrying amount should be the revised carrying amount. Book में carrying amount 20 है. Reversal के बाद the revised carrying amount should be either the recoverable amount 28 or what will be the carrying amount had there been no impairment. Had there been no impairment 100 था. उसमें 25, 25, 25 gone, 75 gone. तो had there been no impairment, today it would be 25. अच्छा, तो recoverable amount is 28. Had there been no impairment, the carrying amount would have been 25, lower of 2. After reversal, I can bring it to 25. Okay, तो book में 20 है, you can reverse 5 lakh. You can reverse how much? 5 lakh, not 8 lakh. You can reverse only 5 lakh. Fine. Okay. Next one is similar question like that only, that you need to do on your own. So after reversal, the revised carrying amount will be equal to what? Either the recoverable amount or carrying amount had there been no impairment, whichever is lower. This question is also okay. Done. Done. This is impairment of asset going to Ind AS 105, unit number 7, non-current asset held for sale, discontinued operation. We have to do this as well as borrowing cost 2 more. We have to do this as well as borrowing cost 2 more, half an hour, 15 minutes for both. 15 minutes for both. Okay, coming to Ind AS 105, 2 parts. One, non-current asset held for sale. So if basically I have a non-current asset which is classified as held for sale, so uska valuation now will be as per Ind AS 105. Now usme Ind AS 16 will not apply, depreciation stopped. And if there is a discontinued operation, how do we disclose the discontinued operation? That is given over here. Now, disposal group, they have defined it's a group of assets which are to be disposed of in a single transaction. That's disposal group. Now, when do I classify an asset as held for sale? When do I classify an asset as held for sale? When the carrying amount will be recovered principally through sale rather than use. The carrying amount will be recovered principally through sale rather than use, and there are 2 criteria to be met. One, it is available for immediate sale. It should not be like, oh, still my orders are pending, I'll not sell you right now. No. It should be available for immediate sale, and sale is highly probable. Okay, when do I say sale is highly probable? If I have to renovate property and then sell, so till renovation is going on, it's not available for immediate sale. It's available for immediate sale, sale is highly probable. Okay, when do I say sale is highly probable? 5 condition. You are committed to sell, active program to find a buyer is going on, you are marketing at a reasonable price, sale is expected to be completed within 1 year, and significant changes to the plan are unlikely. Now, pay attention. Pay attention. After the year is over, the criteria for held for sale are met. Okay, criteria for held for sale are met when? After year over, before books are approved, it's a non-adjusting event. It's a non-adjusting event. The criteria for held for sale should be met on 31st March. Then only you classify it as held for sale. If it is met after year end, it will be a non-adjusting event. Okay. Moving ahead. Now, how do I measure? How do I measure a non-current asset which is classified as held for sale? How do I measure a non-current asset which is classified as held for sale? It will be measured at lower of carrying amount and fair value less cost to sell. See, यहाँ पे value in use नहीं होगा because it is to be sold off. So it will be now valued at lower of carrying amount and fair value less cost to sell. So at the time when you classify it as held for sale, that way valuation. Again, every year end, that way valuation. Till it is actually sold off. Till it is actually sold off. Okay, initially as well as subsequently. Okay. Now, before you classify something as held for sale, suppose I'm classifying something as held for sale on 1st October. So you should provide. So PP is classified as held for sale 1st October. Till 1st October, give depreciation. 1st October के बाद depreciation stops. So before the initial classification, you measure it as per the respective Ind AS. Once you classify it, now the depreciation is immediately stopped. Now the depreciation is immediately stopped. Fine. Sometimes we don't have an individual asset, it's a disposal group. If disposal group is classified as held for sale, there are certain items in disposal group which might not be covered under this standard. Like disposal group mein some inventory is there, some other things are also there. So what happens in that? In that case, that other items basically which are as such not covered under this standard, which are there in disposal group, they will be measured as per their respective Ind AS. Okay. So immediately before initial classification, the carrying amount of asset will be measured as per the respective Ind AS. Upon classification as held for sale, now it will be measured at lower of carrying amount and fair value less cost to sell. Fine. Okay, come to question number 3, fair value of your total asset on acquisition. is 360. Acha, it is acquired exclusively with a view to sell. If it's acquired exclusively with a view to sell, it is classified as held for sale from day one only. So on acquisition, fair value is 360, cost to sell is 10. So I take 350. 350 asset, liability 80. Liability is 80. So don't measure them at fair value, measure them at fair value less cost to sell. So 350 minus 80, they will be measured at 270. Okay, now reporting date पे 340 है, excluding liability, assuming liabilities are basically same, and cost of selling is also same. तो 340 minus 10, 330, 330 में से 80 गया, 250. तो 270 becoming 250, 20 rupee loss will be recorded on reporting date. So day 1 they will be recorded at 270, now they become 250, 20 rupee loss comes subsequently. Now, recognition of impairment loss and reversal, whatever loss we record here, when we are measuring at lower of cost and fair value less cost to sell, that is also known as impairment loss. So whatever loss we are booking over here, that is also known as what? Impairment loss. Now subsequently imagine the carrying recoverable amount, fair value less cost to sell has gone up. So now what is happening is, subsequently if there's some gain coming up, we can increase the fair value. Subsequent increase in fair value is there, we can record a gain, but how much we can record? So how much gain we can record? A loss which we had booked earlier under this standard or under other standard, wo impairment. So an impairment loss from initial or subsequent write down was there. You can record a gain for subsequent increase, but not in excess of cumulative impairment loss, which is recognized as per this standard or as per Ind AS 36. ठीक है, तो यहाँ पे we had recorded 50,000, Ind AS 36 में we had recorded, say for example 2 lakh, the total we had recorded is 50 and 250. The reversal can happen up to 250. Now impairment loss coming up for a disposal group. Disposal group is there, we are having an impairment loss first towards goodwill, then towards other asset falling under this standard, then towards other asset falling under this standard proportionately. ठीक है, तो check question number 4. See, this is balance on 31st March. It is classified as held for sale on 710. So first of all, from 31st March to 710, they are valued as per respective Ind AS. So this 16,000 becoming 14,900, this will be as per the respective Ind AS. This 1100 is as per the respective Ind AS. Now carrying amount is 14,900. I'll be valuing it at what? Carrying amount or fair value less cost to sell, whichever is lower. Fair value less cost to sell they have given is 13,000. The 14,900 becoming 13,000. ये 14,900 becoming 13,000, 1,900 loss. 1,900 loss, that is basically as per this standard, that will be borne first by goodwill. Goodwill में तो 1,900 में से 15 gone, 400 pending. Now non-current asset held for sale will include PPE, building. It will not include inventory. It will not include investment in equity. They are out of scope. So then remaining is borne by this two. Remaining is borne by this two. ये दोनों bear करेंगे in proportion to their carrying amount. Their carrying amount are this. ये उनका carrying amount है. 1,500 goodwill and remaining is borne by PPE and building in proportion to their carrying amount. Done? Okay. Now suppose later on it is increased to 15,500. Oh, 13 becoming 15,500. There is an increase. I had recorded 1,900. I cannot reverse 1,900 because goodwill ka reversal not allowed. I'll be reversing only the other two. Okay, similar question was asked in November 19 exam. Similar question was asked in November 19 exam. Now, changes to the plan. Changes to the plan. Initially, you had decided basically it is classified as held for sale. Now you don't want to sell it. Now you don't want to sell it. Okay, the changes to the plan. So when it was classified as held for sale, it was shown under that current asset. So it was removed from PPE, it was brought under current asset. Now, if it is not to be sold, it will come back in PPE. Now it will come back in PPE. In case of change in plan, asset will come back in PPE. Now, asset will come back in PPE at what value? Asset will come back in PPE at what value? Recoverable amount or the carrying amount of asset had it not been classified as held for sale, इसमें से whichever is lower. So now it will again come back in PP. So earlier from PP it was removed, shown separately as non-current asset held for sale under current assets. Now it will come back in PP, what value? Either at recoverable amount or the carrying amount had it not been classified as held for sale earlier. Are you getting it? Okay, this is the question related to it. Question number 8, you purchase a property for 6 lakh, 15 years. There was some impairment testing, recoverable amount was 470. So carrying amount before classification as held for sale 470. Before classification as held for sale 470, and there was impairment loss as per Ind AS 36 book. 36 wala impairment tha, not as per the standard. Now 470 tha, and fair value less cost to sell is 460. So 10,000 loss was booked as per this standard. 10,000 loss was booked as per this standard. The total impairment loss 50 as per Ind AS 36, 10 as per this standard. Now 31st March, now it no longer meets the criteria for held for sale. If it no longer meets criteria for held for sale, it will come back in PP. What value? Recoverable amount 5 lakh or carrying amount had it not been classified as held for sale. So before it was classified as held for sale, it was 470. Before classification as held for sale, it was 470. It was not classified as held for sale, 470. 470 का depreciation जाता, so it will become 433. So 5 lakh recoverable amount, and had it not been classified as held for sale, it would be 433. Whichever is lower, bring it at 433. In your book, it is currently 460. Bring it at 433. Difference will go in your P&L. Difference will go in your P&L. Clear? Okay, next one, question number 10. Next one, question number 10. It's similar to the question which we did earlier. Only thing, there are other assets which are given in the disposal group. So in your disposal group, you have this. They will be measured in accordance with the respective Ind AS accordingly. वो अपने आप से respective Ind AS में measure होंगे. ठीक है. 2250 was carrying amount on March. 15 September it's classified as held for sale. So till 15 September you're required to measure them as per the relevant Ind AS. So 2250 becoming 2160 is relevant Ind AS. Okay, वो relevant Ind AS था. Now 2160. Now 2160 is basically there. Now you evaluate 2160 को कैसे? Carrying amount 2160 और fair value less cost to sell. तो fair value less cost to sell ये 1900 है, उसमें cost to sell 70 आ गया, cost to sell is 70, तो total it became 1830. तो 2160 becoming 1830, 2160 becoming 1830, 330 loss. This you book it as per this standard. One first towards goodwill, then other standard covered here, other assets covered here, intangible is covered, PPE covered, others deferred tax, inventory, current liability, these are not covered under this standard, so they bear it proportionately. Acha, now for the remaining asset, unka fair value has changed. For the remaining asset, there are some fair value changes. So now disposal group 1830 became, उसमें से 120 गया 1710. 1830 became 1710. Other assets not covered under this standard, they are measured as per their Ind AS. And now they are telling the recovery fair value less cost to sell is 1650. So 1710 is becoming 1650. Don't say 1830 becoming 1650. Out of 1830, other assets not covered here measured as per respective Ind AS. So now it became 1710. 1710 is becoming 1650. So now that again loss is coming, how much rupees? 60 rupees. Goodwill already gone, other assets proportionately. ठीक है. Now presentation disclosure of non-current asset held for sale. How do I disclose it? It is to be presented separately from other asset under your current asset. Same way disposal group liability, presented separately from other liabilities under current liability. Acha, any cumulative income expense recognized in OCI. OCI में anything recognized related to this non-current asset held for sale or disposal group is to be shown separately under OCI. उसको अलग से दिखाना है. अच्छा, now last year it was PPE. This year it is classified as held for sale. So this year it comes under current asset. अच्छा, तो last year PP में this year current asset, do I need to reclassify the previous figure? So last year PP, this time current asset. So should I bring last year also in current asset? No. The previous year reclassification doesn't happen. The comparative amount for prior period not reclassified. For non-current asset held for sale, previous year figures not reclassified. For discontinued operation, it will be reclassified in P&L. ठीक है, अच्छा, fine. See the presentation. Under your asset side, this is non-current, उसके नीचे current. ये current asset के अंदर disposal group के asset held for sale. Under your liability also, ये current liability disposal group की related liability which is held for sale. We are showing it separately. Fine. Now comes the word discontinued operation. See, non-current asset held for sale was one asset. It was an asset or a disposal group. A group of assets which are to be disposed together in a single transaction with the related liability. So that was there. Discontinued operation is a component. It's a component of entity that is either disposed of, it's already disposed, or it's classified as held for sale. But it has to be a component. It has to be a component of entity which is already disposed or which is classified as held for sale, and it presents a separate major line of business or geographical area of operation. ठीक है, तो whenever there's a discontinued operation, उसका data is to be shown separately. उसका accounting नहीं है, it's only presentation disclosure. It's only presentation disclosure. So one machine held for sale, it is non-current asset held for sale. It's not discontinued operation. ठीक है, we need to understand whether it's a discontinued operation or not. It has to be a component. Okay, for discontinued operation, uska data is to be given separately in P&L. And if you remember the format of P&L, we had continuing operation, usme revenue, expenditure, all that, and then we had uska profit. Uske baad discontinued operation. Uske baad discontinued, usme profit or loss from discontinued operation before tax, uska tax impact. Okay, so post-tax profit loss of discontinued operation, post-tax profit loss of discontinued operation, and post-tax profit loss recognized on measurement to fair value. उसके अंदर items are measured to fair value, उसके related. तो operation के related and measurement to fair value के related, both things, and उसका pre-tax and tax part you can show directly on face or in notes. अच्छा, one more thing. Last year it was under continuing operation. This year it's discontinuing. So we had three divisions. One division we are closing. And it meets criteria for held for sale. It's available for immediate sale, and basically the sale ho jayega. So the thing is, like, it's meeting criteria for held for sale. It's meeting criteria. Sale is highly probable. So it's meeting criteria for held for sale. Now what to do? So last year it was basically in continuing. This year it's in discontinuing. The previous year figures in P&L are to be reclassified. Okay, the result of operation of component previously was in continuing. This year is discontinuing. It should be reclassified. So P&L में previous year figures are reclassified, not in balance sheet. So previous year continuing, this time discontinuing, previous year को restate it in P&L. Same way, if there's a change of plan. Last year it was discontinuing, now it becomes continuing. The previous year figures are to be reclassified over here. Did you understood? And this is how the presentation comes of discontinued operation. Your discontinued operation, uska profit or loss. Acha, so pre-tax and tax effect, they have given it in notes. It's assumed that pre-tax and tax effect is given it in notes. Done. This is your Ind AS 105. Come to the last standard of the day, Ind AS 23, 15 more minutes. Come to the last standard of the day, Ind AS 23, 15 more minutes. Okay, borrowing cost. Now see, what do you mean by the word borrowing cost? Borrowing cost are nothing but the interest and other costs which are in connection to your borrowing. Now there's a principal concept under this standard which says, borrowing cost incurred on qualifying asset can be capitalized. So borrowing costs that are directly attributable to acquisition, construction, production. Borrowing costs that are directly attributable to acquisition, construction, production of a qualifying asset can be capitalized. Other borrowing costs will be going in your P&L. Okay? Fine. Now, borrowing costs are basically your interest as well as the other costs related to your borrowing. One is interest. Okay? Using effective interest rate. Interest will always be using effective interest rate. And one more thing, if I have a foreign currency borrowing, why do you borrow in foreign currency? Lower interest. But now there will be exchange loss coming up. Lower interest rate, but samne exchange loss comes up because exchange rate goes up. So exchange loss to the extent of savings in interest. Exchange loss to the extent of savings in interest will be regarded as a borrowing cost. Exchange loss to the extent of savings in interest will be regarded as borrowing cost. Over and above that, whatever is basically the exchange loss, that will be the exchange loss coming under other expenses. Achha, and borrowing costs relating to a qualifying asset can be capitalized. Fine. So check over here. Question number 1. USD 2000, you took a loan, 5% is interest. Okay. And rate was 45, now became 48. Okay, so 20,000 into 3, can I say exchange loss comes up is 60,000? Acha, you paid interest how much? 20,000, uska 5% pay $1,000, $1,000 ka 48,000 interest. You paid 48,000 interest if you had taken a loan in India. 9 lakh rupees pay 11%, 99,000. Okay, so your interest came 48. If loan was taken in India, interest will be 99. What is the savings in interest? 99 minus 48. 51 is savings in interest. Your interest comes 48. If loan was taken in India, interest would have been 99. Okay, so savings in interest is 51. And now you have exchange loss 60. Out of exchange loss 60, 51 will be regarded as borrowing cost, and remaining 9,000 will be the exchange loss, which will come under other expense. Clear? Now recognition. Borrowing cost, this line is important. Borrowing cost which is directly attributable to acquisition, construction, production of a qualifying asset can be capitalized. Acha, what's a qualifying asset? Which takes substantial period of time to get itself ready for use or for sale. So it can be PPE, it can be intangible, it can be inventory also. Fine. Assets that are already ready, when you acquired and that are ready, that uske upar they are not a qualifying asset, I cannot capitalize it. Fine. Acha, they've given one more thing. Inventories which are produced in large quantity on a repetitive basis, they are out of scope from this standard. Inventories which are manufactured in large quantity on repetitive basis, they are not covered under this standard. And even though they are not covered under this standard, but usme, if they are taking substantial period of time to get itself ready for sale, we will be capitalizing interest, okay, even though not covered under this standard. Okay, moving ahead. I'm just taking important question. Question number 9. Question number 9. Keep smiling, pay attention. Okay, Nika Limited has obtained a loan of 620 lakh for renovation of factory 1st April ko. And installation got completed 30th April to 13 months. 13 months are there. Okay. 510 was basically for installation, 54 lakh was for advance to supply for additional asset. Acquired in April, they will also be installed in April 2. Acha, to wo bhi qualifying asset. So, ye qualifying asset, advance to supplier for something which will be coming after 1 year, wo bhi qualifying asset. And balance 56 is working capital purpose, it's not a qualifying asset. The total 620 lakh tha, interest is 68.2. Okay, so out of 68.2, on 510 you can capitalize, on 54 you can capitalize, on remaining 56 you cannot capitalize. Now this is basically if the completion was done on 30th April 2. Now there's one more question. Would your answer differ if everything got completed in February 28? If everything got completed in February 28, it's 11 months. Achha, if it's 11 months, substantial period of time is generally a period of 12 months. 12 months nahi ho raha hai, so then in that case everything will go in P&L, nothing will be capitalized. So less than 12 months, the whole interest will be charged off to P&L. ठीक है. Now, which is the borrowing cost eligible for capitalization? Which is the borrowing cost eligible for capitalization? Which is directly attributable to construction, acquisition, production of a qualifying asset that can be capitalized. Now, borrowing can be of two types: specific borrowing, general borrowing. For a specific borrowing, if it's specifically for that qualifying asset, the total interest minus income from any temporary investment, that will be capitalized. So total actual borrowing cost less income from temporary investment, that will be capitalized. Use हुआ नहीं हुआ भूल जाओ. Use हुआ नहीं हुआ. If it's a specific borrowing, total actual interest, whether used not used, leave it. So over here, the whole interest, even though you use somewhat here, doesn't matter. That full interest, actual interest less income from temporary investment, will be capitalized. So if it's a general borrowing will be capitalized to the extent used. Okay, to the extent it is used, that much will be capitalized. ठीक है. And if nothing is given, you assume that if nothing, कुछ दिया नहीं है ना, then you always assume that the spendings are out of general borrowing. मतलब specific है तो first from specific, then spendings are out of borrowing. Don't assume that spendings are out of my own fund. नहीं, ऐसा assume ही नहीं होगा. If loan is there, spendings are out of loan. Loan है तो spendings are out of loan. Don't think it's out of my own fund. ऐसा सोचना ही नहीं. अच्छा, one more thing. For a general borrowing, if we have more than one general borrowing, the capitalization will be based on weighted average capitalization rate. So check out over here. So you borrow generally and use them for the purpose of qualifying asset. You can basically capitalize based on applying a capitalization rate on that asset. Okay, and this will be the weighted average capitalization rate during the period. What is the weighted average capitalization rate during the period? How do I find the weighted average capitalization rate? What is the total interest during that period divided by total loan of that period into 100? That way I'll be able to find it. ठीक है. Now, expenditure to which the capitalization rate is applied. Expenditure to which capitalization rate is applied. What amount is spent? So amount of expenditure would include only expenditure that have resulted in payment of cash, or अच्छा cash pay नहीं किया but I assume a interest bearing liability, still it's okay. उस पे भी capitalization done. And interest on interest, last year's interest था वो add हो गया था carrying amount में. Interest on interest can also be capitalized. ठीक है. Now going to question number. Okay, let me take first 13, then I come to 12. Let me take 14, then I come to 13. Let me take 14, then I'll come to 13. Let me take 14, then I'm coming to 13. Okay, you began construction on 1st of January. 1 lakh is a special loan, specific loan. ठीक है, rate is 10%. And there are two other non-specific loan also, general borrowing. For the general borrowing, I have to find out the weighted average rate. 5 lakh into 11%, so that is the interest. 9 lakh into 13% for interest. Total interest divided by total loan. Weighted average rate is coming as 12.285. ठीक है. Now, how did you spend? Assume they are all at beginning of the month. January 1st को I spent 2 lakh. 1 lakh special borrowing used, remaining general borrowing used. And then afterwards all general borrowing used. Achha, specific borrowing, full interest capitalized. Specific borrowing, full interest you capitalize, less any temporary income not given. So 1 lakh into 10%. 10,000 capitalized. General borrowing, how it is used? Okay, the 1 lakh used on 1st April. The 1 lakh into 12.28% for January to December, 12 months. Okay, 1st April I used 250. 250 into 12.28% for 9 months. 450 into 12.28% for 6 months. And 120 into 12.28% for 1 month. That way you need to do it. So general borrowing के लिए, this 1 lakh was for 12 months, 250 is for 9 months, 450 for 6 months, 120 for 1 month. ये general borrowing. And specific borrowing, it's fully 10,000 will be capitalized for specific borrowing. So this is the total interest which is to be capitalized. Now come back to question number 13. Come back to question number 13. And there's a similar question in homework also. I'll take both. Keep your eyes open. Pay attention. Okay, now you constructed a building 1st September which continues till December end. So September, October, November, December, 4 months. Okay, now I'm having over here, how did I spend? 1 lakh I spent in September, 250 each in October, November, December at beginning. So 1 lakh in September, October, November, December, 250 each. Now, no specific borrowing, all general borrowing. One is debenture of 20 lakh rupees. Then I have a OD 5 lakh, which increased to 750 in December. So September, October, November, it was 5 lakh. December mein it is 750. Acha, rate 15% until 1st October. Acha, so 5 lakh, 15% in September. 5 lakh, 16% in October, November. And 750, 16% in December. Weighted average capitalization rate I need to find out. If you just check out the line written, it is weighted average capitalization rate for the period. Now here it's a 4-month period. To find out weighted average capitalization rate for the 4 month. So 4 month ka interest and how much is the amount used for 4 month? Loan. So 4 month interest is coming. One, ye debenture ka 5 lakh ke upar 15% was for 1 month, 5 lakh pe 16% was for 2 months and 750 16% is for 1 month. Ye total interest ho gaya. Total interest. So we need to find weighted average rate during that 4 month. Now 4 month ka borrowing. This 20 lakh was there for whole of 4 month, 4 by 4. 4 by 4. Achha, this 5 lakh was for 3 months, 3 by 4. Don't do 3 by 12. वो annualized हो जाएगा. I want ये 4. And this was for 1 month, 1 by 4. So this is basically there. So now if you find out, this is 96250 divided by 2562500, 3.74% is 4 month ka rate. If I had taken यहाँ पे divided by 12, I will get annualized rate. If annualized rate है, divided by 12 करना है. This is 4 month ka rate. Directly apply this rate. Don't do into 3.76 by 12. 12 ऐसे नहीं करना है. This is basically 4 month rate only. ये 4 month rate है, annualized नहीं है. Did you understood? Okay, now let's go to a similar question given in home assignment. ये रहा. You spend 2 lakh in September beginning, 4 lakh in each of the month. You have not taken any specific borrowing. One is debenture, then overdraft are there. Similar question. Now, what is happening over here is we found the weighted average rate, 4 month ka interest, 4 month, how much was the loan that way. They have found out annualized in this question. Now see, both are ICI solution. The debentures were there for whole 9 months, whole year. So uska interest for whole year. They're taking annual interest, annual loan amount, that way they're doing it. Achha, bank OD 4 lakh was for 9 months, 12%. 4 lakh for 2 months, 15%. And 8 lakh for 1 month, 15%. So ये annual interest हुआ. Annual interest. And now annual loan. This was for whole 12 months. 4 lakh was for 11 months, 8 lakh was for 1 month. So ये, and now they're finding weighted average rate 9.5. This 9.5 is basically for whole year. So now I have to do into 4 by 12. वो 4 by 12 करना पड़ेगा. In that earlier one, into 4 by 12 is not required. Earlier one वाले में 4 by 12 into करने की जरूरत नहीं है because we found it for 4 months only. So we took 4 months interest, 4 months के loan, वो 4 month का rate था. So on the amount spent directly you apply that rate. Don't do into 4 by 12. I hope this is clear. Both the ways you can do it, whichever comfortable, up to you. Both are ICAI solution only. I prefer the first one, वो 4 month wala. I prefer that. Fine, moving ahead. Okay, Jacob has a question, sir. Loan borrowed for building of machine for large scale production. What will be the treatment of borrowing cost? Achha, you are basically taking a loan for constructing a machine. See dear, if you are taking a loan for construction of a machine and if that machine is taking more than basically substantial time, more than 1 year, then it's a qualifying asset, interest can be capitalized. Clear, Jacob? Okay, this is done, this is done. 15th is fine. Okay, now 16th question. 16th question. Now pay attention. The thing is, I am constructing a qualifying asset. I'm constructing a qualifying asset. I've paid some money. I paid some money to my contractors, the one who is basically helping me in construct. I paid some money. So this is basically the cost of construction on accrual basis. This is on outflow basis. This is on accrual basis. This is on outflow basis. So see, I would have paid to my contractor 3 lakh in first month only. But our work what he has done is only for 1.5 lakh. This I have paid is for 3 months. What he has done is for 1.5 months. Now question arises over here. Question arises. So when I say that how much I have spent on this, the general borrowing, I don't have any specific borrowing, as in when I use for qualifying asset, so should I take on accrual basis or paid basis? So 3 lakh I've already paid. So 3 lakh paid is for the qualifying asset only. So it should be on this paid basis. So check out the solution. Check out solution. When advance payment is made to contractor, for us it will be treated as payment made for construction of qualifying asset. For us it is nothing but a payment made for construction of qualifying asset. So capitalization should be based on cash outflow basis. Okay, so check over here. If average capital expenditure were taken on accrual basis, the borrowing cost capitalized would have been 0.3. अगर आप उसको cash basis पे ले रहे हो, it comes 0.44. So now the divergence is due to some advance payments which we do to our contractor. The expenditure on qualifying asset includes only those expenditure which have resulted in payment of cash, transfer of asset, assumption of interest bearing liability. When cash is paid, but corresponding cost is not yet accrued, the interest becomes payable on payment of cash only. Therefore, the amount so paid should be considered for eligible interest capitalization. So you should go on cash basis, not on accrued basis. 0.44 you capitalize it. Okay, next 17th May, only thing is it should be based on, the interest should be based on effective interest rate that is basically there. Otherwise it's fine. Now, when should I start capitalizing? When should I start capitalizing? Commencement date ko. When should I start capitalizing? Commencement date. And commencement date is a date when all conditions are met. 3 criteria. 1. You started incurring expense. You started having borrowing cost. I started incurring expense but I don't have a loan only. So capitalization doesn't start. I have a loan but I have not started spending. Still capitalization doesn't start. So you started incurring expense, you started incurring borrowing cost and activities are underway. If activities are halted in between, again capitalization stops. All 3 criteria has to be fulfilled, then only you start capitalizing. Fine. Now suspension. Sometimes temporarily the work is stopped. Imagine the workers went on strike. The workers went on strike. 2 months the work was stopped in between. So that 2 months you cannot capitalize. Acha. But imagine some temporary delays are there which are a part of process. So during rainy season, whenever rains are there, in between that 2-3 days the work was stopped, then the capitalization is not stopped. So when active development is halted, you stop capitalizing. You do not suspend when that is a necessary part of the process. Iske related a question is there in your RTP of May 24, very good one. Acha, complete stoppage. When should I stop capitalizing? When substantially all activities to prepare the qualifying asset for intended use or sale are completed. The substantially all activity which is necessary for qualifying asset for intended use or sale are completed, stop it. Acha, if completion in part, imagine we have tower A, B, C. Tower A completed, stop capitalizing for tower A. So that way you need to basically have it. Okay, now question number 21. 4 phases are given to you. RTP November 22 question. Okay, phase 1, the total expense is 1 and 2 is 98 and 3 and 4 is 123. The total spending you have done is 98 plus 123, total spending is 221, but loan is only of 200. लोन आपका 200 है, लोन 200 है, तो इंटरेस्ट विल बी ऑन 200. 200 का 15%, इंटरेस्ट 30 लाख आया. Now, loan 200, can I say it will be used for phase 1 also, 2 also, 3 also, 4 also? I don't know how, so proportionately. Phase 1 and 2, they are completed in between. Phase 1 and 2 basically, check out, will be operational. They have given over here, mid of the year, phase 1 and 2 have become operational. So phase 1 and 2 ka interest have to capitalize only for 6 months. Acha, so now, how much of this interest relates to phase 1 and 2? So do one thing, aapka interest is 30 lakh. Divide it between phase 1, 2, 3, 4. How? Based on the cost. तो आप ऐसा मानो जो 221 था ना, loan 200 है, loan 200 है, तो but the thing is loan 200 would have been used proportionately only between all of them. जो ये cost था ना, यही proportion में the loan would have been used. तो can I say interest also will be in this proportion? ठीक है, तो interest relating to phase 1 and 2, interest relating to phase 1 and 2 is 30 lakh into 98 by 221, and interest relating to phase 3 and 4 is 30 lakh into 123 by 221. This उसमें हाफ ईयर यू कैपिटलाइज, इसमें यू कैपिटलाइज फॉर फुल ईयर. तो इसमें कैपिटलाइजेशन विल बी फॉर हाफ ईयर, यहाँ पे कैपिटलाइजेशन विल बी फॉर फुल ईयर. क्लियर? ओके, नेक्स्ट वन वी हैव ग्रुप फाइनेंशियल स्टेटमेंट. Group financial statement. Now see, borrowing is done by one group. Borrowing done by parent. Imagine parent has borrowed. So there is a parent, they have a loan. Okay, with that loan money, okay, parent took a loan. With that loan money, they invested in subsidiary. And now subsidiary is basically building a qualifying asset. They are building qualifying asset. Now see, individually, if you try to understand from standalone angle, parent has a loan, but they are not doing a qualifying asset. They have a loan, but they don't have. So they have a borrowing cost, but they don't have a qualifying asset. So the thing is, they will take it in P&L. Now subsidiary, they are having a qualifying asset, but they don't have a loan. They don't have a loan. Parent had a loan, then parent invested by way of equity shares. Parent invested by way of equity shares. So I don't have a loan. So individually, parent has a loan, they don't have qualifying asset. Subsidiary has a loan, subsidiary has a qualifying asset, they don't have a loan. But group as a whole, can I say loan is there and that money is used for qualifying asset? So individually, none of SFS. SFS में it is not capitalized. CFS में it will be capitalized. Okay, that is what they are trying to say. Okay, so check out question related to this. Parent P, they have 3 subsidiaries: real estate, construction, finance. Parent has no operation. Finance company is for raising finance. And now see, real estate company, they were borrowing 10 lakh. Expenditure, they have 1540. Expenditure, they have 1540. They will capitalize interest on 10 lakh. They'll capitalize interest on 10 lakh. But out of 1540, work is done by the construction company. Work is done by the other subsidiary, and they had a markup of 10% on cost. So group as a whole, the cost is not 1540. Group as a whole, the cost will become 14 lakh. Acha, construction company mein no borrowing, but they have expenditure on qualifying asset. Borrowing nahi hai. Acha, to standalone books, real estate, they will capitalize interest on 10 lakh. Standalone books, real estate, they will capitalize interest on what? 10 lakh. Standalone books, construction company, no capitalization. Finance company, they just have finance, they will not capitalize anything. ठीक है. And parent use the loan money to acquire a subsidiary. So individually, finance company, no qualifying asset. Real estate company, they'll capitalize 10 lakh ka 7%, 70,000. Construction company mein there's no loan, only no borrowing, so no capitalization. This is individually. Now if I go to consolidated mein you try to see this way. For a group, the borrowing is this 10 and this 20. Can I say total 30 borrowing is there? 10 and this 20. 30 borrowing is there. And for a group, it's actually 7%. Then 7, they gave it to 8% to parent in any group. It's as such 7%. So तो 30 lakh loan. And now qualifying asset कितना है? This is 14 lakh for a group. This is 10 lakh. तो qualifying asset पे you spend 24. Loan is 30 but you spend 24. Capitalize on 24. तो 24 का 7% would have been capitalized, not 30. Total interest is 30 का 7%. Capitalization will be 24 का 7%, 168. Done. This is also over. Any doubts? Anybody? So in this chapter number 6, we are left with only Ind AS 116, that is leases. So otherwise your today chapter 3 got over, 4 got over, 6 got over. In 6, Ind AS 116 is pending. We'll come to it later on. I told you, you can't get tired. You need to keep on moving. Stop not when you are tired, but stop only when you are done. I repeat, stop not when you are tired, but stop only when you are done. So when you're done with your work, when you're done with your syllabus, when you're done with your target, that time you stop. Don't stop before it. So that was basically the sentence of the day for you. Stop not when you are tired, stop when you are done. Thank you so much. See you all tomorrow, same timing, evening 5 o'clock, and same we'll have 5 to 10:30. Till then, tata, bye-bye, take care. If you like our lecture, share it with all your friends. And yes, if anybody wants to purchase our FR classes or auditing classes, they're available on yashashacademy.com. Love you all. Bye-bye.